People were watching it on Zoom. Hello, hello, hello. People who are watching it on Zoom, please give me a confirmation if the audio video is clear. Accordingly, we will start with the session. Yeah, perfect, great. People who are watching it on YouTube, give me a confirmation if the audio video is clear. I have to change this. Go back to settings. Yeah, clear? Absolutely clear. Okay, great. Yeah, okay. From both the sides, we've got a confirmation that the audio video is clear. So I guess we should be in a position to start the session. Yeah, others also on YouTube, give me a confirmation. Okay, so let's start. Yes, everyone. So hello, hi, namaskaram, and good morning, everyone. Good morning, da. Okay. I hope you guys are doing really, really well. Yes or no? Sunday morning, you could have done so many things. You could have slept at home, watched a movie, but you chose to come here because you've already come here. Put in all the efforts. Let us make it fruitful. Okay. So we are going to start discussing a beautiful chapter, a simple chapter, a jujube chapter, a scoring chapter, advanced capital budgeting. Approximate weightage is going to be somewhere 8 to 10 marks from your examination perspective. Okay. Simple only it is, recently added by ICI, so a good amount of questions could be tested, and because it is a new chapter, so what happens is now we are only having questions from the study material. So majorly a question, if it comes from the study material only. We are having 40 questions, in that also mainly some 70% of those questions are jujube only. So it's going to be very simple for us to score well in this chapter. So from that perspective, okay, it is going to be a very good chapter. Yes, portfolio we studied, good amount of questions we had, maximum we tried tackling. Okay, this is a chapter wherein we can maximize our opportunity to score because chapter is very simple. Yes, few technicalities are there, few nuances are there, we will give time, we'll understand it, as simple as that. Okay, yes everyone, so normally, yes, we begin with a very simple quote or a very simple reminder. Now, normally what happens in life is possibly because I love math so much, so I try putting graphs everywhere. So assume on my x-axis I am taking the hard work that I am putting. On y-axis I am putting the rewards that I am getting. So how is it? You do not put the hard work. Will you be getting the reward? No, boss. You put some hard work, you will get some reward. You put more hard work, you should be getting more reward. You put even more hard work, you should be getting even more reward. So that means your graph should look like this. Yes or no? Okay. You do not put the hard work, you do not get the reward. You put some, you get more. In reality, this is not how it works. Initially, you should be putting in more hard work than the reward you are getting. But it takes a J-shaped curve. Because in the long term, there will be a time when you will be getting way more rewards than the efforts that you're putting. Now understand, once we reach here, everyone is happy because we feel that, okay, for the efforts that we are putting, we are getting in the rewards. Once we cross this, everyone is even more happy because more than the efforts we are putting in, we are getting the rewards. But the most challenging part is to have that courage here, is to have that long-term picture here. We are putting in the work, we are not getting the results. Yes, we see others enjoying, still struggling, we are putting in the efforts. We don't know if it will work or not. But to know that if you are working in the right direction, there is magic in time. It changes. In the long term, change things change, situations will change, stories will change. So all we'll have to do is put in the hard work, give it some time, and allow time to make the magic, because in the long term, magic will happen. Because if I can give you a very simple story, a very simple example, yes, from cricket, again, yesterday also I gave you a reference of cricket. It was the World Cup 2011, the finals. India is playing Sri Lanka. Sri Lanka played, they scored some 280 something. India came for batting. Sehwag gone out in the very first or second ball. Yes, somewhere in the third or fourth over, Sachin gets out. Okay, so here is the scene. Sachin is coming back to the pavilion. A 22, 23-year-old boy. Virat Kohli is going to play. It is Mumbai, India's home ground. A new player is coming. Yes, the crowd is filled with Indians, but there is absolutely no one to cheer for Virat Kohli. Why? The god of cricket is out. What will this guy do? The start, 2011. He went there, there was absolutely no one to support him at that particular point, because the god of cricket is out, boss. Okay, 12 years later, 19th November 2023, still hurts. India versus Australia. Indians are batting. It's an amazing score. Rohit Sharma is hitting like crazy. Rohit Sharma gets out. Still we have the hope. Indians are having the hope as long as Virat Kohli was there. That short ball from Pat Cummins, that hit which fell on the wicket, that shattered billions of dreams, because Indians knew that so long as he was there in the crease, the match was on. So long as he was there, India will not lose. So 12 years. Initially, you should be putting in more hard work than the rewards you will be getting. But over the time, you will reach a position wherein you will be getting way more rewards than the efforts you put in. Yes, we'll all be happy here. But the most important thing is to have that faith in yourself, to see that, to see the unseen, that okay, things will fall in place. Believe in yourself. Believe that one day magic will happen. Yes, everyone. So with this, let us start today's discussion. The chapter is going to be Advanced Capital Budgeting. Beautiful chapter, 3 concepts only. Okay, first we will be discussing concept 0, which is going to be basics. CA Inter, you should have studied. You would have forgotten. So quickly in a small time, we will discuss that. Then comes concept number 1, which is risk analysis in capital budgeting, important. Then comes concept 2, replacement decisions. Then comes concept 3, miscellaneous areas. Okay, quickly we'll start, quickly we'll finish it off. Okay, basics of capital budgeting. Yes, why do I use capital budgeting decisions? Why I want? Yes, to take investment decision on various long-term investment proposal. There is an investment proposal. I want to start a business. Should I start? Should I not start? Should I invest in that business? Should I not invest in that business? To take that decision, I am using capital budgeting decisions. Okay, bros. Great. Now look at this. How do I take decisions? How decision making happens? Short-term decisions are taken on the basis of marginal costing. Yes, but when I am taking long-term decisions, I will be using capital budgeting decision. Capital budgeting is just an extension of marginal costing. Understand, a very simple example I am taking. Yes. Suppose today I went to a shop. I purchased a calculator. 100 rupees I paid. Tomorrow SEBI is coming to me. SEBI is telling, sir, you purchased this calculator. Sir, please give it to me, sir. I told, I purchased it. No, sir, I'll pay you the money, sir. Tell me, bare minimum, how much money I should get so that I can give it to SEBI. 100 I should get. I'm telling, I don't want profit now. Forget. Bare minimum, marginal revenue should be equal to marginal cost. I paid 100. That means bare minimum 100 I want. Simple decision, short-term decision making. There is no different time period. There is no bringing to present value, nothing. Simple, GGB, over. Okay. So, very simple thing. Okay. If cash flows are going to be in the same period, I can directly compare. Okay, boss, today I paid 100. That means tomorrow if I am getting means bare minimum how much I want? 100 I want. Profit is not there, but loss is also not there. Is this clear? So, short-term decision, same period, directly you can compare and take the decision. Marginal costing on that basis you will do. But boss, assume. Tomorrow I decided I am going to stop teaching. Why? No maja is coming. We want some maja in life. So I decided we'll start a business. What business we'll start? We'll start manufacturing and selling wine. Yes, for CA students, we tried giving CA classes. Nobody is interested. Yes, they're all frustrated all the time. So we came up with new brand, wine. No tension. Due date tension, exam tension, IC tension. Ding, ding, ding. Sleep. Okay. So simple business we told, okay boss, at T is equal to 0, I manufactured wine. To manufacture wine, I incurred the cost of 100 rupees. Assume I don't have cash with me. So what I did, I went to bank, I took a loan. At what rate I took a loan? 10% I took a loan. Okay, boss. Now assume. Wine I manufactured, I cannot be selling it today. I have to store it. Assume I'm storing it for a year. Now don't tell me is it wine, beer, what I should store. I don't know. Random example. Okay, I'm Papa person. Okay, so I have to store for 1 year. 100 rupees on loan I took. Okay, I manufactured. Yes, interest is 10%. So tell me, at the end of first year, bare minimum how much I should get? 100 rupees is my cost. This amount I took it on a loan of 10%. At the end of first year, I am going to sell. Yes, SEBI comes to me. Saying, sir, full attention, sir. Sir, give me a bottle, sir. It's coming like this, ding ding. Saying, sir, I'll give 100 rupees, sir. Tell me, will I be selling at 100 rupees? No, I will not sell at 100 rupees. Sir, your cost is 100 rupees, na, sir. The cost was 100 at T is equal to 0. For 1 year, I am paying interest. How much? 10%. That means my total cost here is how much? 100 plus 10, 110. That means bare minimum how much I should be getting? 110. I am telling profit for the time being ignored. At least how much I should be getting? 110 I should be getting. Is this clear, everyone? Okay. So very simple point, a very simple point. If my cash flows are in the same period, directly you can compare and take a decision. Cash flows are in a different period. T is equal to 0, I paid 100. But at T is equal to 1, I am getting. Can I directly compare and take a decision? No, boss. Yes, I have to bring them to the same period. That is what is called as a discounting. I am bringing everything into present value terms. Is this clear? Now, it is not necessary everything I have to bring to present value. Everything I can take to future period also. Anywhere I can take, so long as every cash flow is in the same period, you can take the decision. For simplicity, we are bringing everything to present value. That's all. Is this clear, everyone? Okay. Now, let us understand a bit on basics of discounting. Just 5 minutes I will be spending because this chapter is completely playing around that. Yes, foundation you would have studied, inter also you would have studied, but still 5 minutes for my satisfaction. Okay, boss. Great. Now, look at this. How do I calculate the future value? Okay. Yes, I am telling a very simple thing. 100 rupees is my cost. How much interest I have to pay? 10%. That means at the end of year 1, bare minimum how much I should be getting? 110. Or can I also do it like this? Simple cross multiplication. Look at the students. Present value, future value. Today, if I put 1 rupee, at the end of 1 year, how much interest I want? 10% interest I want. That means how much it should be? 1.1 it should be. Simple. Today, how much I have put? 100 rupees I have put. That means at the end of 1 year, how much it should be? 100 into 1.1. Is this clear? Okay. So, very simple principle I will tell. If I am going front to future, I have to include interest. That means I will be doing, yes, whatever is the amount into 1 plus interest. Is this clear? I will be doing into. Okay. Perfect. 100 into 1 plus interest. 100 into 1.1. Okay, great, boss. Now I am telling, no, boss, I want to come back. Suppose I want to take a decision. I will be taking a decision like this. Okay, boss, at T is equal to 0, 100 rupees I paid. At T is equal to 1, he is willing to offer me, say, for example, 120 rupees. I want a 10% return. So, whether cash flows are in the same period? No, they are not in the same period. They are in different period. I am telling, okay, boss, I want to bring all the cash flow to this period. So, that means this cash flow of 120, I have to bring it back to this period. How do I bring it back? A very simple thing. Again, just a cross multiplication. Present value, future value. Yes, today if I put 1 rupee, after 1 year, how much I want? 10% interest I want. That means 1.1 I want. Okay. That means after 1 year, if I am getting 120 means today, how much is its value? It is going to be 120 divided by 1.1. How much is it going to be? 109 point whatever it is, forget it. That means understand 120 I am receiving in first period, 100 I am paying in T is equal to 0. Can I compare directly? No, I cannot compare directly. I will bring everything to present value terms. I told, okay, boss, 120 is in first year now. From first, yes, T is equal to 0, how much it is? It is 109. That means I am getting 109 inflow on first year. I am paying 109 outflow on first year. That means net how much benefit I am getting? 109 rupees. So should I accept this? I will accept this. Simple point. From future, I am coming back. I am coming back. I should eliminate interest. That means divided by 1 plus n. Is this clear, everyone? Okay, great. Yes. Now, next example we are going, just a simple tweak. Okay, 100 rupees is my cost. Okay, I took it at a loan of 10%. Okay, that means 10 rupees interest I have to pay. Now, I am telling 10% is my interest, boss. Chumma, this entire business I am doing not to earn any profit. Huh? No, I want profit. I am telling 10% interest I have to pay. In addition to that, 2% profit I want. That means tell me for 1 year total how much return I want. 10% plus 2%, 12% return I want. Okay, simple. That means now, yes, what should be my minimum selling price? What should be my minimum selling price? 100 rupees is my cost. 12% I want into 1.12. It is going to be equal to 112 rupees. I am going the front. I will include interest into 1% interest. Or else now I am telling, no, let me bring it back to t is equal to 0. Look at this. I am telling t is equal to 0. I paid 100. Assume t is equal to 1. I am getting 112. I have to see if it is tallying or not. Now, this one is at t is equal to 1. I want to bring it back. If I am going to bring it back means I have to eliminate interest. That means divided by 1 plus interest. Yes, 1 plus rate. For us it was 12%. That means divided by 1.12. 112 divided by 1.12. How much it is? 100. It got tallied. Yes or no, everyone? Okay. Simple moral of the story. From present I am going to the future. I am going front. What should I do? I should include interest. That means I will multiply. That is whatever is a value into 1 plus interest I will do. From future I am coming back. I am coming back. In that interest is there. I am coming back. That means what I have to do? I have to eliminate interest. That means I will be dividing. That means divided by 1 plus interest. Is this clear, everyone? Okay, simple. Till here things are fine. This much only is compounding. Nothing else is there. This only is okay, discounting. Over. I am going front, include interest. I am coming back, eliminate interest. Going front into 1 plus interest. Coming back, divided by 1 plus interest. Sufficient for us. Now look at this. With this, just let us try playing, yes, with the numbers for 5 minutes. Then we'll go ahead. Okay. My discount rate is 10%. Initially at t is equal to 0, I paid 100 rupees. First year I am getting 400. Second year I am getting 400. Third year I am getting 400. Fourth year I am getting 400. 10% is my discount rate. Tell me total how much cash inflow I am getting? 1600 I am getting. How much I am paying? 1000 only I am paying. Good or bad? Good or bad? Good or bad? I cannot compare. Why? Different period da. What I want? Same period I want. So option number 1, I will tell, let me bring everything to t is equal to 0. Okay, boss. Cash outflow is already at 0. So do I need to do anything? No, boss. This is at first period. Where I have to bring it to? 0. That means how much period back I should come? 1 period back. Yes, what is the interest rate? 10%. That means what I will do? Divided by 1.1. Okay. This, when am I getting? Second year. Where I want? At t is equal to 0, boss, I want. That means how much period back I should come? 2 years back. 1 year, 2 year back I should come. That means it is going to be divided by 1.1 square. Okay. This is a third year, boss. Where I want to come? 0th year. That means 1, 2, 3. 3 times I have to come back. That means divided by 1.1 to the power of 3. This is in 4th year. I want to bring it to 0. Yes, that means what I will be doing? How many times I have to come back? 4 times. Divided by 1.1 to the power of 4. Okay. You do that, you will be getting the number. Okay. Fine. Now, I hope you guys know how to take the factor. Yes, 1 divided by 1.1 to the power of 4 if you have to do means 1 divided by 1.1 equal. If you want annuity factor, press a GT. Is this clear, everyone? Okay, great. Now I am telling, okay, for the time being, chumma for time pass sake, I am telling, yes, we will be doing everything. We will be bringing it to 0 and taking a decision. But if I am telling, no, 0 is not lucky number for me. 4 is lucky number for me. I want to take all my cash flow to 4th period and compare. Can I do? I can do. Nothing is stopping me. Tell me, I am telling, no, boss, I want to take everything to 4th period and compare. Okay, boss, let us do it. Very simple, GGB. Now tell me, 4th year cash flow, it is already in 4th year. Do I need to do anything? No, boss, it is there. third year cash flow, I want to go front. How much period I want to go front? 1 year. That means what I will do? Into 1 plus interest into 1.1. Second year cash flow, third year, fourth year, 2 years I have to take it front. That means what I will do? Into, I am going front, 1.1. How many years? 2 years square. Okay, boss. First year cash flow, I want to take it to fourth year. How many years I have to go front? What? Second, third, fourth, 3 years I have to go. That means into 1.1 to the power of 3. 0th year cash flow, it is at 0. 1, 2, 3, 4. How many years I should go front? 4 years. That means into 1.1 to the power of 4. I am telling, no, boss, I am not interested in 4. 2 is my lucky number. Okay. We will bring all cash flow to second year. Now tell me, 400 of second year, that is already in second year. Do I need to do anything? No, boss. Now slowly let me come. 400, this is in first year. Where I have to go? Second year. I have to go front. That means into 1.1. This is at 0th year. I have to go to second year, first year, second year, into 1.1 square. This 400 is in third year. Where I want to come? Second year I want to come. How much back I want to come? 1 year back I have to come, divided by 1.1. This is in fourth year. Where I want to come? Second year. Fourth, third, second, divided by 1.1 whole square. Whatever you take, your ultimate decision will be same only. Your numbers could be different because that interest factor is there, but your decision is going to be same only. Simple. Your cash flow should be in same period. Only then you can compare and take a decision. But throughout standardized way, we are bringing everything to 0. Is this clear, everyone? Okay, great. This much is over. Now is the next point, which is going to be, if my interest rates are different, what will I do? Let us try understanding. Same only, simple only, jujube only. Okay, look at this. I am telling, I invested 100 rupees in bank. See, my water bottle is there in the bank. Yes, I invested 100 rupees in bank. Bank is telling, first year we will give you 10%, boss. Second year will give you 12%, boss. Okay, I want to know at the end of a second year how much I am getting. So tell me. Yes, first let me do in the form of number, then we will do, yes, logically also. Look at this. 100 rupees I put in the bank. First year, how much interest they are giving me? 10%. That means how much interest they will give me? 10 rupees. For that calculator is needed. God. Yes, that means at the end of first year, how much will it be? 110. Second year, how much interest they are giving me? 12% interest they are giving me. So now what is the value that is there? 110. On this 12%, how much will it be? 13.2. That means at the end of second year, how much it will be? 110 plus 13.2, 123.2. Or else look at this. Let me just do it in a very simple way. Yes, 100 rupees I invested here. Tell me first year how much is the interest? 10%. Second year how much is the interest? 12%. Tell me where do I want to go? I want to go here. Yes, here I am standing at 100. Tell me to go 1 year front, how much interest is there? I am going front. I should include interest, multiply. How much it is? 10%. That means into 1.1. Where did I reach? First year. I want for first year. No, boss. Where I want? Second year. I should again go front. Again, I should include interest. Boss, second year, how much it is? Yes, 12%. That means it is going to be 1.12. That means what is going to be the value? 100 into 1.1 into 1.12. How much is it? How much? 123.2. Is this clear, everyone? Yes, same number only I got. Okay, boss. Now I told going front. Now let us come back as well. Yes, say for example, I am telling at the end of same date I am keeping. First year is 10% interest. Second year is 12% interest. I am telling at the end of second year I am getting 123.2. I want to come to 0. How do I do it? Very simple, very simple, very simple. I am coming back. That means I have to eliminate interest. Tell me at the end of second year how much I am having? 123.2. Yes, tell me. From second year I am coming back. I should eliminate interest. Yes, divided by how much is the interest rate? 12%. That means it is 1.12. Yes, now I reach first year. I want first year. No, boss, I want 0th year. That means from first year again I should come back. Again I should eliminate interest. How much here it is? 10%. That means into 1.1. Yes or no? That means how much you are getting? 123.2 divided by 1.12 divided by 1.1. How much you are getting? 100 you are getting. Is this clear, everyone? Yes or no? Perfect. Okay, now look at this example for different cash periods. Let us try doing the calculation. At t is equal to 0, I am paying 4,000. Okay, first year 10%, second year 12%, third year 14%, fourth year 15%. First year I am getting 400, 400, 400, 400. Number I kept same. Okay. Suppose I want to calculate all my cash flow for t is equal to 0. Okay. Tell me, 1000 is already in 0th year. Do I need to do anything? Nothing, sir. 400 is in first year. Where I want to bring? 0th year. So I have to come back, means divided by 1 plus interest. What is the interest percentage? 10%. That means it is going to be divided by 1.1. Okay. Sir, second year cash flow is there, sir. Where I want to bring? 0th year. So I have to eliminate interest. That means it is going to be divided by. Tell me, second year cash flow from here to come here, what is the interest rate? 12%. That means it is going to be divided by 1.12. So where did I reach? First year. Now I want to come back to where? 0th year. Again I have to eliminate. Yes, here it is how much? 10%. That means it is going to be 1.10. Is this clear? Okay, boss. Third year I am getting 400. Yes, stuck I will tell. Tell me, yes, I will eliminate. That means divided by, yes, third year to second year, 14%, 1.14. Yes, second to first, 12%, 1.12. First to 0, 10%, 1.10. Over. Yes, fourth year is 400. I want to come back to 0th year. So third year, second year, first year, 0th year. 4 times I have to come back. That means divided by. Fourth year to third year is 15%, 1.15. Yes. Third to second is 14%, 1.14. Second to first is 12%, 1.12. First to 0 is 10%, 1.10. You will come here, you will take a decision. Is this clear? I am telling, sir. Yes, 0 is Shani, sir. You know Shani? You have heard the term Shani? No, that means Shani is in Kannada term. Shani means, what do you tell? Bad luck. Okay. Yes, we don't want 0, sir. We want 4. I want to take every cash flow to 4. Okay, take what is there. Tell me. 400 is already in 4th. Do I need to do anything? No, sir. This is in third year. So I have to go to 4th year. What is the interest percent? 15%. That means into 1.15. This is in second year. I want to go to 4th year. That means I am going front, include interest. How much? For third year into 1.14. For 4th year into 1.15. I reached here. First year I want to go front. Okay. From here to here into 1.12. From here to here into 1.14. From here to here into 1.15. Okay. 0th year I want to go front. Okay, boss. From here to here into 1.1. Here to here 1.12. 1.14. 1.15. I will reach. Based on that, take a decision. I am telling, sir, 4 is also not good, sir. 2 is super. Okay, do. Who is stopping? Tell me, 400 is already in second year. Do I need to do anything? Nothing, sir. Now, here, this 400 is in first year. I am going front. That means I have to include interest into 1 plus interest, 1.12. This is in 0. Yes, from 0 to 2 I have to go. That means first year 1.10, second year 1.12. I am going front into. This much I came. Sir, third year, sir, I have to come back. How much years I am coming back? 1 year I am coming back. What is the interest? 1.14. That means divided by 1.14. Fourth year I am coming back, sir. So from fourth to third, third to second. Here it is how much? Divided by 1.15. Here it is divided by 1.14. Is this clear, everyone? Okay, this much only we want. As simple as that. All these things are over. Okay. Now, once my discounting is clear, yes, let us go into the simple point, which is going to be net present value, NPV. CA Inter, so much we have played, just we will be spending, because this chapter is all about calculation of NPV. NPV only I am doing, nothing else I am doing. Okay, but some, yes, adjustments, all those things are there. Now, simple thing, yes, I started a business. At t is equal to 0, I am paying 100 rupees. At t is equal to 1, I am getting 120 rupees. That means overall, how much extra I am getting? 100 I am putting, 120 I am getting, 20 rupees extra I am getting. Good or bad? Good or bad? Good or bad? I don't know. Why? Different period. What I want? Same period. So what is my net present value telling? It is telling, boss, your cash flows are in different period. Bring everything to present value. Yes, this 20 rupees is the net value. Net value addition is there. But in present value terms, am I getting or not? I don't know. God only knows. So I will bring every cash flow to present value terms. T is equal to 0. Based on that, I will be taking a decision. Is this clear, everyone? Okay. So 3 different cash flows I will be having. I start a business, I will be having my initial investment. I am paying to start the business, which is also called as cash outflow at the start of the project. Then while the project is running, I will keep getting some cash from that business. Yes, it is called cash inflow during the life of the project. Once the project gets over, yes, these assets are there, I don't want that, I will sell off some cash, I will get. It is called as a terminal value or cash inflow at the end of the project. Vignesh Yadav, tell me now, what am I supposed to tell? Yes, he is money minded, he could have uploaded for 24 hours and remove it. Yes, already he is getting money through Tarun's binary. There should be a limit, okay? Yes, I've told you that, yes, we will be keeping it live only, okay? And I've kept the video till today morning. Today morning we've removed it, okay? Yes, pay attention, okay? Let us try understanding. Okay, so detailed steps are there. Yes, we will come to the steps. Yes, example is there. Yes, quickly let us have a look at the example. Yes, look at this. We are setting up a project. To set up the project, yes, initially, yes, I have to purchase assets 1,45,000. I have to install that 20,000. Yes, to set up the project, I got a subsidy of 35,000. 5 years is going to be the project. Yes, salvage value at the end of it, yes, I will be receiving 50,000. Depreciation is 20% per annum on WDV basis. Yes, expected sales yearly, every year what all sales could be there is given. Variable cost is 30%, fixed cost is 15,000 per annum. This is excluding depreciation. My tax is going to be, yes, 30%. My cost of capital is going to be 10%. Is this clear? Based on this, I should be calculating NPV. Okay, is this clear? Yes, so I should be calculating NPV based on that. Okay, we read this entire story. Yes, we are not getting some maja, nothing is understanding. So we'll do one thing. Let us try creating it in the form of a story. Okay, so are we guys ready, everyone? Yes or no? Okay, so let us try creating a story around this. Here comes our hero. We are going to learn the concept of setting up a business. With whom? With the two legendary characters. Who all? Rangachetan and Amban. Okay, heard of them? Not heard of them? Go first listen about them, then come to class. Okay, people who are sitting in the end, please come front. There is no mic, I have to throw my voice. Please come front and sit. Okay. So let us try understanding this. Pay attention, everyone. Yes, Ranga and Amban, they are sitting together. So Ranga is speaking to Amban, telling Amban is telling, Tillana, Parana. Yes, Ranga is telling, I am tired of becoming a gangster. Yes, we should do something else. Amban is telling, okay Anna, we will do. Tell me what we have to do. So he is telling, I am having a plan. Telling, what is the plan, Anna? Tell Anna. He is telling, previously we had our juice kada. That is where the story started. Adiyodadi, juice. Remember? Yes, we will do one thing. We will go back, start the juice shop again. Still, okay, Anna, we will start. Set, we will start Ranga and Amban juice shop. Set. Okay. But to start the business, we should be incurring some cost. Yes. So how much cost and all we are incurring, how much money we are getting, all that study you do and come. Chuma, we should not be losing money, na? Yes. So he is telling, go do some study and come. Amban is telling, okay, Anna, I will do the study and come. Okay. So Amban is imagining, yes, Ranga and Amban juice. Okay. See, he is also there. Sugar cane is there. This equipment we have to purchase. All these equipment we have to purchase. Okay. Ranga and Amban are sitting there chilling. Okay. Now, yes, Amban comes, yes, with a complete analysis, what all is needed. He is telling, to start the project, we have to incur some cash. Ranga is asking, how much? You tell me. He is telling, I made an analysis, boss. Yes, we have to purchase some assets, sugar cane machine and all. For that, 1,45,000 I have to pay. Okay, great. Along with that, we have to install them also. For that 20,000 you have to pay. Okay, great. All this when I am incurring at t is equal to 0 at the start. Okay, great. So 1,45,000 I paid, 20,000 I paid. So total how much I paid? 1,65,000 I paid. Now this much I paid because it was a good business or rural area, whatever it is. Government is giving a subsidy of 35,000. So tell me, net how much cash has gone from my pocket? 145 went, 20 also went, but 35 I got. That means net how much has gone? 130, 1,30,000. Okay, this is my initial investment. Yes, cash outflow at t is equal to 0. How much I am paying to purchase asset? Yes, how much installation cost less subsidy or anything, whatever I receive. Okay, boss. Super, super. With that, yes, we start the business. What we will be getting? He's telling 5 years life we are having. At the end of it, we will have to stop this business. Okay, great. Yes, 5 years, what all I am getting? He's telling, yes, first year 85,000 sales will get, second year 90, all these things we are getting. That is the sales. But to make sales, some cost I should incur. He's saying, what is the cost? He's telling variable cost is going to be 30%. Okay, great. Fixed cost is also there, which is 15,000. In that depreciation, I have not included. Okay, boss. He's telling, yes, if we earn money, for government, you have to pay tax. How much? 30% tax. Okay, great. Depreciation is 20% on a written down value basis. Okay. Yes, maximum every adjustments will be included here. Okay, fine. We are telling, okay, these 5 years, we will be getting this money. Okay. 5 years is over. Project is over. At the end of the project, will I be getting some cash? Someone is telling, yes or no? The end of the project, what I will do? I will sell the asset, na? From that I will get cash. Yes, so at the end of it, I will be getting a salvage value of 50,000 rupees. End of the project, 50,000 salvage value. By selling the asset, I will get. Okay, great. Yes, cost of capital. Yes, Ranga is telling, I want 10% return on my money. Okay. Yes, so based on this, we have to calculate the NPV. Okay. Now story is a bit more clearer. So based on this, let us try doing the calculations. Pay attention, everyone. Step 1 is a calculation of initial investment. Tell me, at t is equal to 0, when I am setting up the project, what all I am paying? Tell me, to purchase the asset, I am paying how much? 1,45,000. For installation, I am paying how much? 20,000. But I am getting back how much subsidy? 35,000. That means net how much I am paying? 1,30,000 I am paying. Yes or no? Yes. So I can tell in a very simple way, initial investment, it is cost of the asset plus installation cost minus the subsidy received. It is going to be my initial investment or cash outflow at t is equal to 0. Okay. Okay. This was at t is equal to 0. Over the course of 5 years, I am running the business. If I am running the business, I am getting money. So what all money I am getting? Firstly, sales is given. Is this the cash flow I am getting? No, boss, cost and all I have to pay. Okay, so let me write down the sales. How much is the sales? 85,000, 90,000, 1,80,000, 50,000. Okay, boss. With that, variable cost I have to incur. How much is my variable cost? 30% is my variable cost. So accordingly, I will be writing down 30% of this. Is this the only cost I am paying? No, boss. Fixed cost also I am paying. Every year, how much fixed cost I am paying? 15,000 rupees fixed cost I am paying. That also I will pay. So if I reduce that, I will arrive at my EBITDA, EBITDA, earnings before interest, tax, depreciation, amortization. That is basically from the business how much I earned. Yes, 85,000 minus 30% minus 15,000, 44,500. Similarly for all the years, I will do the calculation and keep. But boss, this is before reducing depreciation. From this, what I have to reduce? Depreciation also I have to reduce. Okay, boss. So depreciation, at what rate I was charging depreciation? 20% per annum on a written down value basis. Tell me, depreciation I am charging on my assets. Yes, FR, Ind AS. Yes, how much? What chumma time pass you guys are doing there, da? What I was telling? Depreciation. Yes. PP. I am going to charge depreciation on what? On the cost of the asset, which is going to be purchase cost plus installation. All those things are there. Yes or no? So net, what is the cost of my asset? 1,30,000 it is going to be. So based on that, I will be charging depreciation. How much is going to be depreciation? 20% on a written down value basis. Okay. So let me try calculating the depreciation. Tell me, first year it is 1,30,000 rupees. Based on that, first year's depreciation is going to be how much? 20%. So 26,000. Balance value is going to be 1,04,000. Second year on 1,04,000 I will be charging 20%, 20,800. Third year on this value I will charge. Fourth year on this value I will charge. Fifth year on this value I will charge. Last value I will be getting. Calculations I have done and kept so that we can save time. Okay. There is a shortcut way of doing this as well. Now look at this depreciation I have to calculate. Okay. Yes, on your calculator, 1,30,000 into 20%. How much you are getting? 26,000. Oh my God, magic. No, this is not magic. Now for next year depreciation, from here only I will do. Yes, this is first year's depreciation. Tell me depreciation is how much percentage? 20%. That means the next year's value is going to be 80%. So this directly you do into 0.8. How much you are having? 20,800. This is magic. Now again do into 0.8. 16,640 into 0.8. 13,312 into 0.8. 10,650. Every year's depreciation I got. I want to calculate a salvage value at the end. Just to do a GT, you will get total depreciation minus 1,30,000 equal to, you will get the salvage value. Without this table also you can do, but if it is confusing, chumma 2 minutes will go in doing a table. Do it, finish it off. Is this clear? Okay boss. Depreciation also I reduced. Great. So from my earnings before depreciation I reduce my depreciation. Yes, I will earn my earnings before interest as well as tax. Okay. Okay boss. From this I will not be reducing the interest. Why? I will explain. Yes, directly tax I will reduce. Assume for the time being interest is not there. I will tell you why I am not reducing interest, because the very fact that I am bringing it into present value means that I am recovering my finance cost. I am recovering my interest plus my profit. That is why separately I am not doing it. Okay, leave it aside. Okay, from this I will reduce my tax. How much tax I have to pay? 30% tax I have to pay. Okay boss, I will earn arrive at my no PAT or my profit after tax. This much amount I got, 12,950. On this I have to add back my depreciation. Why we should add back depreciation? Depreciation was a non-cash. Yes, then why did I reduce on earth depreciation? Just to calculate my tax expenses. Is this clear? I hope there is no need to go so much into detail and again tell you how this happens again, because it is a CA final, again it is a revision. Is this clear? So I will arrive at my cash flow after tax. Okay, simple. Sales minus all cost, operating cost. I will arrive at my earnings before interest, tax, depreciation, amortization. From that I will reduce my depreciation, amortization. I will arrive at my EBIT. From that directly tax I will reduce. Interest I will not reduce. Directly tax I will reduce. Yes, on that I will add back depreciation to arrive at my cash flow after tax. Is this clear? Okay, perfect. Every year's cash flow also I got. Great, amazing. Now at the end of the project, Amban had told that we can sell and we can get some money. So how much money I am getting at the end of the project, that also let me try seeing. Look at this, look at this, look at this. At the end of the life, how much salvage value I am getting? 50,000 I am getting. That means 50,000 cash I am getting. Yes or no? Okay boss, great. Yes, 50,000 cash I am getting at the end of the year. At the end of the life, what was the value of the asset, carrying value of the asset? It was some 42,598. That means tell me, am I having a profit here? Am I having a gain here? Yes boss. How much gain I am having? 7,402. The moment I get a profit, who will come and stand? Bhai aur behno, tax. How much tax? Dena padega ki nahi dena padega? 30% tax I have to pay. Tell me, how much gain I am having? 7,402. On that 30% is going to be how much? 2,220. That means my net terminal value is going to be how much? 7,402 minus 2,220, which is going to be how much? Tell me the value. 7,402 minus 2,220 is going to be 5,182. Yes or no? Yes or no? Yes or no? No. Why? Yada Mandu sir. Understand, I am standing here. At t is equal to 5, project is over. Yes, Rangacheta, what he did, he sold the asset. I am only looking at cash. He sold the asset. How much cash came? 50,000 cash came. Okay. This carrying amount of 42,598, what is that? That is the book value. Do I need to pay anyone? Okay. 7,402 is a capital gain. Okay, that I've earned from that. Do I need to pay 21? What I need to pay? Tax I need to pay. How much? 2,220 I am paying. That means net how much cash I am having. 50,000 minus 2,220, it is going to be 47,780 is going to be my terminal value. 47,780. Is this clear? So my terminal value, I am only looking at cash. This is where most people make a mistake. Okay, how much is sale value I got? From that, how much tax I paid? That is going to be my terminal value. Okay, okay, boss. Great. Now understand what all we have done. We have calculated cash flow at all the period. At t is equal to 0. Yes, I am incurring a cash outflow of 1.3 lakh. T is equal to 1. I am getting a cash inflow. 1 I am getting, 2 I am getting, 3 I am getting, 4 I am getting, 5 I am getting. With that, 5th year, I am also getting a terminal value. This gives me the total cash flow for every year. Can I directly compare and take a decision? No, boss. Why? Time period is different. Where I have to bring everything to? Present value. That means I will bring everything to present value terms. Yes, based on that, I will calculate the decision. Is this clear? So that means I will do calculation of present value of cash inflow minus present value of cash outflow. I will arrive at my NPV. Look at this. NPV is present value of cash inflow minus present value of cash outflow. Yes, first year how much I am getting, second year how much I am getting, third year how much I am getting, fourth year how much I am getting, fifth year how much I am getting. This is during the life. With that 5th year terminal value also I am getting. Yes, when you are taking your discount factor, 1 divided by 1.1 equals. Do not press equals. Why? 5th year only it is. Or else you can just add these two and keep. But this is a place you should be careful, cautious. Wherever you guys are committing mistakes, I am telling. Yes, you add, yes, multiplication is something you will do. Yes, you are getting 1,63,590. So what is the ultimate impact this business is having? Ranga, if he decides to start the business, he wants 10% return means. Yes, how much initial investment he is putting in the business? 1,30,000 he is putting. Over the course of different years, he is getting money. Can he directly compare? No, boss. He brought everything to present value. So when he is seeing on present value terms, how much cash inflow he is getting? 1,63,590 he is getting. How much is the initial investment or present value of cash outflow? 1,30,000. That means on net basis, what is the NPV? 33,590 rupees. So tell me, overall NPV is positive or negative? Positive. That means whether decision should be accepted. Yes, boss, decision should be accepted. Okay, project should be accepted. What does this mean? NPV of 33,590. What does it mean? It means that, tell me how much return I want on the project. 10% I want. Am I getting 10%? Yes, boss, I am getting 10%. In addition to that, on present value terms, some 33,590 also I am getting. So am I getting required? Yes, boss. More than that, some extra also I am getting. Is this clear, everyone? Okay, perfect. That means look at this, students. Now let us come to the steps for us to determine. Okay. Step 1. Yes, I should be calculating the initial investment. 3 different cash flows are there. Initial investment, cash inflow during the life, terminal value. Okay. Initial investment at t is equal to 0. What all I am paying? Purchase cost of asset plus installation etc. expenses minus subsidy received. I will arrive at my initial investment. During the life, what is going to be my cash inflow? Sales I will be doing. From that, whatever cost, variable, fixed, operating, all those things I will reduce. I will arrive at my EBIT DA before depreciation, amortization. I will reduce my depreciation. Sir, but depreciation I am not paying now. Just for tax adjustment I am doing. I will arrive at my earnings before interest and tax. From that, directly tax I will reduce. I will arrive at my no PAT, or you can also call it as profit after tax. Yes, on that you will add back depreciation. Depreciation I showed only for showing tax adjustment. I will arrive at my cash flow after tax. Is this clear? Okay, interest will not be reduced, because when I'm discounting means, okay, interest I'm taking care of. Is this clear? Yes, at the end of it, terminal value. Yes, it is a sale value of asset plus or minus tax effect on that. I'm not going to do anything else. Capital gain is only for calculation. Terminal value is sale value plus or minus tax effect. Sir, tax I am paying now. How it is plus or minus? Yes, understand. Yes, if I am having a capital gain, I am having gain means what I have to do? I have to pay tax. That means it is going to be cash outflow. I will be doing this. Yes, if I am having capital loss, that means I will be setting it off against my other gain. But sir, yes, income tax provision does not allow all those things. Keep it in income tax. Do not bring it here. Okay. Yes. So I will be getting a tax shield on the loss. I will be getting a benefit on that. Yes, that I will be adding. I will explain. Do not worry. Look at this. Yes, how will I calculate capital gain or capital loss? I will see what is the sale value minus my carrying amount. Okay, suppose my sale value is 10,000, carrying amount is 9,000. Tell me, am I having gain or loss? Gain, how much is the gain? 1,000 is a gain. So if difference is positive means, yes, it is going to be gain. Gain means what I have to do? I have to pay tax. Okay, it is going to be cash outflow. Suppose, yes, my carrying value is 10,000. Yes, sale value received is 8,000 only. That means how much is going to be the value? 2,000 negative. Yes, gain or loss? It is going to be loss. If it is a loss means, do I need to pay tax? No, I will be getting some benefit. Yes, which is in the form of a reduction of tax payable on other income. Yes, I will be getting tax saving on loss. Yes, I will be treating it as cash inflow. Is this clear? Okay. Now, yes, in a very simple way, yes, I will show you this situation of how am I getting the benefit. Look at this, students, simple. What you guys are doing the yes, people who are watching it on YouTube, yes, please do not get into the disturbance. Okay, there will be people who are trying to create a mess. Yes, you remember what is your objective. You've come here to study. Okay, there is no need to justify me, not justify me. Okay, yes, the very simple thing is, yes, I have not earned a single rupee yet on AFM. Yes, for people who are telling, okay, he's doing it for money. Okay, that's a simple reality. Okay, yes, for the very first time I'm taking classes for AFM. Okay, there is no course available, nothing is available. Okay, so yes, people who are spreading negativity, it is absolutely fine, no issues. But people who are watching it for the sake of learning, there is no need to justify me, my efforts, nothing. Yes, I know the efforts that I've put in. I have faith in myself. Yes, people will be there. Some people will like you, some people will not like you. That's a rule of life. Simple. Just ignore, focus on what you are here to do. Yes, you are here to learn. Yes, just focus on that. Yes, if it is disturbing you, put it on full screen. Do not look at the comments. As simple as that, dear. Simple. Okay, chill. Okay. Look at this. Calculation of capital gain, capital loss, all those things. Okay, fine. First situation. At the end of it, yes, 10,000 is my carrying value. Assume 15,000 sale value I got. Happy or sad? Happy. What is going to be my capital gain? 5,000 rupees is my capital gain. The moment I got capital gain, who came? भाई और बहनों, टैक्स पे करना चाहिए कि नहीं पे करना चाहिए? 30% tax. Tell me on 5,000, 30% tax is going to be how much? 1,500. That means what is going to be the terminal value? 5,000 minus 1,500, 3,500. Yes or no? Yes or no? Yes or no? No. This is where we commit mistakes. This is okay gain. Yes, I want cash. 15,000 cash I got. 1,500 tax I paid. Net how much cash I got? Yes, 13,500 cash I got. You have to be careful here. Okay. Second situation, 10,000 is carrying value. I also got 10,000 only. Gain is there? No. Tax I have to pay? No. That means what is the value? 0. Yes or no? Yes or no? Yes or no? Madam Mandu sir, what the? 10,000 I got. Am I paying? No. That means how much I got? 10,000 I got. As simple as that. Is this clear? Third situation, 10,000 was the carrying value. I got 6,000 only. Tell me capital gain or capital loss? Capital loss, boss. How much is my capital loss? 4,000 negative it is. Now tell me capital loss. I'm already sitting and crying. Oh my God, loss happened. Whether government will come and again collect tax? Maybe God knows. Okay. For now it is not there. Okay. Yes. So, but what government is telling? Yes, because you are having a loss now, you set it off against other income. Now assume. Simple. I am running my business. From that, I am earning 1 lakh rupees PGBP income. That means ideally 30% means how much I should have paid? 30,000 I should have paid. But because I sold this asset on a loss, how much loss I had on this? 4,000 loss I had on this. So now what I will tell, boss, from business I earned 1 lakh, but this 4,000 loss also I incurred now. That means my net income is how much? 96,000 only. On that I will be paying the 30%, which is going to be how much? 28,800. That means tell me. Yes, if this loss was not there, I should have paid 30,000. Because this loss is there, now I am paying 28,800 only. That means how much benefit I got? 1,200 rupees tax that I had to otherwise pay, I have saved now. That is a benefit, as good as my cash inflow. Not paying cash is as good as I am receiving cash. Is this clear? Okay. But sir, PGBP, capital gain, cannot set off all those things. Keep it in income tax. It could be some other capital asset also. I just gave you guys an example to understand. Okay, boss. So very simple thing. If I am having capital gain means minus, capital loss means on that tax shield plus. Ulta it is going to be as simple as that. So 6,000 cash I am getting, 1,200 rupees benefit I am getting. That means total is going to be 7,200. Is this clear, everyone? Yes or no? Yes or no? Yes or no? Okay, till here we have done. We will be calculating NPV. Yes, every year's whatever it is. Yes, I'll bring it to present value terms. Based on that, if my NPV is positive, should I accept or should I reject? I should accept, because it is giving me more than required return. NPV is a negative. I should accept or reject? I should reject. NPV is 0. Should I accept or should I reject? NPV is 0. NPV is 0. NPV is 0. What I should do? I should accept. Why? Understand. NPV is the extra return over my required return. I am telling from my business, I want 10%. Different period cash flows are there. I discounted at 10%. That means 10% I got. Beyond that I am getting or not is what NPV is telling. I am telling I want 10%. Am I getting, if NPV is 0, am I getting 10%? Extra I am not getting. I anyways wanted 10% only na. Extra I am getting means bingo. Otherwise no problem. 10% I am getting na. So even if my NPV is 0, I will still be accepting the decision. Is this clear? Because NPV is going to represent the additional return that we are going to earn. Is this clear, everyone? Okay, great, perfect. Yes, working capital adjustment for us. Yes, final not required. Treatment of interest, yes, in a small way I have told you guys. Yes, present value factors for the entire subject of AFM. If question gives you present value factor, you will use that factor only. You will not be calculating it. Otherwise, you will be calculating your present value factor up to 3 decimal digit is sufficient. Okay, boss. Yes, example we have seen. Decision making is over. Okay, yes, part 1 is over. NPV, this only will be using 99.99%. Okay, next one thing is profitability index. Yes, what is profitability index trying to tell me? It is telling me for every 1 rupee that I am putting today on the present value terms, how much cash inflow I am getting. Suppose my profitability index is 1.2. What does it mean? Yes, profitability index formula, it is the present value of cash inflow divided by present value of cash outflow. What is it telling? Yes, if my PI is equal to 1.2, it means that today if I put 1 rupee na, yes, on today's terms, present value terms, I will be getting a cash inflow of 1.2. That means 0.2 benefit will be there. Yes, that is after, yes, getting the required rate of return. Is this clear, everyone? Okay. So if my PI is more than 1, I will be accepting. If it is less than 1, I will be rejecting. Not telling in detail, it is not needed also. Okay. So very simple example, look at this. 2 projects are there. Yes. Steps are going to be same. First 3 steps are going to be same. Step 1, calculate initial investment, cash outflow. Step 2, calculate cash inflow during the life. Step 3, calculate terminal value. Yes, bring your cash inflow to present value. That is step 2 as well as step 3, bring to present value. Now you calculate profitability index, present value of cash inflow divided by present value of cash outflow. Okay, boss. First project you calculated present value of cash inflow, 2 lakh it is. Present value of cash outflow is 1 lakh. Tell me what is my profitability index? 2 lakh divided by 1 lakh, it is going to be 2. Yes, my NPV is 1 lakh favorable. Now what does it 2 indicate? It is telling that if I put 1 rupee today on today's terms, I am getting back 2 rupees. Okay. Project B, 12 lakh I put. Yes, 12 lakh is total present value of cash inflow. 10 lakh is present value of cash outflow. That means 2 lakh is going to be my NPV. Okay, NPV is 2 lakh. Now tell me. I want to calculate the profitability index. Present value of cash inflow divided by present value of cash outflow. 12 lakh divided by 10 lakh, it is going to be 1.2. That means what does it mean? If I put 1 rupee today cash outflow, on today's terms, I am getting 1.2 cash inflow. Is this clear? Okay, boss. Great. Okay. Now, based on this, if I have to take a decision means, based on NPV, if I have to take a decision means, I will be selecting project B because 2 lakh it is giving. But based on profitability index, if I have to take a decision means, look at this. Project B, if I put 1 rupee today, now 1.2 I am getting. But A, if I put 1 rupee today, now 2 rupees I am getting. Tell me which one is better? A is better. Okay, so this is giving me a better decision because NPV is an absolute number. This becomes a relative number. Is this clear, everyone? Okay, not discussing too much. Yes, profitability index is present value of cash inflow divided by present value of cash outflow. If it is more than 1, we accept. If it is less than 1, we reject it. As simple as that. Okay, great. Then comes internal rate of return. I'll just be taking a 1 minute break. Yeah, we'll continue. Yes, boss. The next point is internal rate of return. Again, this is a basic. We will keep using it at so many places. So, we'll spend some time to understand this. Once this is done, our basics are done, we will go ahead. But everywhere in advance, it is just playing based on NPV as well as IRR. Nothing more is there in this entire chapter. That's all it is there. Okay, boss. What is IRR telling? Yes, NPV told me how much extra return I am getting. IRR is telling how much return actually I am getting. IRR is saying how much is the actual return that I am getting. Look at this very simple example. We decided we are going to stop teaching. Chumma negative comments and all are coming after putting in so much efforts. Chumma da, just because of negative comment I won't do. Chumma example, assuming is free. Okay. So I told 100 rupees I am incurring to manufacture a beer. Okay. Okay, boss. Cost of capital is 10%. 10% interest I am incurring. With that, I also want Papa something. Yes, so I want 2% profit. That means tell me total how much percentage return I want. 12% return I want. Okay, simple point. That means today if I put 100 rupees means at the end of first year, yes, bare minimum how much I want. 112 I want. If I get 112, okay, I am happy, boss. Okay, great. Assume in reality I am getting 120 rupees. Okay, in reality how much I am getting? 120 rupees. Now, decision I can take anywhere. I can take every cash flow front. I can bring every cash flow back. Wherever I want, I can take decision. But in NPV, every cash flow I am bringing to 0 and taking decision. Tell me how much return I want. 12% I want. First year, how much I am getting? 120 I am getting. Yes, I will bring it back 1 year divided by 1.12. Tell me what is going to be present value of cash inflow. 120 divided by 1.12. How much it is? 117 or 107. Yes, that is the present value of cash inflow. Present value of cash outflow is how much? 100. That means what is my NPV? 7.14%. Is this okay? Now, what does this mean? It means that, boss, I want 12% return. Am I getting 12%? Over and above 12%. I am getting some 7 rupee on present value basis. That means tell me my actual return is more than 12% or less than 12%. More than 12%, boss. Even after 12%, I am getting some extra. That means I am earning a bit more. How much more? Let me see. Yes, suppose I'm earning more than 12%. So now let me see how much actually I'm earning. Let me try discounting at 18% and see if I'm getting 18% or not. Tell me. I'm telling 120 rupees. Let me see if I'm getting 18% or not. Yes, bring it to present value. Divided by 1.18. How much is going to be the present value? 10, 1.69 whatever, minus 100 rupees. So what is going to be my NPV? 1.6949. Yes, what does it mean? It means that, boss, yes, if I discount at 18%, still my NPV is 1 rupee. That means, am I earning 18%? Yes, boss. I am earning a bit more than 18%. Even after earning 18%, I am getting a bit extra. How much extra? Let me increase the rate again and see. Yes, randomly, let me try discounting by 22%. Okay. Now, here I know, looking at this, because I have taken a very simple example, looking at that, I know, yes, 100 today, yes, 120 after first year means actually 20% I earned. Simple jujube number only I have kept. But in reality, I will not be knowing. So, different rates, I am saying, okay, this much, this much I am earning. Okay. Let me try discounting at 22% and see. Tell me 120 I am getting at first year. I want to bring it back to 0th year. At what rate I am checking? I am testing 22% I am getting or not. So, divided by 1.22. So, 120 divided by 1.22. That becomes my present value of cash inflow minus 100. How much you are getting? Minus 1.6393. That means, tell me, am I earning 22%? No, boss. I am earning a bit less than 22%. Okay. So, am I earning 18%? Yes, boss. Am I earning 22%? No, boss. I am earning somewhere in between the two. How much I am earning? That is what I have to calculate. Yes, interpolation formula is there. Is rate at lower plus whatever it is. God knows what that formula is. Who wants that? Simple, jujube. Okay, simple. Yes, I know my actual return is between 18 and 22. Where? Let me just try using a simple cross multiplication. Tell me, students, from 18%, if I increase my discount rate to 22%, that is, I increase my rate by 4%, what happens to my NPV? My NPV was at 1.6949. From there, it came back, it came down to minus 1.6393. That means, from 1.6949, it came to 0. Then it again went negative. That means, total by how much it fell? 3.3342. Simple. I am telling, if I increase my discount rate by 4%, my NPV will fall by 3.3342. This is okay. Okay. I am telling, boss, what I want? I want my NPV to be 0. When my NPV is 0, that time I am getting, okay, exactly how much I am earning. I want to know exactly how much actually I have earned. Okay. That means, I am telling, from 18%, from lower end, let me go. Yes, from here, I am at 1.6949. If I increase 4%, I will reach minus 1.63. Do I want to reach minus? No, boss. Where I want to reach? I want to reach 0. That means, I want to reduce it by how much only? I want to reduce it by 1.6949 only. That means, by how much I should increase my discount rate. Simple, simple, simple. Look at this, everyone. Let me just write it again. Yes, look at this. Discount rate, NPV. If I increase my discount rate by 4%, my NPV will decrease by 3.3342. I want to decrease my NPV by how much only? From 1.6949, I want to bring it to 0 only. That is, I want to decrease it by 1.6949 only. That means, by how much I should increase the discount rate? Cross multiplication. Look at this. So, what I am telling? 18% I am earning a, yes, a bit extra I am earning. How much extra I want? Simple cross multiplication. It is 1.6949 into 4 divided by 3.3342. Yes, how much is it going to be? 1.6949 into 4 divided by 3.3342 plus 18. How much you are getting? It is going to be, yes, 2.03. 18 I am getting, extra 2.03 I will be earning. That means, around 20.03% I am getting. Is this clear, everyone? Yes, I know 100, 120 means how much I am earning? 20%. Sir, 0.03 difference is there now. Now understand, yes, interpolation, it will not give you exact number, because between the two periods, you have not done present value. You have just done, yes, a direct relationship. Okay, a small, that is going to be very minute. Exactly accurately, it is not possible for you to calculate. Is this clear, everyone? Okay, okay. Now, without touching a formula, I have calculated my, yes, IRR. Now, I am telling, sir, I don't want to come from 18. I want to come from 22. Why da? Sir, chumma sir, fun. Okay, let us do from that as well. I am telling, yes, look at this. 22%. Am I earning 22%? A bit less than 22%. How much less? I am telling now from here, let me come back. Tell me, from 22%, if I reduce my discount rate to 18%, that is, if I reduce by 4%, yes, my NPV from minus 1.6393, it will come to plus 1.6949. That is, from minus 1.6393, it will reach 0. From there, it will go to plus 1.6949. That means my NPV will increase by how much? 3.3342. Okay. But I want to increase my NPV by how much only? Boss, I am standing here. Here I am standing. You should always know where you are standing. Huh? As a best friend or as a boyfriend? As a best friend is always better. Okay? Oda. Left side, lower rate, higher rate. What does it be? What you are thinking? Proper mindset. Now tell me. Yes, if I reduce from 22 to 18, yes, my NPV will increase from here to here. But I want to bring to where only? From here, I want to bring to 0 only. That means I want to increase it by how much only? 1.64, yes, 6393 only. That means how much I should reduce? Okay, boss, I will tell, if I reduce my discount rate by 4%, my NPV will increase by 3.3342. Yes, I want to increase my NPV by 1.6393 only. That means I should reduce by how much percent? Simple. Yes, it is going to be 1.6393 into 4 divided by 3.3342. 1.6393 into 4 divided by 3.3342. How much it is? 1.97. That means from 22, I should reduce by 1.97. That means actually how much I am earning? 20.03. Same answer only I got. Same only I should get. As simple as that. From wherever you can play with that. Is this clear? A simple cross multiplication. It is absolutely no need. Draw a line. Line should be straight. Okay. Yes. You should see. Yes. How much discount rate you are changing, by how much NPV is changing. How much I want NPV to change, based on that do a cross multiplication. Is this clear, everyone? Okay, boss. Great. So what are the steps? Yes. Step 1 is you will be calculating all cash flows, same NPV only, present value of cash outflow, cash inflow during the life, terminal value. Okay. Now how much return I am earning, I want to see. How will I see? Trial and error. Randomly I will put some interest rates and see. Yes. Yes. So calculate NPV using a random rate. Say randomly you can start with 10%. Okay, boss. If your NPV is positive, you discounted at 10%. Your NPV is positive, say positive 100. What does it mean? It means I am earning a bit more than 10%. That means how much more? I will take a higher rate. Yes, I will increase the rate. I will try doing it by 15%. Still I am getting plus 50. I am earning bit more. Again I will increase, say 20%. Okay, I am getting somewhere around 30 or 20. Random numbers I am putting. A bit more. Let me put 25. That means now I am earning minus 10. What does it mean? That means I am earning between 20 and 25. Is this clear? Now where between 20 and 25? I have taken two rates. Preferably one rate should be giving my NPV positive, one rate should be giving my NPV negative. The difference should not be much. You cannot take 10% and 90%. Okay, the difference should be as less as possible, because in the middle of that I am not doing, yes, present value discounting. Okay, yes, not getting into that. Okay, obtain two rates that make NPV close to 0. One will make NPV positive, one will make NPV negative. Yes, ensure that the difference is not huge. Ideally, preferably it should be less than 5%. Then do your interpolation and calculate IRR. I am not putting formula, lower rate plus whatever it is. Just to draw a line, get the value, as simple as that. Okay, yes, decision making. Suppose from the project, I want 10%. The IRR is 15%. Tell me how much return I want. 10%. IRR is telling actually how much I am getting. Actually 15% I am getting. Good or bad? Happy or sad? Will I invest or not? I will go and invest. Accept the project. Yes, required rate is 10. 10% I want. Yes, but my IRR is 5 only. Means actually 5 only I am getting. Good or bad? Happy or sad? Sad. Will I put my money? No, boss. Reject the project. Is this clear? IRR is telling actually how much return I am getting. Is this clear, everyone? Yes or no? Yes or no? Yes or no? Absolutely clear. Okay, yes, for the same example, if you want, you can calculate. Yes, the IRR. Yes, first step is to keep your cash flows ready. Yes, initial investment cash inflow during the life terminal value. Yes, discount at some random rate. Yes, NPV positive, increase the rate and see. Positive again increase. Get the rates where, yes, one is positive, one is negative. That means between 18 and 20 it is lying. So how much? If you increase the rate by 2%, this is falling by whatever it is. I want it to fall from 3346 to 0 only. That means how much cross multiplication you will be getting your answer. Is this clear, everyone? Okay, perfecta. Basics is over. We have spent a good amount of time understanding the basics, because if your basics are ready, okay, understand, yes, 80% of this chapter I am calculating NPV only. And at these 3-4 different places, I will be using reference of IRR. So there is no need for me. So if I tell IRR, you will be in a position to do it. Is this clear? That is why we've spent a good amount of time, even though it is a revision. Yes, giving you guys 2 minutes, then we will continue our discussion. Yes, online live students, give me a confirmation. Everything is fine. YouTube. Okay, great. Set. Maja is coming. Sebi, coffee you have, Ada? Give me half glass. When did you guys come? 10 o'clock only, na? I'd put a message in our group telling that 10 o'clock will be the session. 5 o'clock I put. Yes, after writing everything, 5 o'clock I went to sleep. Yes, after doing this, what do we get in return? Money minded. What will happen? Because of that was, anyways, it is on slow mode only. Yes, yes. Now what I'm speaking, students will get after 2 minutes only. They will subscribe. See, people want to spam, they can do anything in the world. Huh? No issues. Okay, so we'll continue our discussion, everyone. Okay, here comes the concept one, a very big concept, a very beautiful concept, which is going to be, yes, till now whatever we discuss, sir, NPV calculation, standalone basis, 10 marks will come, no, will not come. But in a question, calculation of NPV will come so many times. Okay, yes, but still in the most detailed way only with maximum adjustments we have understood. Okay, now comes risk analysis in capital budgeting. Now understand what exactly is happening, what exactly on earth is the risk. Yes, now look at this, look at this, look at this. Simple. Rangacheta and Amban, they decided that they are going to start the business. Okay, when do they take the decision? At t is equal to 0, they are going to take the decision. But when are they going to be getting the cash flow? At different periods in the future. Tell me, cash flow I will be getting in the future. Certain, not certain. Not certain. I estimated 1 lakh I might be getting. But confirm, pakka I will get. No, it can be more also, it can be less also. So, is there a risk? There is a risk. If I know exactly how much I am getting, no worry only. Directly, Jujib, you can take a decision. But I don't know. Risk is there. Initial investment, today I analyzed and I thought, okay, 1,30,000, I will be in a position to set up the project. I went there, he's telling, boss, machine cost has increased. I have to pay more, risk is there. I thought every year 1 lakh cash inflow I will get. I did not get, some competitor came, risk is there. I thought at the end of it, terminal value will be there 50,000. That asset has become obsolete, risk is there. I thought, yes, I will be getting a loan at 8%. So 2% for me a profit, 10% return is sufficient. But bank increased the rate, they made it 12%. So now I want 14%. Risk is there, risk is there. Previously 10% was sufficient, now I want 14%. So all these are estimates of the future. So if it changes, risk is there, risk is there. Now how do I incorporate the risk and take my decision? Okay, three different, yes, sets of techniques are there. First is the conventional techniques. Here we are having RADR, risk adjusted discount rate, certainty equivalent, CE approach. Second is going to be the statistical techniques. Yes, that is expected value, which is nothing but mean, average. Yes, standard deviation. Is there a need to tell? So much we played. Coefficient of variation, sigma by x bar into 100. Okay, yes. Over. Then comes other techniques. In that, sensitivity analysis is there, scenario is there, decision tree is there, simulation is there. In that simulation only theory is there, not even a single question is there. I will not be discussing this. Is this clear, everyone? Okay. Conventional techniques. Conventional means typical old school techniques. What are the old school techniques? Two techniques are there. First is risk adjusted discount rate. Second is certainty equivalent, CE approach. Okay, now understand what happens. SEBI is there. SEBI is my student. He became a chartered accountant. Yes, when he became a chartered accountant, he did not message only. He put in the work. Now why he should tell? He cleared. Okay. After 2 years, he sent me a message. Sir, I cleared CA, sir. Great, Davenda. Sir, 2 years back only I cleared, sir. Why you didn't tell 2 years? Sir, that I cleared now. What is it? The role of you? Okay. But sir, today I want your help, sir. What, sir? Sir, I am having 1 crore cash. Sir, full hard work I did. 1 crore cash is there. I want to invest. I told invest. No, sir. You tell, sir, where to invest. Yes. Firstly, sir, I am thinking whether to put in FD. FD risk is there. Risk is not there. I am assuming risk is 0 or Government of India bonds. Okay, risk is there, risk is not there. Yes, how much return it is giving? Say for example, 8% returns is giving. Okay, okay. Or else he is telling, sir, one more plan is there, sir. I will invest in market. Tell me, if you are investing in market means risk is there, risk is there. Tell me, I am telling, yes, you invest in market, you will get 8% return. Will you invest in market? Yes, without taking any risk, I am getting 8%. So by taking risk, why will I want 8%? If I am taking risk means I will be charging a premium. Okay, boss. I am telling, yes, market is having a base risk, 1 unit of risk. Okay. So market is giving me 15%. That means tell me, if I take 1 unit risk, how much premium I am demanding? 7% premium I am demanding. So simple, risk free, 8 any case I want. How much unit risk I am taking? 1 unit. For 1 unit, how much premium I want? 8% premium. That means I want 15%. Okay, great. He is telling, sir, one more plan I have, sir. What the? Sir, I am thinking, is we get into CA coaching. I told, great, start. Which one you are planning to start? Sir, AFM, sir. I told, great, start. But I told, it is a bit more risky. So no, people will keep spamming you. Random messages will keep coming. You should be ready for that, mentally tough for that. Okay, still have a smile, even though you are crying inside, sleep deprived. Okay, no option. If you are ready for that, take. Sir, how much risk da? Yes, if investing in market is having a risk of 1, it is 2.5 times risky. 2.5 times risky, randomly I'm telling. So now tell me, yes, you get into CA coaching. Yes, you put your 1 crore, set up infrastructure, everything. Yes, risk free, you are getting 8%. Market at 1 unit of risk, you are getting 15%. You start CA coaching, you get 8% return. Interested? Yeah. So much we are doing. You are still smiling. You get 15%. Okay, I can put in market now. At least market doesn't make negative comments. I'm putting more risk. That means I want what? More return I want. How much more? Okay, boss. Even if I don't take a risk, I should be getting 8%. How much times risk I have taken? 2.5 times risk I have taken. For one time risk, how much premium I want? 7% premium I want. So for 2.5 times risk, how much premium I want? 17.5% premium I want. With that 8% extra, that means 25.5 percentage I should be getting. Sorry, it was 7% premium. Number I missed. 7 into, oh, I took it as 2 units of risk. Random numbers I put, leave it. Okay. Or else telling, sir, AFM you are teaching now. I don't want to compete and take away your market. Thanks, da. Very grateful. Sir, but I have a secret business, sir. What secret business, da? Sir, come here. Tell me. Sir, I'm thinking of starting a super business, sir. What business? Ganja business. You know, you get high on that, you can text whatever you want. Okay, very risky. Oh, you can go in jail also for supplying. Okay, tell me, you start a ganja business. You are getting 8% return. You will start. You can be killed also, da. People will put you in jail, full life gone. 8 for 8%, you will take. Mad. 15% return, you will take. Mad. Yes or no? Yes, I'm asking. This business is how much times risky? Yes, I'm telling it is 5 times risky. Very risky. Tell me. Yes, without taking a risk free, how much I'm getting? 8%. For taking 1 unit of risk, how much premium I'm asking? 7% premium I'm asking. Here I'm taking how much times risk? 5 times risk. That means 35% premium I want. 8% extra I want. That means 43% returns I want. Is this clear? Okay. So a very simple point I am telling is, boss, simple. Yes, I am getting cash flows in future. Risk is there, risk is there. I am telling, yes, if risk is not there in the cash flow, yes, discount using a lower rate. Lower rate is sufficient. Risk is there, more risk is there. Yes, while you are discounting only, discount using a higher rate, because if you are taking more risk means you want more return to justify that. Is this clear, everyone? That is my risk adjusted discount rate. Discount rate that I am using to discount, if it is risky, means include that risk and use a higher risk adjusted discount rate. Is this clear? Okay, simple, jujibiya. Sir, how do I calculate my risk adjusted discount rate? See, here I have taken equity markets as a base. Yes, in reality, yes, I will be taking the return, yes, from my business. Suppose, yes, I am HUL. I am having 10 different businesses. Yes, from my business, on an average, assume I am getting 15% from my business. Okay, that means I am telling risk free is 8. In my business, for taking 1 unit of risk, this is the level of risk I am taking now. I am earning 15%. That means for taking 1 unit of risk, 7% premium I am doing. Suppose tomorrow HUL wants to start CA coaching business. They will see, yes, right now my risk is 1 unit. CA coaching is how much times riskier? Their own determination. They are telling it is 2 times riskier, boss. We are selling product. This is service. Who knows? Yes, if you purchase soap, on the soap they cannot put a comment. Money minded. On service on YouTube they can put a comment. Okay. Yeah. So 2 times riskier. So what to do? Yes, more premium I want. As simple as that. Business will decide. Okay. So what is going to be the formula? Yes, my risk adjusted discount rate. Yes, it is going to be my risk free rate. Risk free I want. Yes, then yes, what is going to be the risk premium for taking 1 unit of risk into how many unit of risk I am taking? That is going to be my risk index. Yes, premium is going to be nothing but, yes, the average return that the entity is earning. Yes, written by the firm. Yes, minus my risk-free rate. Yes, it is nothing but the, yes, looking similar to your CAPM equation. Yes or no? Yes, risk-free rate plus, yes, beta, which is nothing but risk index, RM minus RF. There I took market as a base. Here I am taking my business as base. End of the story. Yes, there is no need to buy heart and keep, but if you want, see, this is step 1. I will be calculating my risk adjusted discount rate. What is my risk adjusted discount rate? It is risk free rate plus risk premium. RF plus required return of the firm. Right now, firm how much it is earning minus risk free. That tells me firm how much premium it is charging into risk index. This business is how much times riskier when compared to my firm's average business. That gives me my RADR. Based on my RADR, yes, now I will discount by taking RADR to see, okay, boss, for that risk that I am taking, that much return I am getting or not. If I am getting that much return, okay, great, boss, you are having risk that you have covered, and over that you are getting extra. Yes, I will be calculating NPV. Based on that, I will be doing the calculation. Simple example, look at this. Okay, project requires an initial investment of 1 lakh rupees. 1 lakh rupees I am putting. Cash flow after tax for 5 years. 5 years, this much cash I am getting. But all these are estimate. Risk is there, boss. Anything can happen. So what I am telling, risk-free rate is 8%. If I know this is all certain, no risk only, then 8% also was sufficient for me. Yes, but yes, minimum required return for the firm. Firm right now in the business, how much it is earning? 14%. This project is 3 times riskier than company's existing business. 3 times risk is there. That means tell me how much I want. Even if I don't take risk, how much I want? 8%. Yes, company for taking risk, how much premium company is right now getting? 6% for taking 1 unit risk. Yes, my business, new business is how much times riskier? 3 times. So 6 3s are 18 plus 8. I want 26% return. So now what I will do, initial investment of 1 lakh is there at t is equal to 0 minus 1 lakh is there at 1, 2, 3, 4, 5 cash flow is there. I will discount and calculate NPV at which rate? At 26%. Even after discounting at 26%, if it is positive means, okay, boss, for the risk you are having, it is giving, start the business. Otherwise, you will tell, boss, very risky, that much return I am not getting, no need to invest. Is this clear, everyone? Okay, va, simple, jujubia. You do the calculation, story is over. NPV has a, yes, positive NP of 35,000, even after discounting at 26%. That means I am telling, okay, boss, I am earning more than 26%. I am having risk, na, risk. For that, I am charging 26%. Am I getting 26%? Getting. So start now. Take the risk. Is this clear? Calculated risk. Okay, wow. Is this clear? Continue Panlama. Okay, boss. Next one is going to be my certainty equivalent approach. Okay, giving you guys 1 minute. Okay. What is certainty equivalent approach telling? Yes. Simple thing, boss. Data should be uniform. Cash flow is risky means discount rate should also be risky. Cash flow is without any risk. You can take directly risk-free rate also. Okay, simple. Look at this. Yes, my cash flow is risky means I will take risky. Yes, risk adjusted discount rate. Yes, cash flow has absolutely no risk, zero risk. I know this I will get pakka. Then while I am discounting, should I discount at a higher rate? No. Risk-free rate also if I get is sufficient because it is certain for me. Is this clear? Okay, boss. Now look at this very simple thing. Yes, risk adjusted discount rate was telling that, boss, my cash flow that I am getting now, in that risk is there. So what I will do, I will discount at a higher rate. Cash flow is having a risk. So in my discount rate also, I will put a risk. Same, here also risk is there, here also risk is there. Certainty equivalent is ulta. Certainty equivalent is telling cash flow risk ka, risk. I will do one thing. I will see how much cash flow is certain. How much is a certain cash flow? I am telling 1,20,000 I might get. Yes, suppose I am deciding, okay, I want to start teaching or not. How much I might get? Yes, 1 year, 1,20,000 I mean. Certain, confirm, I don't know. If people put negative comments, how will I hear? But how much certainty is there? I am telling 1 lakh pakka I will get. Pakka wa? Pakka. Tell me in this 1 lakh risk is there? In this 1 lakh risk is not there. That means this 1 lakh is certain. Certain. This I am discounting. At which rate I will discount? Risk free I will discount. Risk is not there now. Simple as that. RADR is telling cash flow le risk irka, so discount rate you include risk. Certainty is telling cash flow risk irka, convert into risk free, discount at risk free. Story over. As simple as that. Look at this. Yes. By default, cash flow that I am having, that includes risk. Yes. The default discount rate that I am having, which is available in the market, is risk free rate. What is RADR telling? RADR is telling, okay boss, cash flow that you are having, it is including risk. Now do one thing, discount rate le you include your risk. Calculate RADR. Based on that you discount. Certainty equivalent is telling, boss, do one thing, cash flow le risk irka, risk. You calculate how much is risk free cash flow, how much is a certain cash flow. You calculated certain cash flow, pakka you will get. This pakka you will get. Risk is only not there. No risk only, pakka. Confirm, I got a contract, I know this much I will get only. Then this you discount using risk free rate. Based on that you take a decision. Over. Simple. GGB. Is this clear? So what is certainty equivalent telling? It is telling, boss, your cash inflow is risky. You convert it into riskless. Once your cash flow becomes riskless, now discount using risk free cash rate. Is this clear, everyone? Okay boss, look at this. Yes, expected future cash flow involves an element of risk. So we will try to eliminate the risk and calculate certain cash flows, risk free cash flows. Once I have calculated risk free cash flow, this I will discount using risk free rate only. Is this clear, everyone? Okay. So what are the steps? Step number 1, I will calculate the certain cash flow. How do I calculate the certain cash flow? It is expected cash flow into certainty equivalent factor. Suppose question is telling that next year I am expecting 1 lakh rupees cash flow. I am asking, risk is there? Risk is there. I am asking, you tell me how much percent is certain? Pakka you will get. I am telling 80% is certain. No doubt only. Pakka I will get. I will get only. That means tell me how much certain cash flow I will get? 80,000. Yes, 1 lakh is my total cash flow into how much percentage is certain? 80%. That means how much is my certain cash flow? Is this clear? Yes, expected cash flow into how much percentage is certain gives me my certain cash flow. Is this clear? Step 1, I have calculated certain cash flow. Now, the cash flow that I have calculated and kept, is it risky or riskless? Riskless cash flow. That means this when I am discounting, at which rate I will discount? Risk free rate I will discount. Over. Story over. As simple as that. Look at this. Project requires an initial investment of 1 lakh. Risk free is 6%. Yes, 2 years, how many years? 5 years project is running. Every year, how much cash flow I might get? Yes, first year 40,000 cash flow I might get. Tell me, is it certain? Risk is there, boss. I'm asking how much percent is certain? 0.9, 90% is certain. That means what is my certain cash flow or risk free cash flow? 36,000. Second yearly, how much I might get? 50,000 I might get, boss. But risk is there, boss. How much percent you can tell with the short you will get? 85%. This how we'll calculate. Business will determine based on their data. Yes, that means how much I will be getting? 42.5. Yes, similarly for every year, 55 into 0.8, 78 into 0.7, 45 into 0.6, I will calculate. Step 1, I will calculate certain cash flow. Okay, boss, certain cash flow I got. Now, once I got a certain cash flow at which rate? Riskless cash flow, at which rate I will discount? Risk-free rate I will discount. I will arrive at NPV. If NPV is positive, means accept, otherwise reject. Is this clear, everyone? Okay, a simple summary of the two approaches. Look at this, look at this, look at this. Two things are there. Firstly, cash flow is there. In cash flow, risk is there. Secondly, discount rate is there. What is risk adjusted discount rate telling? Risk adjusted discount rate is telling that, boss, in the cash flow, risk is there. So to compensate for that, when you are discounting, take which discount rate? Risk adjusted discount rate. Discount at a higher rate. Okay. How do I calculate risk adjusted discount rate? It is risk free plus, yes, for 1 unit of risk, how much premium I am asking? Like that, how many units of risk I am taking? Okay. Certainty equivalent approach is telling, boss, cash flow le risk irka, risk irka. You do one thing, you calculate certain cash flow. How much riskless you will get? That is your cash flow into certainty equivalent factor. Yes, you calculated certain cash flow. This is certain. Pakka. Risk irka? Then discount at risk free. Calculate NPV. Positive means accept, negative means reject. Story over. Is this clear, everyone? Okay. Now, one extra adjustment, yes, which was there in one of the questions. Don't worry, we'll get into the questions. Two projects are there. Project A is there, project B is there. They have given every year how much cash flow I am getting, what is the certainty equivalent. If I multiply, I will get certain cash flow. Similarly, based on that, for two projects also I will do. I will calculate, take a decision based on certainty equivalent approach. Now, question is asking you again, just as a small comment. Yes, if instead of using certainty equivalent, if I am using RADR to discount my cash flows, yes, which project will be using a higher RADR? Tell me, more risk means more discount rate, less risk means less discount rate. Okay. Now look at this. Project A is there. I am telling project A la 1 lakh I am expecting. I am asking, pakka wa? Pakka not. Yes, I am asking how much percent is certain? 90% is certain. That means how much percent risk is there? 10% risk is there. Yes. Project B, assume 1 lakh only I am getting. I am asking how much percent is certain? 80% is certain. That means how much percent risk is there? 20%. Tell me, project A, how much percent risk is there? 10%. Project B, how much percent risk is there? 20%. Tell me where risk is more? Project B. That means where I will be asking a higher RADR? Project B. Yes, this I can do by calculating my risk, or else based on certainty equivalent only I can tell. Tell me, in project A, 90% is certain. Project B, 80% only is certain. Tell me, yes, where risk is more? B. Only 80% is certain here. There 90% is certain. Na? That means tell me where I will be using a higher rate. B, I will be using a higher rate. Is this clear? Yes. If my certainty equivalent is less, means their certainty is less. That means risk is more. That means there I will be using a higher RATR. Is this clear, everyone? Okay, wa. Taka questions we will see. Okay, based on this, look at the students. Okay, yes, simple GGB questions are there. Look at this, everyone. Okay, because questions are there, we are discussing. Okay, look at this. An enterprise is investing 100 lakh in a project. Okay, great. Yesterday only I have uploaded on Telegram. Okay, risk-free rate of return is 7%. Risk-free. Yes, risk premium expected by management is 7%. Management is telling 1 unit risk if I take 7% extra, you want, boss. Life of project is 5 years. Following cash flows are given 1, 2, 3, 4, 5. Calculate NPV of the project based on risk-free rate. That means first I will calculate NPV by discounting at which rate? Risk-free rate, and also based on risk-adjusted discount rate. So step 1, yes, I will calculate NPV at which rate I will discount? Risk-free rate, which is going to be 7%. I know how to discount. Yes or no? Second, I will again calculate NPV at which rate? Risk-adjusted discount rate. Now tell me, how much is my risk-free rate? 7%. Now tell me how much premium management is expecting? 7%. For this project, 7%. They would have seen how much times risk, all that calculation they would have done. That means tell me how much return they want for this? 14%. So again I will calculate NPV, but this time I will discount at which rate? 14% I will calculate. Based on that I will calculate. They just asked me to calculate, finish it off. Difficult? Very difficult. Yes. Question number 2. Determine the risk-adjusted NPV. Risk-adjusted. Okay, boss. Net cash outlays. Cash outlays. That means it is initial cash outflow. Okay, boss. Project life. For how many years I am getting? Okay, great. Annual cash inflow. 70,000. That means only for X I will show. Look at this. 0 is there. 1, 2, 3, 4, 5. Tell me at T is equal to 0. How much cash outflow is there? Cash outflow. 2.1 lakh is there. Cash inflow every year how much I am getting? 70, 70, 70, 70, 70. Coefficient of variation is 1.2. Why on earth they have given coefficient of variation? God knows. We don't know. Let us read. What work is there for us? Company selects risk-adjusted discount rate on the basis of coefficient of variation. Based on coefficient of variation, we are selecting risk-adjusted discount rate. Okay, now what it is? Company selects risk-adjusted discount rate on the basis of coefficient of variation. Yes, if coefficient of variation is 0, yes, my risk-adjusted rate of return, risk-adjusted discount rate is 10%. 10% is sufficient. Coefficient of variation is 0.4. Some risk is there. Yes, that means I want some more, 12%. If it is 0.8 means I want 14%. If it is 1.2 means I want 16%. So on and so forth is given. and present value factor of 1 to 5 years is also given. Present value annuity factor is also given. If a question is giving you the figures, means we will be using that figure only. I will not put my calculator and show my knowledge. Is this clear? I say is telling dog has 2 legs, I will assume dog has 2 legs. Don't go and check is this correct or not, also don't check. Okay, yes. Now tell me if my coefficient of variation is 1.2, how much return I want? 16% I want. That means this I will discount at which rate? 16% I will discount and see. Okay, if it is a 0.8 means how much I want? 0.8 means 14 I want. So I will discount at 1 point, so 14% and see. Yes, don't calculate the present value factors, they are given there. Okay, if it is 0.4 means how much I want? 12%, I will discount at 12% and finish, over, GGB. Okay, yes. Then comes question number 3. 3 projects are there, 1, 2, 3. Following information is available. Project 1, project 2, project 1 project. We will see. Cost, that means initially how much amount I'm putting. Okay, great, boss. Cash inflow for first year, second year, third year, fourth year. Risk index, how much times risk I'm taking when compared to the business. Okay. Minimum required rate of return on the firm. Business level, for the average risk we are taking 15% we want. Tax rate is 40%, risk free rate is 10%. Find out the risk adjusted discount rate for these projects. Okay, firstly, risk adjusted discount rate. I am telling, even if I don't take any risk, how much risk free I am getting, was 10% I am getting. But when I am investing in my business, na, yes, on an average, how much I am getting? 15%. That means how much premium I am getting? 5% premium for taking the base risk. This project is how much times risky? 1.8 times. That means here how much premium I want? 9% plus 10. That means how much I want? 19% I want. Is this clear, everyone? So now, yes, initial cost is there. Yes, at t is equal to 0, given 15 lakh. Year 1, 2, 3, 4 is there cash inflow. Yes, I will discount at 19%. I will calculate NPV. Second year also I will do accordingly. I will do. Third year also I will do. Sir, tax rate is given na, sir. What is the relevance? No relevance. Because here what they have given is inflow. That means it is after doing all tax adjustment. I need not put my extra knowledge there. Is this clear, everyone? Yes, it is going to be, yes, absolutely no relevance. Chumma they have put. Is this clear, everyone? Okay. Based on RADR, which project is the best? Yes, wherever NPV is highest, we will be selecting that. Is this clear, everyone? Okay, question is over. Next, I am having certainty equivalent. Yes, very difficult question. Yes, if you think you are mentally strong, only then read. Otherwise, yes, this is not for the mentally weak people. Okay, yes, if the investment proposal costs 45 lakh, okay, risk free is 5%. Calculate NPV under certainty equivalent technique. Tell me expected cash flow. First year, 10 lakh I am expecting. Pakka wa? How much percent is pakka? 90%. That means what is my certain cash flow? Very difficult, very difficult. Tuck, 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 tuck. How much? 10 lakh into 0.9, 9 lakh. Similarly, for 4 years you will do. Yes, this is a certain risk-less cash flow. At which rate I will discount? Risk-free rate I will discount. Story over. Is this clear, everyone? Okay, next thing. Textile manufacturing company is considering one of the 2 mutual exclusive proposals. Sebi, 2 proposals are there. Can you select both together? Don't do like that. Life will become hell. Only one you can select. Question da. What you are thinking? One only we can select. M is there, N is there. Meenakshi, Nirmala. Project. What does SEBI? Yes. Which require cash outlay of 8.5 lakh and 8 lakh 25,000. Okay, that much cash is needed. The stat. Okay. Certainty equivalent approach is used to incorporate the risk. Current yield on government bond, risk free, is 6%. It is used as risk free rate. Expected net cash flow and certainty equivalent is as follows. Okay. Year 1 to 3. How much cash flow is there? Into certainty equivalent, you will get a certain cash flows. Yes, that you will discount at which rate? 6% risk free rate. You will calculate NPV for this also, for this also. Yes, present value factors they have given. I need not worry about that. Which project should be accepted? Wherever NPV is high, that I will accept. Second, if risk adjusted discount rate method is used, which project will be appraised with a higher rate? I'm telling I am not using certainty equivalent. I want to discount using risk adjusted. Tell me in which project risk is more. Okay, look at this, students. Yes, for 3 years certainty is given. Yes, I will calculate on an average how much percent is certain. First year is 80% certain, second year is 70% certain, third year is 50% certain. So take an average and tell me what is the percentage certainty. How much? Point 66, 667. Yes. For the second project, what is the percentage? Yes, average certainty 0.8. Tell me, in project M, whatever cash flow I saw, in that only 66% is certain. That means 34% risk is there. In the second proposal, 80% is certain, only 20% risk is there. Tell me where risk is less. Here risk is less, more certainty is there. Where risk is more, here risk is more. That means where I will use a higher rate, M I will use a higher rate. That is going to be my, yes, discount. I can calculate average certainty equivalent, or based on total also I can do, because years are same. Yes, where, yes, certainty equivalent is lower, that means lower certainty, that means higher risk, that means higher RADR. Is this going to be clear? Over. 5 questions we did. What was there? Nothing was there. Is this clear, everyone? Yes, giving you guys 1 minute again to let the things settle in. We will continue our discussion. Yes, then we are coming to part 2, which is going to be statistical techniques. Over. Yes, everyone. So part 2, let us do it quickly. Part 2 is going to be statistical techniques. So the entire statistical techniques we have bifurcated into 2 different parts. Part 1, yes, we are going to, it is basics. Part 2 is going to be advanced. It's both the things we already know. What is statistical techniques? Yes, calculation of expected NPV, expected return from the project, X bar. Calculation of risk. What is risk? Variance. Take a square root of that. Standard deviation. Yes, you want to compare, means you can also calculate coefficient of variation, sigma by X bar. Everything long ago. No, 2 days back I told. So I'm not going to tell again. Is this clear, everyone? Okay. So look at this. Here I have written everything again. Yes, to explain. No need, absolutely fine. Now just let us write down the formulas. Yes, expected return. Yes, X bar. Yes, based on past data, based on future data. Tell me, based on past data, what is it? It is the average summation X divided by N. Future means summation P into X. Okay, risk. What is the risk? What is risk? Risk is variance, past data, X minus X bar, deviation, take a square, summation, I want average divided by N. Boss, future data, boss, sigma P into X minus X bar the whole square. Yes, standard deviation is square root of variance. Okay, great. Coefficient of variation, it is sigma divided by X bar. If you want, you can do into 100. Is this clear, everyone? Okay, perfect. Past data, future data, perfect. Now understand here what I am doing. Yes, point number 1. For us in this chapter, this is not relevant. Why, sir, not relevant, sir? So much time we spent, sir. Business decision. Should I start business? Should I not start business? Tell me, business I started? No, I am standing here. Should I start? Should I not start? Back I can see and take any decision. No, boss, business I am yet to start. That means where things are happening. Future. That means I can only estimate. This will not come. Only future thing will come. That means here things are going to be sigma px as well as sigma x minus x bar whole square into p. Yes, that is going to be my variance. Okay, point number 1. Point number 2. Sir, in portfolio management, I was calculating return as a percentage. Here, when I am taking decision, different period cash flow is there. Yes, every decision I am going to take based on NPV. Yes, that means here when I am telling expected return, it is the expected NPV from the project. I am telling, boss, simple, 100 rupees I have put today. At the end of first year, cash inflow that I might be getting can be 120 also, can be 150 also, can be 180 also. Yes, this probability is 30%, 50%, 20%, whatever it is. So I will tell, if this happens, how much is my NPV? Yes, if this happens, how much is my NPV? If this happens, how much is my NPV? Okay, NPV will be given for me in the question. Yes, NPV is going to be my X. Yes, you will put the probability. P into X you will do. Yes, X minus X bar you will do. Yes, P into X minus X bar the whole square you will do. This is going to be expected NPV. This is going to be variance. Take a square root of that, standard deviation. Story over. Is this clear, everyone? Yes, look at this. Yes, X I will be taking NPV. Yes, probability P into X, this gives me the expected NPV, X bar only. Yes, I say we'll keep using the term expected NPV, such a big term it will write in the formula also. 3 lines that formula will only go. Yes, summation of probability into expected NPV in each of the situation, all those things they'll write. What is that? This much only. Yes, X minus X bar, P into X minus X bar whole square, this is going to be variance. Take a square root of that, you will be getting standard deviation. Yes, you've calculated that. Yes, which project should be selected? Now, different ways. Suppose I am telling I have to select based on returns only. That is, I will be taking based on, yes, NPV. Wherever my NPV is highest, expected NPV, X bar is highest, that I will select. I am telling based on risk, I don't want risk only. Wherever standard deviation is lowest, that I will expect. I am telling I want an overall picture by incorporating return also, risk also. I will be taking coefficient of variation, CV, sigma divided by X bar into 100. Yes, what does this tell? Divided by X bar. For 1 unit of return, always base, for 1 unit of return, how much risk I am taking? Tell me, to earn 1 unit of return, I want to take more risk or less risk? Less risk. Wherever my CV is lowest, that I will be accepting. Is this clear, everyone? Okay, coefficient of variation also I have told. Yes, example is there. Yes, if I start a business, this all NPV I can be having. This is the probability of that happening. Okay, great, boss. Based on that, do the calculation. Yes, X is there, P is there. P into X, I will be getting my X bar. This is the expected NPV. My NPV can be 200 also, 800 also, 400 also, 120 also, 600 also. What is expected? 442 I will be getting. In this risk boss, it can be 200 also, it can be 800 also, it can be 120 also, it can be 600 also. How much is risk? Okay, boss, I am expecting 442. I got 200 only. How much less I got? 242 less I got. I got 800. How much more I got? 358. Similarly, I will be doing. Yes, then I will be squaring my deviation into probability I will be doing. That means how much risk I am having? 60,076. This is going to be in terms of a square. Yes, I want it to be in interpretable terms. Yes, if this is going to be lakhs, means this is going to be lakh square. Okay, it is going to be in square. I cannot interpret. Yes, so I want to, yes, interpret. So I will be doing a standard deviation sigma. Yes, take a square root of that. That means look at this expected NPV from the project. If I start the project, expected NPV is 442. Yes, what is the risk? What is the standard deviation? How much up or down it can happen? 245.1 up or down, it may go from the expectation. Okay, boss, great. CV also I have done. Yes, this is over. Based on this, questions are there. Questions we'll see. I hope for statistical basic, this much is sufficient. 2 days back only I spent 1.5 hours. Okay, so yes, there is no point in again explaining. But in this basics also questions are there. Good amount of questions are there. Okay. Are we ready to do the questions? Okay. Okay. Possible net cash flow of project A and B at the end of first year. How much cash I will get? And their probabilities are given. Okay, boss, great. Discount rate is 10%. How much we want? 10% we want. For both the project, initial investment is 10,000 rupees. For both of them, I want 10,000 rupees. Okay, boss, great. Yes, what all cash flow can be there? What is going to be the probability? Yes, state which project is preferable. Calculate the expected NPV. What they want? NPV, just NPV is sufficient. Okay, boss, great. Now look at this, students. Project A I will take, project A I will take. Tell me at t is equal to 0, t is equal to 1. At t is equal to 0, how much I put? 10,000 I put cash outflow. At t is equal to 1 for first year, what all I can get? 8,000 also I can get, 10,000 also I can get, 12,000 also I can get, 14,000 also I can get, 16,000 also I can get. That means what is the expected cash flow I am getting? 8,000 into 0.1, 10,000 into 0.2, 12,000 into 0.4, 14,000 into 0.2, 16,000 into 0.1. Tell me, expected cash flow for first year. Say be fast da. 12,000. Okay. Yes, all these things can happen, but expectation is how much? Yes, 12,000. This I am getting when? First year. Yes, what is question asking? Calculate the expected net present value, NPV. Yes or no? Yes, 12,000. Yes, it is for first year. I want to bring it to 0th year. Yes, what is the discount rate? 10% divided by 1.1. How much you are getting? Whatever it is, minus 10,000 cash outflow. That means what is going to be my NPV? 90, whatever. Same thing I will do for project B. Over. Sir, risk, sir. They did not ask why I should do. Next question we'll see, na? Simple. Is this clear, everyone? Okay. If they ask risk, yes, cash flow is given. Expected is given. Take x minus x bar the whole square into P. Do that. Finish off the story. Is this clear, everyone? Okay, great. The probability for net cash flow for the 3 years of a project is as follows. 3 years, what all cash flow I can get? Look at this. For first year, na, I can get 2,000 also, 4,000 also, 6,000 also, 8,000 also. Its probability is given. For second year, this all I can get, probability is given. For third year, this all I can get, probability is given. Calculate the expected net present value of project. They are asking expected net present value, NPV. I should understand what I want. NPV I want. How will I get NPV? Today how much I am putting, every year how much I am getting. Get to present value over GGB. 3 years is there. Yes. If the initial investment is 10,000, tell me at 0 how much I am paying? 10,000. First year, second year, third year. First year, what all can be? Sir, 2,000 also I can get, 4,000 also I can get, 6 also I can get, 8 also I can get. This into probability. If I do, will I be getting the expected cash flow? Ah, boss. Second year also, can I get expected cash flow? Third year also, can I get expected cash flow? What I will do? Bring to 0, calculate NPV, over, story over, go home, sleep. Oh, do. Next question. Okay. Yes, third question. Here they have asked, calculate variance and standard deviation of project A and B on the basis of following information. Here, did they ask? Yes, average, expectation. Average, did they ask? No, they did not ask. That means, will I calculate? No, I will not calculate. I will calculate. Without X bar, how will you calculate risk? Okay. Now, simple. Yes, what all can happen? Cash flow can be 8 also, 10 also, 12 also, 14 also, 16 also. Probability is given. Yes or no? What is there in life to do? Yes, for you, X is given. Yes or no? What all cash flow can be there? 8 also, 10 also, 12 also, 14 also, 16 also. This is for project A. Probability is given. You will do P into X. You will get X bar, expected cash flow. They have given cash flow. That means it is expected cash flow. I don't want anything I can do. X bar only it is. Okay. Then I will do X minus X bar. Yes, X minus X bar the whole square into P. This is going to be variance. Take a square root. It is going to be standard deviation. I got for A. Same thing I will do for B. Story over. Then comes calculate coefficient of variation. What are they asking? Coefficient of variation. Okay. Sigma by X bar. Tell me. Yes, for every, yes, cash flow they have given. X is given. Probability is given. Multiply P into X. X minus X bar. P into X minus X bar the whole square. This is going to be your variance, square root, standard deviation. Here P into X you are having X bar. Sigma by X bar is going to be coefficient of variation. For both the projects there we can calculate. They have only asked to calculate. They did not ask interpretation. I will not interpret. If they ask, I can do. Where CV is less, that is good. Over. Is this clear, everyone? This much only. Yes. Then comes question number 18. Online students, I hope the discussion is fine. Speed is okay. Okay. Cyber company is considering 2 mutually exclusive projects. Only one of the 2 we can accept. Both we cannot accept together. Sebi. Okay. Investment outlay for both the project is 5 lakh. Both project 5 lakh. I should put at the start. Okay, boss. Each is expected to have a life of 5 years. 5 years. They are giving. Okay, great. Under 3 possible situations, their annual cash flow and probability is as under. Okay. Yes. Project A, project B. Yes, what all possibility is there? Project A how much? Project B how much? Cost of capital is 7%. Which project should be accepted? Explain with workings. Okay, boss. Here they have not told us. Okay. Yes. Whether I should be taking a decision based on return or based on risk. So what I'll do? Both I'll calculate and keep. Tell me return from the project. Yes, it is nothing but the NPV of the project. Is this clear? Yes, aram se. Okay. Yes, now look at this. I am only doing for project A. Project A. How much years is my life? 5 years is my life. Initially, how much I am putting? 5 lakh I am putting. T is equal to 0. First year, second year, third year, fourth year, fifth year. Yes, for project A, what all I can get? Annual cash flow. What all I can get? 6 lakh also I can get. 4 lakh also I can get. 2 lakh also I can get. Yes. So what is the expected cash flow for every year? 6 lakh into 0.3, 4 lakh into 0.4, 2 lakh into 0.3. How much it is? 4 lakhs. So I know expected for every year it is same only. Bring everything to present value. You will get NPV over NPV I calculated. Then comes risk calculation. For risk calculation, yes, cash flows are given. Now here based on cash flows I will be doing the calculation. Look at this. Yes, every year's cash flow is given for me. Yes or no? Yes. What all cash flow could be there? 6 lakh also, 4 lakh also, 2 lakh also. 6 lakh also, 4 lakh also, 2 lakh also. What is the probability which is given to me? 0.3, 0.4, 0.3. Okay. P into X. If I do, I will get the expected cash flow. Every year, what is going to be the expected cash flow? Then I will do X minus X bar the whole square into P. This is going to be the variance in cash flow. Yes, I will take a square root. I will get the standard deviation of cash flow. Understand, I have taken cash flow. So everything is going to be in terms of cash flow. Why I am stressing on these terms, we will understand in advanced. Okay. Here the solution that IC has done is actually wrong. Because they have done it that way, okay, fine. Actually, I should be calculating NPV in each possible situations. Based on that NPV, yes, I should be calculating the risk of the NPV. How do I do that? Afterwards, we'll see. Maja will come. Samma வேற level இருக்கு. Perfectly independent, perfectly dependent, moderately dependent. Set. Okay. For now, this much is sufficient. Yes, so long as things are jujube, let us also keep it jujube. If things become advanced, we will get some maja. Okay. Yes, now look at this, students. Company is considering project X as well as Y with the following information. Expected NPV is given. How much I am going to get? Standard deviation is given. Which project you will recommend based on the above data? Tell me. Yes, if I have to take a decision based on return means, where return is more, X or Y? Why it is more? I am telling no boss, risk based on risk I want to take a decision where risk is less, X is less. So based on return means Y, based on risk means X. Yes, whether your opinion will change if you use coefficient of variation. We should see coefficient of variation is what? Sigma by X bar. So you do sigma by X bar. You calculate coefficient of variation, whichever is less. Yes, that you will be doing. Yes, tell me which measure is more appropriate and why. Tell me, taking a decision based on just NPV is good or just standard deviation is good or coefficient of variation is good. Coefficient of variation is good, boss, because both the things together it is bringing. Is this clear, everyone? Over. This is also over. Now, how many more questions are there? 20 is there, 21 is there. 2 questions are there. Over. With that, this will also be over. I will give you guys just 2-3 minutes to let the thing settle in. Then we will go to next concept. Maja is there. Sensitivity analysis. Okay. Online students, I hope things are fine. Okay. Next question. Great. KLM Limited is considering taking up one of the two project. One of the two we want. Okay. So both projects are having same life. Require an equal investment of 80 lakh each. In that also 80 lakh, in this also 80 lakh. Okay, great. Both are estimated to have almost same yield. As company is new to this type of business, cash flow arising from the project cannot be estimated with certainty. Okay, I can only think how much it can be. An attempt was therefore made to use a probability to analyze the pattern of cash flow from the other projects during first year of operation. The pattern is likely to continue during the life of the project. Results are as follows. Full time pass, nothing was needed. Chumma, yes, 80 lakh I am putting. Yes, same life we are having. Okay, great. Okay, tell me project K. What is the expected cash flow? It can be 11 also, 13 also, 15 also, 17 also, 19 also. Probability is given. Similarly for S it is given. Okay. What are they asking? Yes, first calculate variance, standard deviation, coefficient of variance for both the projects. Tell which project is riskier. Okay, great. Now here for me cash flow is given. So everything I will do based on cash flow. Did they ask me to calculate expected NPV? No, they did not ask. So will I do? Why I will do? Chumma cash flow is there. Based on that I will finish it off. So look at this for project K I will do. Tell me, yes, first I will put X, which is the cash flow. Then I will put the probability how much? 11, 13, 15, 17, 19, 0.1, 0.2, 0.4, 0.2, 0.1. Yes, I will multiply P into X. I will get X bar. What is this X bar? Get a feel. What did I take as X? Cash flow. This is the expected cash flow. How much cash I will get on an average? Risk boss. X minus X bar. Yes, P into X minus X bar the whole square. Take a variance. Yes, take a standard deviation. This is what? This is the standard deviation of cash flow. Okay, now you will calculate coefficient of variation, sigma by X bar. Data should be uniform. If you are taking standard deviation of cash flow, your expected return should be also of cash flow. In denominator, you cannot be putting expected NPV and doing the calculation. If so, you should be taking, yes, risk of NPV. Risk of NPV I have not told here. Is this clear, everyone? Finish off the question. Story is over. Which of the two project is riskier? Yes, you calculate variance, standard deviation, coefficient of variation, variance for this anyways I want X bar. Yes, which is riskier? Wherever standard deviation is more, that is going to be riskier. Okay, boss, great. Question number 21. Let us see. Shivam Limited is considering two mutually exclusive proposals. Projects are there. One of the two I will be doing. Project A cost 36,000, B cost 30,000. Yes, for A I am putting 36,000, for B I am putting 30,000. Okay, you have been given below the NPV probability distribution for each project. Yes, what is given, what is given, what is given? This is the NPV. That means different year what all cash inflow could be there. Yes, how much discount rate I want? Yes, initial cash flow is how much? Discount. They did that and they told after doing all this, yes, I am telling, yes, ultimately I can earn 15,000 also, 20% chance is there, 12,000 also, 30%, 6,000 also, 3,000 also. Calculate the expected NPV, calculate the risk attached to the project, standard deviation. Yes, now tell me what is given for me. X which is given for me. What is given? NPV is given. I will put whatever is the value. I will multiply by probability P into X. I will get X bar. What is this X bar? Expected NPV. Then I will do X minus X bar. Then I will do P into X minus X bar the whole square. I will get variance. I will take a standard deviation. I will get standard deviation. This is standard deviation of what? Standard deviation of NPV, because I have taken NPV. Okay, boss. Great, boss. Yes, I have calculated everything. Yes, they are asking calculate profitability index of each project. Now, how do I calculate the profitability index? This is good. Maja. Yes, tell me firstly, what is profitability index? Formula. Present value of cash inflow divided by present value of cash outflow. Okay, great, boss. Fine. Okay, for me, whether cash inflow data is separately given? No, sir. What is given? NPV is given. Just for project A, let me try calculating the expected NPV. Tell me, my NPV can be 15,000 also. How much chance is there? 20% into 0.2. It can be 12,000 also. How much chance is there? 30% into 0.3. 6,000 also. How much chance is there? 30%. It can be 3,000 also. How much chance is there? 20%. Tell me what is going to be the expected NPV? 9,000 is going to be my expected NPV. Step 1, I calculated the expected NPV. Now tell me, what do I want? I want profitability index, which is present value of cash inflow divided by present value of cash outflow. For project A, present value of cash outflow. Initial investment is given, given 36. Cash inflow is given, not given. But sir, NPV formula I know, sir. It is present value of cash inflow minus present value of cash outflow. Tell me what is my expected NPV? 9,000. This I don't know. Yes, present value of cash outflow is how much? 36,000. That means what is the value of X? Take it to the other side. 36 plus 9, 45,000. Yes, step 2 I will calculate present value of cash inflows, 45,000. Now I got, okay boss, 45,000 divided by 36,000, 1.25. Is this clear? NPV is given. I want present value of cash inflow. Just give yourself time to understand that. Okay, yes, the most beautiful part is giving the time to understand the question. Once you understand, calculation will go. See, once you have done 5-6 questions, x p p, yes, x minus x bar p into x minus x bar whole square variance standard, then you will do. Where you should be spending time. Yes, practice you should do, otherwise you will commit calculation mistake. To understand what exactly is happening in the question. We are in finals. Yes, you cannot be expecting that, okay, one question you did. Yes, everywhere same thing, only numbers will change. No, everywhere something or the other they will give. Okay, yes, we should understand what exactly is the story that they are trying to tell, as simple as that. Yes, statistical techniques basics is also over. Okay, great, online students. Okay, yes, now the time is 12:27. I will give you guys I did not order food also. Okay, fine. I will give you guys a 7-minute break. Okay, 12:35 we will come back and we will start with the beautiful Maja topic, sensitivity analysis. Crazy is there. Okay, we will do that. We will go for break. Sorry, we will go for lunch break. Okay, or else we'll see after that some 2 jujube things are there, scenario analysis, decision tree. If possible, till there we'll finish off and we'll go for break, because the next 2 will be taking 10 minutes only, maximum 10 minutes. This will take a good amount of time. Post lunch we will start with statistical techniques first. Yes, that is done means concept 1 is over, then comes replacement decisions. Yes, if that is done, then miscellaneous nothing is there. Okay, yes, 12:35 will continue our discussion. Baby, you are having vehicle, huh? Can you do me a favor? From a nearby shop, can you get me shoes? Okay. Get me a mosquito. Mosquito gloves. Okay. Poquito. Yes, students, so we will continue our discussion in 3-4 more minutes. Students have gone for break. What is your name? Pavitra. Your name is what? Bahubali, what? Oh, oh. Okay. Two, 3 more minutes, students. Okay. I have asked one of my students to get me a juice. We are discussing Ranganna stories, right? So we want juice. Okay, I did not have breakfast, that's all. That one book is fully AFM, like the two books are there with you. Fully AFM study material is one book, two books. One book only. Okay, okay. Okay. We'll start. I don't know when they'll come. What Pavitra? You should bring all of them to class, na? Your name is Pavitra, na? So you are only sitting in first bench. See, all of them are outside. What is this, Pavitra? Okay. Yes, everyone. So let us continue our discussion. We are going to part 3. Okay. Yes. So two main. Yes, we have bifurcated all our techniques into 3 main headings. First one is going to be my conventional techniques. In that I have discussed risk adjusted discount rate as well as certainty equivalent. Then I told statistical. Okay, now we are discussing all other techniques into one main heading. In that, sensitivity is there, scenario is there, decision tree is there, simulation is there. Simulation, for namesake, they have written 2 lines. Example is also not there, question is also not there. I will not be touching. Decision tree, 1 question is there. Scenario, 1 question is there. Sensitivity. So we will start with sensitivity analysis. Okay. Okay, great. So understand what exactly on earth sensitivity analysis is trying to tell. Yes, capital budgeting decision. Should I invest or not? Based on NPV, I am taking a decision. Yes, boss, based on NPV, I am taking a decision. But in order to calculate NPV, I have taken many factors. How much investment I want, how much cash I am getting, what will be selling price, what will be variable cost, what will be tax rate, what will be terminal value. All these are pakkawa, these are uncertain. These are uncertain. They can change. If they can change means my NPV will go. Yes, now I am having a risk. Now assume, yes, I am thinking, yes, from every year I am getting 1 lakh rupees. Okay, assume in reality I got 1,50,000 every year. Happy or sad? Happy. Tension is there? No. When is the tension there? I thought 1 lakh cash every year I will get, but in reality I got 50,000 cash only. Is this clear? Yes, the fear is of adverse movement in my expected factor. If it moves positively, I am happy only. I thought 5 years project will run. Project ran for 10 years. Happy only. More year I am getting cash. It finished off in 2 years only. That is risk. Is this clear, everyone? Yes. So there is a risk of adverse movement in the factor. Yes. If it moves adversely, damar may happen. So here in sensitivity analysis, what we are doing is we analyze the impact of change in every factor. Yes. If every factor, yes, one by one changes, what happens to my NPV? That is how NPV will change based on the adverse change in the factor. Yes. Firstly, here I will be taking impact of only one factor at a time. Multiple factors together I will not be taking. Only one factor at a time. If it changes adversely, what happens I will be showing. And here I will be considering adverse movement only. Is this clear, everyone? Okay. Yes. Finally, we got our juice. Just give me a minute. I'll just quickly have it. You guys don't feel bad. Sugar de putta. What does so much is there not getting over only? Great. So let us get into the game. Let us understand with the help of a story what exactly on earth is sensitivity analysis. Okay, 3 people are there. One businessman, one person is doing job, one person is doing articleship. The richest person in the world doing articleship. Sir, no. Okay. So 3 people is there. Yes. Assume. Yes. Pavitra na? Yes. Pavitra started a business. Okay. Yes. Assume. What is your name? Sushmita. Simple name da. Whose name? Whose? Jaya. Jaga. That day one simple name was there. Santosh, where is Santosh? Santosh. Santosh went into job. Sebi is doing articleship. Okay, 3 people are there. Okay, boss, great. Now we are asking these 3 people. Yes, in a month, how much you are earning? Pavitra is doing business. She is telling 1 month around 1.5 lakh I will earn. Okay, great. Santosh is into job. He became CA. He is into job. I'm asking 1 month how much are you earning? He is saying around 1 lakh I'm earning. Okay, great. Sebi, articleship. How much are you earning? Stat 8,000 rupees. Higher end. Okay, correct. Okay, you're asking, okay, how much is monthly expenses? Pavitra business, spending lavishly. 1 lakh per month she is spending. That means every month how much she is saving? 50,000 still she is saving. Okay, great. Yes, Santosh is in a job. 1 lakh he is earning. That means, okay, how much he is spending? Around 80,000 he is spending. That means how much he is saving? 20,000 he is saving. Okay, Sebi is doing articleship. 8,000 he is spending. Every rupee he is calculating and spending. In 7,000 he is finishing it off. 1,000 rupees still he is saving. That's the beauty of life. See, one day you will all start earning. Yes, one day small things will not start to matter. That day you will look back and you will think, in 7,000 we were surviving. Na? I still look back. I did 3 years of articleship in Bangalore at 7,200 rupees stipend. I was not asking money from home. Every rupee I had account. Yes, this month 400 rupees petrol. Based on that, I will decide how much I should go in bike. Okay, I was traveling 9 kilometers because at 1,500 rupees, yes, a Muslim community hostel was there. 1,500 rupees. So, that's a beauty. Now you look back, okay, you spend, yes, 5,000, 10,000 gone. You will not realize much. But there, when every rupee is going to matter, you look back, you will feel crazy. Yeah, so get to that level. Okay, fine. Now, so 3 people are there. You are doing business, 1.5 lakh is the income, 1 lakh is the cost, 50,000 is the saving. Job 1 lakh you are getting, 80,000 you are spending, 20,000 is saving. Article 8,000 you are getting, 7,000 you are saving, spending 1,000 you are getting. Okay, fine. Now, boss, risk is there. Risk is there, boss. Tell, this is the expected income. Income in 1 month can be more also, it can be less also. If it is more, will I sit and cry? No. When will you cry? If it is less. That means what is the risk? Risk of reduction in income. Okay, boss. Expense, this is expected. It can be more also, it can be less also. You spend less in a month, will you feel bad? You will sit and cry, oh my God, what happened? No. What is risk? More you are spending. Okay, boss. I defined my risk. Fluctuation can be there. Yes, if my income reduces, that is risk. If my expenses goes up, that is risk. Okay, boss. Now, I will be evaluating 1 factor at a time. Now, altogether 2 factors are there. Income is there, expense is there. 1 factor at a time I will take. I am telling, assume my expenses increased by 10%. 10% random percentage I took. Tell me, expenses decreased. Will I feel bad? No. If expenses increase, I will feel bad. I am telling, if my expenses will increase by 10%, what will be the hit? What will be the impact for each of these people? Okay, great, boss. Tell me, only 1 factor I am changing. Only expense I am changing. Income will I touch? I will not touch. Only 1 factor at a time I will touch. Only 1 girlfriend at a time. Sebi. No multiple people at a time. 1 person, 1 time only. Okay. After breakup, next person. 1 factor at a time. Once you have calculated sensitivity, then go to next factor. The sensitivity analysis I am telling the. Okay. So I am not going to touch income. Income will be same only. Only expense I am telling it will increase by 10%. Tell me, businessmen's expected expense was 1 lakh rupees. I am telling, if it increases by 10%, what will happen? It might become 1,10,000. Okay, that means how much will be the revised savings? 50,000 will be the revised savings. Similarly, job person, Santosh was there, 80,000 was his expense. If it increased by 10%, how much it will become? 88,000. That means what will be his savings? 12,000 only. Sebi is there, articleship, 7,000 is spending. If it increases by 10%, it becomes 7,700. Savings will be what? 300. Okay, fine. Now tell me, originally for the businessman, how much savings would be there? I thought 150 would be there, 100 I will spend, 50,000 savings will be there, I thought. But if expenses will increase by 10%, now how much will be the savings? 40,000 only. That means by how much percentage? Yes, my savings will reduce. Previously it was 50, now it will become 40. By how much it will reduce? By 10 it will reduce. On which value? On 50. Percentage change formula. It is a change divided by original value from where it is changing into 100 basics. Okay. Yes, 50 was there. From there it became 40. That means it reduced 10. From where? From 50 it reduced. That means how much percent it reduced? 20% my savings reduced for businessman. For person who is doing job, previously 20,000 savings was there. But now boss, savings is 12,000 only. That means savings reduced by how much? 8,000 it reduced. From where? How much was there? 20,000 was there. That means how much a percentage savings reduced? 40% it reduced. SEBI articleship he was doing. Previously somehow 1,000 rupees he was saving. But now his savings is 300 only. That means tell me by how much his savings has reduced? 700 rupees. Yes, previously how much it was? 1,000. That means how much percent his savings reduced? 70% his savings has reduced. Now try understanding the feel, what it is telling. Okay boss, 3 people they calculated next month how much savings could be there. In that risk is there. Income may fluctuate, cost may fluctuate. Yes, if their cost fluctuates adversely by 10%, assume their cost next month increase by 10%. Yes, what happens to Pavitra's savings? By how much percent her savings will fall? Her savings will fall by 20%. By how much percent? Yes, job person savings will fall? 40% will fall. SEBI's saving, 70% will fall. Who will get the biggest hit? Who is most sensitive? SEBI is most sensitive, because just 10% if his expenses go up, his entire savings will come down by 70%, boss. That means who should be most careful about expenses? He should be most careful about expenses. Is this clear, everyone? Yes, same story. Who is, what happened? This got switched off. Okay, fine, leave it, no issues. Who is most impacted? Yes, SEBI article is most impacted, because if his cost adversely increases by 10%, his saving 70% will reduce. Okay, he is the most sensitive. Okay, he has to be most cautious. Okay, boss, great. Same thing I can do for income also. Tell me, income we have calculated. Yes, if whether my income increases is bad or income reduces is bad. Income reduces is bad. Yes, I will hit it adversely by a specific percentage. Suppose I put everything by 10%. So everybody's income reduced by 10%. Yes, only one factor at a time, one girl at a time, SEBI. That means cost will I touch? No, cost will be same only. I will calculate savings. Original savings is there, revised savings is there. I will see how much percentage my savings has reduced. Yes, wherever yes, the percentage fall is highest, that is most sensitive. Is this clear, everyone? Okay, great. This we understood with the help of a simple story. Same thing I should be doing for my NPV. Yes, I estimated what all factors could be there. Based on that, I calculated NPV. Okay, how much cash I am getting, how much selling price will be there, how much variable cost will be there, how much life will be there, how much discount rate will be there. All these are estimate. It can vary. It can vary positively also, negatively also. If it changes positively, will I cry? No. What is fear for me? If it changes negatively, I will see every factor, only one factor at a time. Yes, suppose I am taking cash flow. Yes, assume my cash flow adversely changes by 10%. What will be my NPV? Original NPV is there, revised NPV is there. By how much percent my NPV falls? Then my discount rate changes. What will be revised NPV? How much percent it falls? Life changes, selling price changes, initial investment changes. Every factor changes. Only one factor at a time. What will be my revised NPV? How much percent my NPV will fall? Wherever NPV will fall maximum, that is the most sensitive factor. Is this clear, everyone? We will do an example, do not worry. Now look at this. You have to tell me what is risk, what is risk, increase or decrease. Initial investment or cost of project. I thought that for my project 1 lakh I am going to put. Yes, if it increases it is bad, if it decreases it is bad. If it increases, yes or no, I thought 1 lakh I have to put. I set a project at 50,000 only. Will I sit and cry? No, boss. But I have to spend 2 lakh. Oh my God. If it increases, it is risk. Selling price. I thought every pen, suppose I am manufacturing pen, I will sell at 50 rupees. Yes, it increases is risk, decreases is risk. Decrease is going to be risk. Variable cost. Increase is risk, decrease. Increase is going to be risk. Fixed cost. Cost increases risk, increases risk. Cash flow after tax. After paying tax, how much cash I am getting? I thought every year 1 lakh I will get, but now I am getting 90,000 only. Risk is there. Decrease in cash inflow is going to be risk. Project life. Increase or decrease? Decrease. I thought I started this business, sugarcane business, Rangana started. He thought 10 years it will have a life, 10 years I will earn money. But they could run it only for 5 years. It means only 5 years they could earn money. Risk. Yes, fall in project life is going to be my risk. Sales volume. I thought every year 1 lakh units I will sell. What is risk? Fall in the sales volume is going to be risk. Discount rate. Increases risk, decreases risk. Increases risk, decreases risk. Increases risk. Simple. Yes. To start the business, I want to get my funds. Loan. I thought I will get it 8%. 8% if I discount is sufficient. But I went to market and I'm asking, they're telling you give 12%, only then I'll give. Happy or sad? Will I be happy? Previously I was getting 8%, now I'm paying 12% to bank. I'm paying more to bank. Bank will become rich. Happy? No boss, I will become pauper. Yes or no? So, yes, increase in discount rate, more I have to pay. That is a risk for me. Is this clear, everyone? Okay, boss. Great. I understood what is a risk, adverse movement. Now, how do I calculate? Calculation is very simple, Juju. There are two different ways for me to calculate sensitivity analysis. One is simple, one is a bit difficult. Yes, simplest way is, yes, a fixed percentage change in every factor. Every factor is there. Every factor, yes, I will change adversely by a fixed percentage. Question will tell you how much percentage adversely it will change. If it doesn't tell, I will put by 10%. Okay, yes, now how do I do that? Second one is going to be margin of safety approach. Now this, even if you completely leave it also, is absolutely fine. Because every question I say does as per both the approaches. This alternative that. So this if you completely ignore, just you do this and go. Sufficient, more than sufficient. But this is also simple only. Just that you have to spend some time and understand the nuances. That's all. Okay, boss. Great. Yes. Where a fixed percentage change in every factor is given. First approach. Yes. What will I do? Step 1. My expected data is there. Based on that, I will calculate the expected NPV. Okay, how much I am expecting to get. But this is expectation. It may change. So what I will do for every factor, I will pick every factor. Only one girlfriend at a time. Sebi, at a time, how many factor will change? Only one factor. Everything else constant. Okay. Only that factor I will adversely change. In this situation, what will be my NPV? I will calculate. Is this clear? Suppose I am having 5 factors. One factor I will change adversely. All 4, like that only I will keep. In this situation, what will be my NPV? I will see. Then I will see, okay, boss, originally this was my NPV. Now my NPV has become this. By how much percent my NPV has changed? Percentage change in NPV. Percentage change formula. It is a change divided by original value into 100. Is this clear? And tell me, yes, which is the most sensitive factor? Where maximum percent change is there, the factor with the highest percent fall in NPV is the most sensitive factor. In our example, yes, when cost increased by 10%, yes, SEBI's savings fell by 70%, highest it fell. That means he is the most sensitive to change in cost. Is this clear, everyone? Okay, great. So shall we solve questions on this? 2 examples I have created as per both the approach. Each and every adjustment, what all under the earth is possible, everything we put in 2 examples. That you do, then practical questions you can do it yourself. Is this clear, everyone? Okay, boss. Now let us try doing. Example 1. Rangana is going to start a project. Okay, juice shop. What is the cost of the project? They are estimating 1 lakh. Project life they are estimating is 5 years. Cash flow, they are thinking after paying tax, every year 40,000 they will get. Discount rate is going to be 10%. Calculate NPV of the project. Can I calculate NPV? Tell me T is equal to 0. How much I am paying? 1 lakh I am paying. Yes, every year how much I am getting? 40, 40, 40, 40, 40. At what percent I should discount? 10%. I will get my NPV. Yes or no? NPV is 51,631. Okay, boss. Great. This is my expected NPV. But risk is there, boss. Risk is there, boss. If factor changes adversely, first let me define risk. Boss, I am thinking my cost of project will be 1 lakh. What is risk? If it increases is risk, if it decreases is risk. If it increases is risk. Project life, I am thinking from this business I will get money for 5 years. If it increases is risk, if it decreases is risk. Decreases, I got money only for 3 years, that is risk. Cash flow after paying tax every year 40,000 I will get. If it increases is risk, decreases, decreases. Discount rate, I thought for bank 10% I should pay. Increases risk, decreases risk, increases risk. I should define my risk and keep. Basics, we just miss out on that, that's all. Okay, boss. Then sensitivity, if each factor adversely changes by 20%. Question is telling, yes, assume every factor adversely changes by 20%. What will be my situation? Okay, let us do the calculation. Look at this. Original NPV I have done, existing NPV. Yes. Calculate revised NPV after 20% adverse change in every factor. One girlfriend at a time, one factor at a time. At one time, one person only. Everything else is going to be constant. Okay, boss. Now my basic data I have written here. Look at this original value. I have done the calculation this way. You guys can do individually, separately. I just for comparison purpose here only in one single place I have put. Yes, cost of project. Originally what I thought 1 lakh it will be. Cash flow after tax, cost of project originally I thought 1 lakh it will be. Cash flow after tax I thought originally 40,000 I will get. Discount rate originally I thought 10% it will be. Life originally I thought 5 years. One factor at a time. One girlfriend we will pick. Yes, Sebi, our first girlfriend is cost of the project. Okay, I thought cost of the project will be 1 lakh. What is question telling? By how much percent it will change adversely? 20% cost of the project. Increases risk, decreases risk? Increases risk. That means if it increases by 20%, how much it will be? 1,20,000. Other things will change. What will be NPV in that situation? Tell me every year how much I am getting? 40,000 I am getting. Like this for how many years I am getting? 5 years. Discount factor is 1.1, sorry, 10%. So 1 divided by 1.1 equal. MRC, 5 years present value annuity factor you will get. So 40,000 into present value annuity factor, you will get present value of cash inflow minus present value of cash outflow. How much will be my cash outflow? 1,20,000. What will be my NPV? 31,631. Is this clear, everyone? Okay, perfect. Now tell me, originally what I thought my NPV will be? 51,631 I thought. But if my cost of project increases now, look at this, originally I thought 51,631 will be there. But if my cost of project increases, it comes down to how much? 31,631. That means by how much rupees NPV will fall? 20,000 rupees it will fall. From where? From 51,631. That means how much percent NPV will fall? 30 point whatever percentage it will fall. Same thing you have to do for every factor. Aram se one step at a time. No hurry only. Only, Sebi, one girlfriend at a time. No multiple people. No best friend also. Commitment is required. Sensitivity is telling. Cash flow after tax, next factor. We estimated that it is going to be 40,000. Tell me, cash flow increases risk or decreases risk? Decrease. How much percentage adverse they have told? 20%. So 40,000 minus 20%. Assume every year I am getting 32,000 only. Let me calculate NPV. Yes, tell me 32,000 every year I am getting. Like that for 5 years at 10%. Yes, discount factor is 3.791. Yes, what is going to be my cost of project? 1 lakh only one factor at a time. Okay, minus 1 lakh. How much you are getting? 21,305. Tell me, originally what I estimated my NPV will be 51,631. Now how much it became? 21,305. Just aram se you do. For everything I can give you a formula. Every 5 place I can give you a formula. No need. You know the base, you do. Or else you get stuck like crazy. Okay. Tell me by how much my NPV is falling from 51,631 to 21,305. How much it is falling? 30,326. 30,326 it is falling. From where? From 51,631. That means how much a percentage it is falling? 58.74%. Okay, boss. Great. Next thing I will do for discount rate. Yes, currently discount rate is how much? 10%. Discount rate increases problem, decreases problem. Increases problem. Right now it is 10%. If it increases by 20% of 10, don't do 10% plus 20%, 30%. Okay, I am not even making an attempt to justify why it is wrong. At final you should know why it is wrong. Okay, it is 12%. Is this clear? Now only one girlfriend at a time. Yes or no? Everything else is same only. How much I am getting every year? 40,000 only I am getting every year. But discounting is not at 10%. It is at 12% for 5 years. I will put present value annuity factor at 12% for 5 years minus initial investment is 1 lakh only. You will arrive at your NPV. How much you are getting? 44,191 rupees. Tell me, originally how much we thought? 51,631. Now it became how much? 44,191. That means by how much it reduced? 7,440. Yes, from where? From 51,631. That means how much percentage it fell? 14.41 percentage. Okay, boss, great. Next, project life. I thought 5 years is project life. Tell me, yes, project life increases risk or decreases risk? Decrease. I thought 5 years I will get. Suppose I got cash from 10 years. Bingo, happy. I get 3 years only. Yes, cash inflow. That is risk for me. Okay. 5 years minus 20%. 4 years. Okay, now let me try calculating. Only one girlfriend at a time. Only project life is changing. Everything else is constant. I am getting 40,000 only. Yes, discounting is 10 only, but for 4 years. Okay, I will take present value annuity factor for 4 years. Initial investment is 1 lakh only. Calculate your revised NPV. 26,794. Yes or no? Okay. Originally I thought it is 51,631. Now it became 26. I was checking. You guys are alert or not? Sometimes I intentionally put suspense. 26,794. That means by how much it has reduced? How much? Whatever. How much percentage it has reduced? See, this was correct. I was checking whether you guys are chumma, you are doing or not. It is important. Na? See how difficult it is being me. First I should write right. Then I should write wrong on the assumption that you will make it right. Okay. Now tell me, which is most sensitive? Understand, if my factor goes adversely by 10%, yes, if my cost of project goes adversely by, yes, 20%, na, my NPV will fall by 38%. If second, cash flow goes adverse, na, my NPV will decrease by 58%. If discount rate changes, NPV will reduce by 14% only. If last one goes, it will reduce by 48%. Where I am having maximum risk? Second one. That means where is the maximum risk? Cash flow is the most sensitive. That means, okay, I calculated NPV in real life. I calculated NPV. Yes, before deciding to start, I will again confirm. Cash flow pakka I will get na. Because if this goes means most risk I am having. And when I am running the business also, my maximum effort will be to ensure that my cash flow I am getting. A discount rate, some up or down is fine for me. Initial investment, some more okay for me. But cash flow I should get it right. Is this clear? That is what sensitivity is telling. One factor at a time. Is this clear? I will calculate the sensitivity. Comment. Okay, boss. Great. Okay, simple. Jujubi. Nothing is there. Okay, great, boss. Next, one more example is there. All these things are there. We'll come to that. Okay. Now, different sets of data we have taken. Okay. We are starting business. Okay. Rangana is selling, yes, every glass of juice we are selling at 100 rupees. Okay, boss. Variable cost is 40 rupees. Okay, boss. Fixed cost every year is 5 lakh. Okay, boss. Number of units that we are going to produce and sell every year. First year 20,000 units we are selling. Second year 30,000. Third year 30,000. Discount rate is 10%. Initial investment is 20 lakh. Understand total how many factors are there. Selling price is a factor. Variable cost is a factor. Fixed cost is a factor. Number of units is a factor. Discount rate is a factor. Initial investment is a factor. Let me define risk. Selling price. What is risk? Selling price increases risk or decreases risk? Aram se decreases risk. There is no need to buy heart and keep. Should I do plus minus? This all plus, this all minus. Why you want that? Where you can keep it simple, keep it simple. Variable cost increases risk or decreases? Increases. Fixed cost increase. Number of units that I am selling and getting money. If it reduces, that is risk. Discount rate increases risk. Initial investment, how much money I am putting, increases risk. Okay, I defined my risk and kept. Step 1, calculate NPV of the project. I will do a detailed calculation of NPV because in other places cash flow was given. Here, look at this. I will do a calculation. How many years are there? 1, 2, 3. Selling price is given, variable cost is given. Tell me, selling price is 100, variable cost is 40. Contribution is how much? 60 per unit. Like that, how many units I have sold is given. So can I calculate my contribution? If I want, I can show sales minus variable cost contribution also. That I just simplified, that's all. Okay. This much contribution I got. From this fixed cost I should pay. Yes, boss, I should pay fixed cost also. Normally it will give me my EBITDA, earnings before interest, tax, depreciation, amortization. Depreciation is given, not given. Tax is given, not given. Nothing is given. That means what this will be? This only will be my cash flow after tax. Okay, boss. So every year's cash flow I got. Now tell me, initial investment I have. Okay, every year's cash flow I got. T is equal to 0, I know. 1, 2, 3, I know. Discount rate is given. Can I calculate NPV? Yes or no? You will calculate NPV. Simple. Yes, we are going to do the calculation. Contribution, fixed cost, cash flow, present value of cash inflow. I will calculate NPV. NPV is going to be 6,87,453. Whatever it is. Okay. Now, what are they telling? Calculate sensitivity in selling price, variable cost, fixed cost, number of units. Only 4 factors I have taken. Selling price, variable cost, fixed cost, number of units. Yes, these 2 things in the last example already I told. So, summa again why we are doing. Okay, fine, great. So, if every factor adversely changes by 10%, 10% adverse movement is happening. What will happen? We will see. Okay, boss, great. How did I not do in a single table? Separately only did. Sure. Okay, fine, no issues. Okay, I've kept the data here because here some calculations have to be. Okay, here I cannot just bring it down to a single table because so many every year's data will change now. Okay, fine. Now tell me, selling price, only one girlfriend at a time, only one factor is going to change adversely. How much percent? 10% it is going to hit. Tell me, selling price, originally how much I thought selling price will be? 100. Yes, if it adversely changes by 10%, how much will be my selling price? 90. Variable cost, will it change? No, it is 40 only. That means how much will be my contribution? 50 per unit. Yes, I got my contribution per unit. Whether number of units will change, nothing else will change. I will get the total contribution minus a fixed cost. I will get my cash flow after tax into, I will get present value of cash inflow minus present value of cash outflow. I will get my NPV. All these from basics we've been doing from CA Inter long back. Okay, so I'm not spending time here. Plus this is revision. Okay, so I will calculate NPV. It will come to 32,307. Okay, boss. Originally, how much was my? Sorry, what? NPV will come down this much. Okay, fine. Yes, originally my NPV was 6,87,453. But if my selling price reduces by 10%, now how much my NPV will become? It will become 32,307. That means by how much rupees my NPV will fall? 6,55,146 it will fall. How much percent it will fall? 655,146 it will fall. From where? 687,453. How much percent it will fall? 95% it will fall. Just 10% if my selling price reduces means business is damar, almost close to damar. Yes or no, everyone? Okay, great. Next factor we will take one factor at a time. Yes or no? We are telling variable cost changes. What is original variable cost? 40. Tell me 10% adverse means how much it will become? Plus 10%, 44. Tell me anything else will change? No, boss. Selling price is 100. If variable cost becomes 44 means contribution is how much? 56 per unit into number of units. I will be getting the total contribution minus a fixed cost. I will get cash flow into present value factor is going to be same only. I will get present value of cash inflow minus present value of cash outflow. I will get my NPV. NPV will become 4,25,394. Originally I thought it will be 6,87,453. Now it will become 4,25,394. By how much it will reduce? Not even touching calculator, directly 38.12%. Yeah. Whatever divided by original value, how much percentage it will fall? 38.12 percentage it is going to fall. Is this clear, everyone? Okay, perfect. Third factor that they have asked is fixed cost. Tell me originally how much I thought is fixed cost? 5 lakh. If it adversely changes by 10%, means what? Increase or decrease? Increase by 10%. It will become how much? 5,50,000. Everything else is same only. This is 100 only. This is 40 only. That means contribution is 60 only. Based on that total contribution I will get. But fixed cost will become 5,50,000. I will get my cash flow. Present value factor is also same only. Yes, I will get present value of cash inflow. Initial investment is also same only. I will get my NPV. Tell me originally I thought 687,453 will be my NPV. But now it has become 563,110. That means how much percent NPV has fallen? It has fallen by, do the calculation, 18.08%. Is this clear, everyone? For 4 factors they have asked. Okay, great. Sorry, for number of units also they have asked. I missed. Now tell me, number of units, 10% adversely have to change. First year, number of units, increasing is risk or decreasing is risk? Decreasing is risk. Okay. First year I thought 20,000 units I will sell. 10% adverse means how much it will become? Second year 30,000. 20? Third year 30,000. Everything else is same only. Selling price is 100, variable cost is 40, contribution is how much? 60 into number of units is this. I will get total contribution minus fixed cost is same only. I will get cash flow, discount rate is same only. I will get present value of cash inflow, initial investment is same only. I will get NPV. My NPV will become some 2,94,365. Okay. So originally it was 687,453. Now it has become 294,365. By how much it has reduced? Whatever it has reduced, how much percent it has reduced? 57.18% it has reduced. Is this clear, everyone? Okay, va? Okay. Now final thing. Okay. Samaja. Life of the project. Tell me, originally my life is how much? 3 years. Assume my life adversely moves by 10%. Adversely means plus a minus a. Minus it has reduced, that means 3 minus 10%. 2.7 years. That means my project life will become 2.7 years. Can I do the calculation of present value of cash inflow? 0.7. How will I do? Not possible. Don't tell me, sir, I will do, yes, third year number of units into 70% into all those things I will do. No, your present value factor also you want. So many things are there. Okay, fine. I cannot do. That means I cannot adversely hit it by 10%. But sir, I want to adversely hit it by 10%. I will do one thing. Okay. Project life is currently how much? 3 years. It has to move adversely. That means it should go up or come down. Come down. Nearest where it can go? 2 years. That means from 3, if it comes down to 2 years, means how much percent it will fall? It will reduce by 1 year on 3 years. 33.33%. If my life reduces by 33.33%, how much will be my revised NPV? Can I calculate that? First, let me do that. Then I will do cross multiplication, bring it for 10%. I am giving every extreme scenario possible just in these 2 examples, so that anything comes, you know how to do. Everywhere else, you put a percentage, you will get it. Only for life, it can come in decimal. So if for life, if it comes in decimal means, yes, what you will do, you will put some other rate, then do a cross multiplication, bring it to that rate. Okay, boss. I will tell, boss, I cannot bring it that way. So, yes. So what I will do, yes, I will reduce it by 33.33%, bring it to 2 years. Based on that, I will calculate NPV. Okay, boss. Only life is changing, everything else is same. Selling price is 100 only, variable cost is 40 only. That means contribution is how much? 60. Number of units is same only. I will calculate total contribution minus fixed cost. I will get cash flow into present value factor. I will get present value of cash inflow minus present value of cash outflow. I will get my NPV. Yes, now let me try calculating the percentage change in NPV. Yes, originally my NPV was 6,87,453. Now, if project life becomes 2 years, my NPV will become minus 2,89,256. By how much it will fall? From 687 plus, it is going to 289 minus. Yes, if you are still getting confusion, draw a line. 0, 689, 0 it comes, again it goes to 89. By how much it is falling? 142.07% it is falling. Is this clear? Okay, fine. Okay. Now tell me. This was my calculation. But based on this, can I give a comment which is most sensitive? No, because every other factor I change by 10%. This factor I change by 33%. Data is not uniform. I cannot compare. Okay, that means what I will do, this again now I will bring it to 10%. How I will bring? Simple cross multiplication. I am telling, boss, if my project life, yes, project life is there. NPV is there. Cross multiplication, 99% for you is in costing FM interfinal, you finish it off in cross multiplication, nothing more is needed. If your project life decreases by 33.33%, one third, your NPV will fall by how much? 142.07%. For me, question told how much adverse to put? 10% only adverse to put. That means how much will my NPV fall? 10 into 142.07 divided by 33.33, 42.6% it will fall. Is this clear, everyone? This is the only way for me to calculate NPV in this situation. Is this clear? Or else, yes, once you see this, for every factor you do by 33.33%. Okay, that also if you want you can do, but this is okay, this is fine, we will do it this way. Okay, fine everyone. Okay, now comment. Yes, let me see. Yes, when my factor adversely changes by 10%, where I am getting the highest hit. If selling price adversely changes by 10%, na, yes, my NPV will fall by how much percent? 95% it will fall. Variable cost if it changes means only just 30% it will fall. Okay, fine. Fixed cost if it changes means just 18% it will fall. Okay, fine. Yes, number of units if it changes means okay, 57% it will fall. But still selling price 95% is falling. Yes, life if it changes means I want for 10%, don't compare with 33%. Yes, it will fall by 40%. Tell me where I am having maximum risk? Selling price, because if that moves adversely by 10%, na, 95% of my NPV will be wiped away. 95% will fall. That means selling price is going to be the most sensitive factor. Is this clear, everyone? Okay. Approach 1 is over, where you are hitting every factor adversely by 10%. Simple. Yes, 3 points to remember. Point number 1, you should know what is adverse. Cash inflow means reduction is adverse. Outflow means increase is adverse. Yes, this life of the project reduction is adverse. Discount rate increase is adverse. Over story. Point number 2, one girlfriend at a time. Only one factor I will touch. Everything else will be constant only. Yes. Point number 3, I will calculate the percentage fall in NPV. How much percentage it fell? Which is the most sensitive? Maximum percentage fall is most sensitive. The only trick adjustment is if your life comes in decimal. 3 year minus 10%, 2.7 years. I cannot do. I will bring it to 2 years. I will see how much percent it reduced, 33.33%. For that, I will see percentage fall in NPV. Then I will reverse calculate for 10%, how much it becomes. Over. Discussion over, story over. Now, if you want in this only, you can stop. Because margin of safety approach is, yes, a bit tricky. You will understand, simple only it is. Bring your X, you will get answer. Your X is there to help you. You should know which X to choose. Correct place, correct X you should choose. If your X becomes that side, this side, life will become damar. All these are AFM philosophies. Okay? Yes. But every question ICA has done, they have done in both the approaches also. So if this much only you do, you give in the examination, just to give a note. Alternatively, it can also be solved using margin of safety approach. In that case, the answer will vary. Should be sufficient. Okay, but still, because it is there, let us do that also. Okay, we will do that, or should we ignore that? Ignore, Do, What da? Bahubali, what is your name, Specs? Lalita, what Lalita? If you are telling ignore means okay, ignore. We can give a good break. We can sleep, come back. Aram se we can continue. Just giving you guys a 1 minute breather to let the things settle in. We'll do one thing. Where is my phone? Don't worry, once I'll give you lunch break, I'll give you good enough lunch break. Okay, 1.5 hours. 1.5 hours lunch break, I'll give you. Aram se have lunch. Stop question. Sleep if you want to, because I will sleep. Okay, then we'll continue. Sebi, remind me in 10 minutes, okay, to order food on Zomato. So by the time I give a break, yeah. Huh? My phone is switched off. Yesterday I left this charger here only and went. So night charger only is not there. Huh? Which one? My charger I kept it here. For my iPad I had kept it. So I did not take it upstairs. So life without phone pay is miserable. Statistical nuanced. Okay. We'll continue our discussion. Okay. Type 2. Okay. Maja is about to come. Get ready. Yes, we call it as margin of safety approach. That is, here we are seeing by how much percent, if my factor changes, my NPV will become 0. I want to bring my NPV to 0. Let us understand with our first example. 3 people are there. Businessman is there, job is there, article is there. How much is the income? 1 lakh 50, 1 lakh 8,000. How much is the expense? 1 lakh 8,000, 7,000. What is the savings? 50,000, 20,000, 1,000. Yes, first person, Pavitra is telling, yes, 1 month I am having 50,000 rupees savings. Okay, that means tell me right now. Let me only consider for expenses. Right now, what is Pavitra's expense? 1 lakh. In future, if her expenses becomes 1 lakh 10,000, will she feel bad? She will feel bad. But will she be on the road? No, boss. She still has money. Her expenses become 1 lakh 40,000. Will she feel bad? She will feel bad. But will she be on the road? 1 lakh 50 she is earning now. Her expenses reach 1 lakh 50,000. Now she is exactly 1 leg on the road, 1 leg on the home. Some more expense, she will reach road. Yes or no? So tell me. Right now her expense is 1 lakh. Maximum how much she can spend so that her NPV becomes 0, so that her saving becomes 0. Maximum up to 1.5 lakh she can spend. Yes. Santosh, he is spending 80,000. Maximum how much he can spend so that his savings become 0. 1 lakh he can spend. Article, he is spending 7,000. Maximum how much he can spend so that his savings become 0. Firstly, 1,000 you should not tell as savings. Yes. Secondly, how much you can spend? 8,000 you can spend. So that means, look at this. I am telling. Yes, Pavitra's current expense is how much? 1 lakh. In future, even if it becomes 1 lakh 50,000, it is okay. Savings has just become 0. That means 100 has become 150%. By how much percent her expenses can go up from 100, even if it becomes 150, that is 50, it increases from 100. That is, even if her expenses increases by 50%, she is okay. She will be on the home only. Yes or no? Okay. Now, second person, he is doing job. Right now, what is his expense? 80,000. Maximum how much he can spend so that his savings can be 0? 1 lakh. That means how much percent extra if he spends also is okay for him. 80 is there. It becomes 1 lakh. That means 20 extra he spends on 80. How much? Even if he spends 25% extra, he will not become negative. Okay. Article is there. Right now, how much he is spending? 7,000. If how much he will spend, his savings will become 0. If he spends 8,000, his savings will become 0. That means how much percent extra if he spends, his savings will be dumber. Now it is 7,000. If it reaches 8,000 means 1,000, yes, change on 7,000, 1 by 7, 14.28%. Yes, now understand how do I calculate. Chumma don't by heart, highest, lowest, highest, lowest. You will get confused there. Simple, simple, simple. Now understand what is it telling. Pavitra is telling business. She is telling right now I am spending 1 lakh. Even if my expenses increases by 50%, I am okay. Santosh is telling job. Right now my expense is 80,000. Even if my expenses increase by 25%, I am okay. Sebi is doing article check. He is telling right now I am spending 7,000. If my expenses increase by 14%, I am damar. Tell me who is having the most risk. Sebi is having the most risk. Assume, yes, all their expenses went up by 10%. Anyone is having problem? No one is having problem. Assume their expenses increased by 20%. 20% it increased. Whether Pavitra, businessman, will be on the road? No. Whether Santosh, job person, will be on the road? No. Sebi is on the road. Yes or no? Yes, 30% it increased. Sebi is already on the road. Who will join with Sebi? Santosh will come. Some place for me also you keep da. Yes or no? Tell me, who is most sensitive? Yes, Sebi is most sensitive. Yes, whose factors lowest change? Just 15% change in that factor will make the NPV 0. That is the most sensitive factor. Is this clear? Yes, what is the most sensitive factor? Yes, the factor with the lowest percent change. Just some it change means my entire NPV is wiped away. That is the most riskiest. Is this clear? Don't buy AIR-10 keep. That is highest, this is lowest. Read the numbers, feel the numbers, give yourself a minute's time to tell what is happening. You will tell the decision. The reason why we don't do it that way is we are not telling what is happening. We are just seeing some numbers are there, random calculations we are doing. Give yourself time to feel the story, to understand what exactly on earth these numbers are trying to tell. There is no need to by heart 99% things. So look at the steps to be calculated. Step 1, I will calculate existing NPV. Step 2, yes, for every factor, I want to know, yes, the revised value of factor, how much my factor can become, so that NPV becomes 0. Right now she is spending 1 lakh rupees. Maximum how much she can spend so that her NPV becomes 0. Okay, 1 lakh 50 is her earning. That means 1 lakh 50,000 she can spend. Okay, I will calculate the revised value of factor. Then I will see the percentage change in the factor. Previously I was spending 100. Now I am spending 150. That means how much percent extra if I want I can spend. 50% extra if I want I can spend. Don't sit and by heart percentage change formula. It is the change divided by original over. Yes, based on that comment, factor whose lowest percent change will make NPV 0. Just a small change, the entire NPV will be wiped away. That is going to be the most sensitive factor. Is this clear, everyone? Got the feel? In first one, I am changing. Yes, I am calculating revised NPV based on that percentage change in NPV I am seeing. Here I am changing a factor based on that, yes, revised percentage change in factor I am seeing. Okay, aram se, you have to give yourself time to feel what is happening. That's all, nothing else is there. Look at this simple summary. Okay, where is it? Okay, next page I put up. Okay, fine, here it is. Yes, approach 1, yes, I am bringing in a fixed percentage change in every factor. I am changing. So step 1, always I will calculate existing NPV. Step 2, okay, factor has changed adversely by 10%. So I will calculate what is the revised value of factor. For this value of factor, what is the NPV? This is the original NPV. This is the revised NPV. What is the percentage fall in NPV? Where there will be maximum fall in NPV, that is the riskiest, most sensitive. Okay. Second, margin of safety approach. Here I am telling, okay, step 1 is again I will calculate existing NPV. I want to make this NPV as a 0. Margin of safety, complete safety net I want to eliminate. I want to make this NPV as 0. To make my NPV 0, what will be the value of factor? How much that factor will be? Okay, boss, originally this was the value of factor. Now this is the value of factor. How much percentage change in factor is okay for me? I will calculate percentage change in factor, where just the minimum change in factor makes my NPV 0. That is going to be the riskiest. Is this clear? I have made it the most simple. Still, if you are feeling, no, sir, very difficult, sir, eliminate this. For every question, you do that over. Is this clear, everyone? Now, what all different variants can be there? Look at this. Two examples, same example. First one I did, yes, fixed percentage adversely changed. Secondly, sensitivity in order to make the NPV 0. Cost of project is 1 lakh. Project life is 5 years. Cash flow after tax is 40,000. Discount rate is 10%. We are ready? Yeah, aram se. I've told you, we are in finals. Some places we should be willing just to think. That's all. Okay, boss. Great. Tell me existing NPV I would have calculated and kept 51,631. Okay. Zomato. Okay. Just a minute, students. Okay. 30 minutes, half an hour. Okay, fine. Yeah, ready? Yes, what I want to do, I want to make NPV 0. Okay, so whenever you are stuck in trouble, yes, we should remember? We should remember our X, that's all. X will help you out. Don't worry, X is there for our benefit, for our advantage. They will help us. Okay, tell me right now what is my existing NPV? 51,631. I want to calculate the value of the factor so that NPV becomes 0. Based on it, I will calculate the percentage change in every factor. Okay, boss. Aram se one step at a time I will do. Okay, every data I have kept. Yes, cost of the project. I am seeing the change in cost of project. That means everything else is going to be same. I am telling cost of project right now is 1 lakh. If my cost of project becomes how much? My NPV becomes 0. I don't know. X. Everything else is going to be same only. Project life is 5 years only. Cash flow after tax is 40,000 only. Discount rate is 10% only. Okay, boss. Now, yes, I have assumed project life as X. I want my NPV to be 0. What is NPV formula? Yes, NPV is equal to present value of cash inflow minus present value of cash outflow. NPV should be how much? 0. Present value of cash inflow. Every year how much I am getting? 40,000. Like this, for how many years I am getting? 5 years at the rate of 10%. I will put my present value annuity factor of 5 years for 10% minus present value of cash outflow. That only I am calculating, na, minus X. Is this clear, everyone? You will arrive at the value of X. Yes, look at this. 40,000 into 3.791 minus X. That means your X is going to be 1,51,361. Okay, va? Okay. That means tell me right now my cost of project is how much? 1 lakh. Even if it becomes 1,51,361, I am okay. I will not be on the road. That means how much percentage if it increases also I am okay. 51.36% if it increases also I am okay with that. Okay, boss. Great. Okay. Now if I want I can tell shortcut also that if it is the cost of project directly, yes, what is there, you can just add, do all those things. But if I am telling that for everything I have to keep telling, for this you do like that, for that you do like this. Forget, na, bring your X over. You will take 1 minute extra, but you are not thinking, na, you are not by thinking for this, that I should do, for that this I should do. Over, put X. Everywhere X will come. Okay, next. Cash flow after tax. Okay, data is the same only. Okay, right now I am having some 51,000 something NPV. They are asking, yes, everything else is same only. Right now I am getting 40,000. If how much cash flow I get every year, NPV becomes 0. I know, I don't know. So what I'll assume? X. NPV is what? Present value of cash inflow minus present value of cash outflow. NPV should become 0. Tell me every year how much I am getting? X I am getting. Like this, for how many years I am getting? For 5 years I am getting at 10%. Calculate present value annuity factor. For 5 years at 10%, how much it is going to be? 3.79 minus cost of project is 1 lakh only. Calculate the value of X. 1 lakh goes to the other side, becomes 1 lakh divided by 3.79. What is the value of X? 26,000, whatever, 378, 385, whatever it is. So right now it is 40,000. Even if it becomes that 26,000 also I am okay. I will not come to the road. Is this clear, everyone? Okay. Then comes the discount rate. Slowly. Okay. I want to calculate at what rate if I discount my NPV becomes 0. Now look at this, look at this, look at this. Right now what is the cost of the project? 1 lakh. Will it change? No, boss, it will be same only. What is project life? 5 years. Will it change? No, boss, same only. Cash flow after tax, will it change? No. Right now if I discount at 10%, now I am getting some 51,000. At what percent if I discount? I will make my NPV as 0. IRR. What I have to calculate? IRR I have to calculate. Here don't put X. Please, I don't know how to discount now. Don't do 1 divided by 1 plus X to the power 1, 2. Please. Okay, IRR. You should know when to call your X, which X to call. Very important lessons in life. Chumma, you cannot keep calling X. So 10% I am getting 50,000. That means I am earning more. Let me try discounting at 15% and see. When I am discounting at 15%, 34,000 is there. That means I am earning a bit more. Let me discount at 25% and see. Still I am getting 7,000. Let me discount at 30% and see. I am getting minus 2,577. That means I am getting somewhere between 25 and 30. Aram se, there is no need to buy heart anything. Aram se, okay. You should know exactly what is happening. Okay, somewhere between 25 and 30 I am getting. How much I am getting? I want to see. Okay, boss, tell me. Yes. If my discount rate is 25%, my NPV will be 7,571. Tell me if my discount rate is there, NPV is there, discount rate I am showing here. Discount rate is 25%, NPV is how much? 7,571. Discount rate becomes 30%, NPV becomes minus 2,577. I want my NPV to be how much? 0. Tell me if my discount rate increases by 5%, my NPV decreases by how much? From 7,000 it reaches 0, then it goes to minus 2,577. By how much it reaches? 10,148. If my discount rate increases by 5%, my NPV will decrease by 10,148. I want it to decrease from here to where? I want it to decrease by 7,571 only. That means by how much percent I should increase my discount rate? Right now I am earning 25. How much extra discounting I can do? It is 7,571 into 5 divided by 10,148. How much? 3.79, whatever it is. That means it is going to be 28.73%. Is this clear, everyone? Okay. Don't worry, we will bring all those things in every situation. MOS approach, what I have to do, I will tell. Don't worry. For now, every situation, aram se one by one will understand. Then we'll bring everything together also. Don't worry. Okay. That means right now my discounting is 10%. Even if it reaches 10%, na? 10%. Even if it reaches 28%, I'm okay. I will not be on the road. Okay. Yes. How much ever percentage increases, okay. We can do it and keep it. Okay. Fine. Great. Then comes the life of the project. Ready? Okay. Great. Now tell me. Yes, I want to calculate at what life of the project my NPV becomes 0. I want NPV to be 0. Okay, boss. Great. That means tell me. Cost of project, will it be 1 lakh only? It will be 1 lakh only. Life, this can change. How much, that I want to know. Everywhere don't call your X. See if you can get the work done without X also. Yes. Cash flow after tax is 40,000 only. Boss, it is 40,000 only. Discount rate is 10% only. It is 10% only. Nothing is changing. I want to know at what life my NPV becomes 0. Okay, now without discounting, let me try taking this decision. Look at these students, how much I am paying? 1 lakh I am paying every year. Yes, 5 years is there. Yes, first year how much I am getting? 40. Second year how much I am getting? 40. Third year how much I am getting? 40. Fourth year how much I am getting? 40. Fifth year how much I am getting? 40. Okay, I want to calculate the life. I will do that. Now tell me, 1 lakh I am paying. I want to recover 1 lakh. If I work only for 1 year, can I recover 1 lakh? How much I can recover? 40 only I can recover. If I work for 2 years, first year 40, second year 40, total how much I can recover? 80 I can recover. Did I recover full 1 lakh? If I work for 3 years, how much I have recovered? 120 I have recovered. How much I want to recover? 1 lakh is sufficient. That means how much year I will be working? 2.5 years I will be working. That means if I work for 2.5 years, it is sufficient. That is without discounting. These are all in different period. Can I compare? What I have to do? I have to discount. Bring every cash flow to the present value. Okay, so I have to be calculating my discounted payback period. Long back, before 1947. CA Inter. Forget that. Who wants? Simple. Get a feel, na? Who will remember the terms? Discounted payback, all those things. Okay, simple. What I am doing. Now, boss, I know every year how much cash I am getting. Cash flow after tax. I know the present value factor. I can calculate present value. This I do every time. One thing extra I will do. I will calculate cumulative present value. Now, what does it mean? It means first year on present value terms 36,000 I am getting, whatever the number. That means if I work only for 1 year, how much amount I will be recovering on present value terms? 36,000 I will be recovering. Second year, how much I am recovering? 33,000. That means if I run the project for 2 years, total how much I would have recovered? First year's 36,000, second year's 33,000, total 69,000 I would have recovered. How much money I put, boss, on present value basis? 1 lakh. Sufficient? Third year again I should go. Third year again I worked. 30,000 is there. That means 3 years total I worked. How much I have recovered? 99,400 I recovered. Full 1 lakh has happened. No, some jujube extra is there. That means fourth year I will work. How much extra I will work? I will see. Fourth year I worked. That year 40,000 I got. Present value is how much? 27,320. That means how much it became? 1,26,000. This much I should work. How much I want? 1 lakh only. Why I will work full 4 years? Tell me. If I work for 3 years, again interpolation only. Yes, how much I am getting total? 99,474. If I work for 4 years, I am getting 126,794. That means if I work for 1 year extra, how much extra I am getting? 27,320 I am getting. Look at this. I work 1 year extra. I am getting 27,320 extra. Tell me how much I want. How much I paid, boss? 1 lakh I paid. Nah, that means how much I want. 1 lakh is sufficient. That is here I am standing. I want to reach 1 lakh. How much extra I want? From 99,474 to 1 lakh. How much extra I want? 526 only extra I want. That means how much extra I should work beyond the 3rd year. Plus 526 divided by 27,320. How much it is going to be? 0.02. That means 3 year plus 0.02. 3.02 years I should be working. Is this clear, everyone? Okay. Sir, 3.02 I cannot feel, sir. Okay. 3 year. Convert this into days. Tell me 1 year has how many days? 365 days. That means 0.02 into 365 is going to be how much? Don't ask me, sir, how am I doing into 365, please. I will do suicide here only. How much? 7. 3 years and 7 days you work. Okay, sufficient. Then you go home, sleep. No issues. Is this clear, everyone? Okay. Till now, first 2 things that we did, no problem was there. Yes. When I want to bring my NPV to 0, discount rate. Which discount rate I want? I will be calculating my IRR. Point number 1. Point number 2, life of the project. How many years if I work, I will recover my investment. Boss, I want it to be on present value terms. So, every year's cash flow, present value factor, I will calculate present value of cash inflow. Boss, I will be doing cumulative because I want to know, okay, total how much I recovered. Cumulative I will be doing. Now, wherever it is reaching close, there I will put interpolation, finish my story. Is this clear, everyone? Okay. Yes, analysis is there. Look at this. Cost of the project. Originally it was 1 lakh rupees. Yes or no? Even if it increases and becomes 1,51,000, will I be on the road? No, I will not be on the road. It will become 0. That means how much percentage it can increase? 51% also if it increases, I am okay. This interpretation, this is for our understanding. Yes, even if my cost of project increases by 51%, I will not be on the road. NPV will not be negative. NPV will just become 0. Okay. Cash flow after tax. I thought every year 40,000 I should be getting. Yes, if I get 26,378, now it will become 0. That means how much percent if it will fall, it will become 0. 34% it will fall, it will become 0. Okay, great. Discount rate. Right now it is 10%. At what discount rate it becomes 0? I calculated my IRR. At 28% it becomes 0. That means 10 can go up to 28.73. How much percent it can change? Even if it changes 187% also, I don't have any risk. That much cushion is there with me. I am not very sensitive to its change. Life right now is 5 years. If my life reduces to how many years it becomes 0? 3.019 years. That means how much percent if it reduces, it becomes 0? 39% it becomes 0. Now. Yes, when you are taking an interpretation, be careful. Okay. Yes, my cost of the project. Yes, always tell to yourself the story. My cost of the project, even if it increases by 50%, I will not be on the road. This, even if it increases by 34%, I will not be on the road. This, even if it increases by 180%, I will not be on the road. This, if it increases by 39%, I will not be on the road. Yes, where I am having the maximum risk? Cash flow after tax. If it increases by 35%, I will be doing Amma, Tai, I will be on the road. My NPV will become negative. Yes or no? Assume it increases by 35%. Discount rate changes by 35%. Will I have a problem? This changes by 35%. Will I have a problem? This changes by 35. This changes by 35. Where I will reach? Okay. Yes. So, where the lowest percentage change in factor makes NPV 0, that is going to be the most sensitive factor. Is this clear, everyone? Okay. Great. One more example. More maja. But over. With that concept is over. Okay. Fine. Then we'll bring everything together at one place. Don't worry. Okay. Giving you guys 1 minute. Oh, it is almost 2 o'clock. Hungry, yeah? She is telling that time only I told we don't want, we'll have food properly. You guys didn't listen. No? Lalita? Yes, sir. No shame on Lalita. What Lalita? Okay, fine. Example 2. Selling price is given, variable cost is given, fixed cost is given, number of units is given, every year discount rate is given, initial investment is given. Okay, discount rate change, MOS I showed, IRR, initial investment change, that also I showed, taking it as X. Okay, now what all I want? Selling price, variable cost, fixed cost, number of units. Okay, they are asking calculate NPV. Okay, we will calculate. Yes, if every factor adversely changes by 10%, that also I will calculate and keep. Okay, sensitivity as per MOS approach I have to do to make my NPV 0. Ignore taxation and depreciation. Current NPV is 6,87,000. Okay, boss, great. Aram se. Yes, margin of safety approach. Right now, what is the NPV that I am having? I will just write down the number. What is it? 687,453, if I am not wrong. I don't want that number to be wrong. 687,453. Okay. Fine, boss. Yes, right now, when these are my factors, selling price is 100, variable cost is 40, fixed cost is this many units I am selling, all these things, how much NPV I am having? 6,87,000 I am having. I am telling, if my selling price changes, by how much my NPV becomes 0? Tell me, every other factor will be same only. Only selling price will change. That means what I will do, selling price I will assume it as X. Based on that I will be doing the calculation. Yes or no? Yes or no? Yes or no? No. You can do. But a very important question in life is to know, who is your X? Who is your X, Sebi? Who is your X? Understand. Because if you take selling price as X, for every year I have to calculate cash flow. How it will become? Yes, I will be calculating total contribution. Tell me, selling price is X, selling price minus variable cost. Variable cost is 40, so it becomes X minus 40. X minus 40. X minus 40. Yes, year 1, year 2, year 3. Yes, I got the contribution per unit into number of units I should be doing. Here I am having 20,000 units. Yes, I will get the total contribution. It becomes 20,000 X minus 8 lakh. Yes or no? So on it will go. Yes, from that minus fixed cost I will do. Yes, I will get my cash flow. On that present value factor I will put. So much X is coming. Okay, what I will do? Directly contribution I will take it as X. Why? First advantage is this headache I will eliminate. Contribution I will take it as X. Second advantage for me is when I am doing for variable cost, I need not do again. Contribution I know. Just based on that directly I will get. Look at this. What I am doing, very important lesson in life. Sebi, what? Who is your X? Okay. So in this case, whom am I assuming as X? Who does reach so early? For me only. So early it reaches. It means now only you can give break. Okay. I am assuming contribution as X. Yes, obviously calculation you have to do, but still it will become simpler. Look at this. I assume the contribution as X. That means tell me first year 20,000 units I am selling. That means what will be my total contribution? 20,000 X. Second year 30,000 units means 30,000 X. Third year 30,000 units means 30,000 X. Minus fixed cost when I do, I will arrive at my cash flow after tax. First year it is 20,000 X minus 5 lakh. I am going to multiply. I want to bring it to present value into present value factor. So it is 20,000 X into 0.909 minus 5 lakh into 0.909. Okay. Every years I calculated cash flow after tax. Now I will be calculating my NPV. NPV is present value of cash inflow minus present value of cash outflow. NPV should become 0. Present value of cash inflow. All these, yes, I will add and I will write down, minus present value of cash outflow is 20 lakh. We are in final. Some X we have to bear. You cannot be assuming that you will be getting an equation 3x is equal to 18, find the value of X. There you will tell X, here into here divide by 3 is 6. Some maja should be there in life. You are going to become CS. Okay, fine. Okay, so based on this, I will simplify. Yes, minus 20 lakh goes to the other side plus this minus goes to the other side plus this into comes to the other side divide. You will be getting the value of x is 49.51. Okay, fine. Till here is fine. Very important lesson in life is to remember who is your x. You should not forget who is your x. Contribution is your x. Okay, so that means if my contribution becomes 49.51 na, my NPV is damar, NPV becomes 0. Okay, but I want to calculate selling price is how much, variable cost is how much. Based on this only, takka two places also you will do. Yes, if contribution is 49.51, NPV is how much. Suppose my selling price is changing. Okay, how much will be my selling price? Tell me. Yes, selling price minus variable cost is contribution. Selling price is changing. Yes, contribution if it becomes 49.51, it becomes 0. What is my variable cost? Variable cost is changing. No, how much it is? 40. That means what should be my selling price? 89.51. That is, if my selling price becomes 89.51, my NPV becomes 0. Sir, variable cost, okay. If my contribution becomes 49.51, my NPV becomes 0. Yes, selling price minus variable cost is contribution. Contribution is how much? 49.51. Variable cost is changing. That I want to see. Selling price is same only. How much is selling price? 100 minus variable cost. Take it to the other side, bring it to this side. 100 minus 49.51. If my variable cost becomes 50.49, yes, then my NPV becomes 0. Is this clear? Yes, firstly, I have simplified the calculation. Secondly, in a single calculation, I got both the values also. So, lesson being, if your selling price per unit, variable cost per unit, you have to calculate, means don't take that as x. Take contribution per unit directly as x. Based on that, you calculate. Okay? Okay, boss. This much is fine. Fine. Next one is simple, jujube. That will finish it off. Okay, then one or two more maja could be there, or else maja is over. No, one more maja is there. Simple only. Next is simple. Don't worry. Fixed cost. Tell me, I'm telling no, boss. All those things are same. Only fixed cost is changing. Okay, fine. That means selling price is same only. Same only. Variable cost is same only. Same only. Based on this, contribution is same only. 60 rupees only. Number of units is same only. Same only. Based on that, can I calculate cash flow after tax? Present value is same only. Same only. Wait. Fixed cost is changing. How much is fixed cost? I don't know. Fixed cost is x. Simple. Okay. So I'm telling contribution will be same only. Fixed cost I don't know. Fixed cost I took it as x. So I'll get cash flow after tax 12 lakh minus x. Similarly for 3 years. I have to bring it to present value terms. I will get my present value of cash inflow. Yes, NPV should become 0. Present value of cash inflow minus present value of cash outflow. Find out the value of x. X is 7,76,000. That means right now my fixed cost is 5 lakh. Even if it becomes 7,76,388, I am okay. Is this clear, everyone? Simple only. If I want for everything, I can give you formula. Okay? Then the nightmare will start. Yes, which one you should do. Here till now I have not even touched a single formula. The only thing I am doing is cross multiplication I am doing, percentage change I am doing, change divided by original value. That's all. Okay, fine. Number of units. Number of units is going to change. Here again, yes, just remember one thing. Yes, selling price is changing. No, boss, same only. Variable cost is changing. No, boss. Means contribution is changing. No, boss. Fixed cost is changing. No, boss. Discount rate is changing. No, boss. Initial investment is changing. No, boss. Only number of units is changing. Now understand, number of units are changing. How much my number of units is? I could have directly taken as x, but understand the problem. Every year number of units is different. That means if my number of units, yes, my number of units is in which ratio? First year if I am selling 20,000 means next year I am selling 30,000, third year also I am selling 30,000. It is in the ratio of 2:3:3. Yes, I will give x only, but based on this ratio I will give. So I will tell, okay boss, first year I am selling 2x means second year I will sell 3x, third year I will sell 3x. Based on this I will make my NPV 0. Is this clear? This is the only point I should be incorporating. As simple as that. Look at this. Yes, original number of units is 20,000, 30,000, 30,000. Yes, number of units will reduce, but it will reduce proportionately only. That means revised number of units also will be in this ratio only, 2:3:3. How much it will be? Let us assume 2x, 3x, 3x. Sir, we can simplify this further, sir. I can make it x, 1.5x, 1.5x. Now, even if you do, ultimately you will use calculator only. Now, why you want to do all those things? Okay, finish it off. Now, contribution per unit is this. Number of units, 2x, 3x, 3x. It gives me my total contribution. From that, reduce your fixed cost. You will arrive at cash flow after tax into present value factor. You will get present value of cash inflow minus present value of cash outflow. You will get NPV. NPV should become 0. Find out the value of X. X is going to be 8,253. Is this clear, everyone? Based on that, I can calculate the revised number of units. First year was 2x, so it is 2 into 8,253. Yes, second year is 3x, that means it is this much. Third year is this much, that means the revised total number of units is going to be 66,024. Okay, originally I thought that I should be selling 30, 60, 80,000, but if I sell 66,024 units also, I will be okay. That means how much percentage fall is okay for me? Yes, 17.43% fall is okay for me. Is this clear, everyone? Yes, or else here if you want, you can simplify this if you want. Understand? Yes, revised value of X I got it as 8,253. That means I will take for any 1 year. Tell me, first year revised units is going to be 2x, which is going to be how much? 16,506. First year I originally thought 20,000 I should be selling, but I am telling boss, even if I sell 16,506, it is okay. That means how much reduction is okay for me? 3,494 reduction on 20,000. How much percent reduction? 17.43. Same ratio only I have taken, na, should be same only. Is this clear, everyone? As simple as that. Yes. Then life of the project, that I have already explained, discounted payback period I want. Okay, finish. Yes, which method I have to follow? Yes, question will tell. Even if question tells anything, IC is giving both the answer for every question, and your final decision is going to be same only. Okay, as per both the approaches. Is this clear, everyone? Okay, wow. Yes or no? From morning till now, whatever we have done, quickly takka in 2-3 minutes we will summarize. Then we will take a good amount of lunch break because we have to come back. How much maja is there now left? Statistical techniques is there. Advanced. Name only is advanced. Okay. Advanced capital budgeting. Only name was advanced. Till now what we did was all JGB only. Sensitivity, some amount was there. Afternoon. Statistical. JGB only. Unless you decide to complicate it. Unless you decide to tell Hertz model, Hilliard's model, that, this. Keep it simple. Okay. Aram se, without any problem, we'll finish it off. Okay. Fine. Let us summarize. Don't worry. Okay. So let us start from scratch. So first we told present value, future value. I am going front means include interest into 1 plus interest. I am coming back, eliminate interest divided by 1 plus interest. Okay. Yes. Interest rate is same. I am going front. I can directly do into 1 plus interest rate to the power of n. Directly I can do. But interest rates are different means every year separately I should keep doing. Coming back also, interest rate is same means stuck I can come back, or else every year by year, I should keep coming back over. As simple as that. Yes, based on that. NPV calculation. 3 different cash flows are there. First one is initial investment at 0. Then cash inflow during the life. Then terminal value. Yes, every cash flow I will bring to present value terms. NPV is present value of cash inflow minus present value of cash outflow. Yes, first present value of cash outflow or initial investment. Yes, cost to purchase asset plus installation miscellaneous cost minus subsidy if any I get. Okay, cash inflow during the life for every year. What is the sales minus whatever is the cost, variable cost, fixed cost, operating cost, whatever it is. Yes, I will get my EBITDA minus from that depreciation. I will get my EBIT, earnings before interest and tax. From that directly I will reduce tax. Why I am not reducing interest? When I am discounting, that itself is eliminating interest. Okay, boss. Yes, I will get my NOPAT. For us interest, all those things will not be there. For us directly you can use PAT also, no issues. Okay, on that I will add back depreciation non-cash. I will get my cash flow after tax. This is just a random 1 or 2 questions could be there. All this was inter, but still I have kept. Okay, terminal value. Here you have to be careful. At the end, how much cash I am getting? I sell my asset, I get cash inflow. On that, If I am having capital gain, I will pay tax. Sale value minus capital gain. I am having a capital loss. I will get a tax shield on that. So it is sale value plus this tax shield on the capital loss. Is this clear? Plus or minus capital gain tax. Don't do capital gain minus tax. That is going to be wrong. Tell to yourself what you are doing. Be careful here. Okay. Yes, here you can close your eyes and do the calculation. You will not commit a mistake. Here also you will not commit a mistake. Here you will be committing a mistake. Yes, if my sale value is more means gain, on that I will pay tax. If my sale value is less means it is loss, on that I will get a benefit on tax. Okay, cash inflow. Great, boss. This much we did. Then profitability index, it is present value of cash inflow divided by present value of cash outflow. For 1 rupee I am putting today, on today's basis how much I am getting. Okay, great. Next, internal rate of return. Actually, how much percent I am getting. How do I do? First, I will take some random rate, on that calculate NPV. NPV is a positive, means more than that I am earning. I will discount at a higher rate. I will discount at a higher rate. I will get two rates where in one NPV is positive, one NPV is negative. Okay, ideally the difference should be less. Based on that, I will do interpolation. Lower rate, how much is NPV? Yes, if my lower rate, what is the discount rate? Plus, if I increase my discount rate by this much percent, NPV will fall by this much percent. I want to bring it to 0. That means how much percent I should increase. I will calculate my IRR. Is this clear, everyone? Okay, fine. This was the basics. Based on that, we went to concept number 1, that is risk analysis. First one is conventional techniques. Two things are there: RADR, certainty equivalent. RADR is telling, boss, my cash inflow is having risk. That means when I am discounting, at which rate I should discount? Risk adjusted rate I should discount. How do I calculate my risk adjusted rate? Risk free anyways I want, plus what is the premium in my business into how much times risk I am taking, risk index. Based on that, I will discount. Based on that, I will calculate NPV. Certainty equivalent is telling, boss, cash inflow is having risk. It is having risk. In that, how much percent is certain? So expected cash flow into certainty equivalent. I will get certain cash flow. How much is certain? How much I know pakka I will get? This is which cash flow? Certain cash flow. At which rate I will discount? Risk free rate I will discount. Over. So my certain cash flow, it is expected cash flow into certainty equivalent. Is this clear, everyone? Okay, boss. This one was there. Okay, perfect. Next, statistical techniques. Okay, basics. Yes, expectation, expected cash flow or expected NPV, summation P into X. Yes, risk variance. It is sigma X minus X bar the whole square into P. Yes, take a square root, standard deviation, coefficient of variation sigma divided by X bar into 100. Okay, boss. Sensitivity analysis we have discussed. It's detailed revision. Let us do. Sensitivity analysis, important. In this full chapter, 3 places: sensitivity analysis, statistical techniques advanced, then replacement decision. That's all, nothing else is there. In that one big part we have finished. 2 more afternoon will do. Is this clear? Okay, fine. Sensitivity analysis, one factor at a time, one girlfriend at a time. How it will move positively, negatively, adversely. Everything else is constant only. 2 different approaches are there. Approach number 1, wherein I am showing a fixed percentage change in every factor. 10% adverse change. Okay, what you are going to do? Step 1, based on existing data, you will calculate existing NPV and keep. Okay, boss. Step 2, they are telling one factor will change adversely. So I will pick one factor. Yes, I will move it adversely by that percent. Only that factor will change. Every other factor will be same only. In that situation, I will calculate the revised NPV. So for every factor, I will calculate the revised value of factor. After adverse movement, I will calculate revised NPV. Based on that, original NPV is there, revised NPV is there. I will see how much percent my NPV has changed. Where my NPV changes highest percent, that is highest risk, that is going to be most sensitive. Okay, here everything is simple only, jujube only. The only trick can come when life is given. Your life was 3 years. I want to reduce it by 10%. It reaches 2.7. I can't do. First, I will change by some other percent. Yes, I will bring 3 to 2. That is, I reduce it by 33.33%. On this, I will calculate NPV. Then I will do a cross multiplication. Okay, boss. If it reduces by 33.33% means my NPV reduced by this much percent. I want to reduce by 10% only. Na? In that case, what will happen? Is this clear? Here, simple, jujube. And any given question, you can do this, get done. Okay. Then comes margin of safety. You have to be careful. Step 1 is same only. What I am telling? Existing NPV, you will calculate. Step 2, I am telling, if my NPV becomes 0, what will be the value of factor? Only one factor is changing, everything else is changing. I am telling NPV becomes 0 means this factor's value will be how much? Then I will calculate the change, percentage change in the factor. Previously I saw the percentage change in the NPV. Here I will be saying the percentage change in the factor. Is this clear? So calculate existing NPV. For every factor, I will calculate the revised value of a factor so that my NPV becomes 0. Then I will see the percentage change in the factor. How much percent my factor has changed? Yes, whichever factor, just a small change makes NPV 0. That is the most riskiest. Lowest percent will make NPV 0. That is the most sensitive. Is this clear? Now, how do I calculate the revised value of factor? Everything together at one place. Look at this. Where all I will be having adjustment. Firstly, project life. Yes, right now my project life is 5 years. Yes, at what life my NPV becomes 0? Discounted payback period. Everything else is same. Yes, I will write down the year, how much cash flow I am getting. I will calculate the present value of cash inflow. I will calculate the cumulative present value. Yes, in between 2 years, it would have recovered my investment. So interpolation I will do. I will calculate what is going to be the project life. Is this clear, everyone? Okay. So calculate present value of cash inflow, cumulative present value. Calculate the project life at which cumulative present value of cash inflow is equal to present value of cash outflow. That is my, yes, NPV is equal to 0 just by using your interpolation technique. What happened? Okay, fine. It went out. Okay, fine. A bit outside this. Okay, done. That is one place I have to be careful. Second place is discounted rate. Right now my discount rate is 10%. At that my NPV is okay, boss, 1 lakh. At what discount rate my NPV becomes 0? What I have to calculate? IRR I have to calculate. Over. This is also over. Third one is sales volume. 3 different years sales volume is given. Yes, first year 200 units I am selling. Second year 300 units I am selling. Third year 400 units I am selling. Future sale volume will reduce, but it will be in the same ratio only. So I will give weight, based on that I will calculate. So I will take it as 2x, 3x, 4x. Based on that I will calculate the value of x. Based on that I will calculate the revised quantity. Based on that I will show the percentage change. Every other figure, take it as x. In that, selling price variable cost is there, means take a contribution as x. Everywhere else, take that factor only as x. Cash flow after tax is given, that you take as x. Investment is given, that you take as x. Everything else, yes, fixed cost, cash flow after tax, take that factor as x. And so over. Margin of safety approach is also simple. Yes, all you will have to remember is 4 points. First, project life means discounted payback period. Year, cash flow, present value, cumulative. I should do an interpolation where it is reaching. Interest rate means IRR. Next, yes, sales volume means based on the weight I will give x, 2x, 3x, 4x. Based on that I will show. Everything else is x, where if selling price variable cost means directly do contribution as x. Over. Finish. Till now whatever I have told is over. Questions are there. Questions, trust me, this what I have given is more. This much is not there even in the questions. You guys can see, and in questions anyways, even if you don't do this, completely you close your eyes, you do this also, you will find ICS alternative answer. Is this clear? The only thing is when you are doing calculation, do by yourself. By mistake also don't see how they have done. Just tally every answer you are getting or not. Because if you see their formula, tomorrow only you will say tata bye bye. Trust me, for me also sometimes I will see the formula, will become mad. Like even standard deviation formula, this much they would have written. Chumma you put a table, you will get so much, you will become depressed. Okay, so don't see solution, that's all. Okay, yes, so now the time is 2:20. How much time break you want? 10 minutes break. What? 3:20. Okay, 3:20, 1 hour plus a 10-minute bonus for you guys. 3:30 we will come back, we will continue our discussion. 3:30 will come back. 2 jujube things are there. 2 minutes. Scenario analysis, decision tree. 10 minutes will get over. Nothing is there, one question is there. After that, we'll go to advanced statistical techniques. A good amount of time will be taking. Let the things settle in. After that, replacement decision is there. That is also good. With that is over. Impact of inflation is anyways 1 or 2 minutes. Okay. Yes, we'll try finishing it off. Yes, students. Okay. 3:30. We will continue our discussion. Yes, everyone, give me a confirmation if the audio video is clear. Online students who are watching it online, give me a confirmation whether the audio video is clear. You guys can see me. You can see me. Who told here? Yeah? What the? Clear, crystal clear. Okay, great. Scenario analysis will do. Yeah. Yeah. Yes, everyone. So welcome back after the break. So we are discussing the chapter advanced capital budgeting. So what all is over? Concept 0, basics is over. Concept 1, risk analysis. In that, conventional techniques, risk adjusted discount rate. Yes, I'll be taking the risky discount rate. Certainty equivalent, I'll calculate the certain cash flows. Okay, part 1 was that. Part 2, statistical techniques, basics, expected NPV. Yes, variance, standard deviation, coefficient of variation. Okay, boss. Part 3 was my sensitivity analysis. Yes, if a factor goes adversely, one factor at a time, what is the hit I am getting? One way is, yes, a fixed percent change in every factor I am going to do, or way 2 is, yes, to make my NPV 0, how much percent change in factor is needed. Detailed way we have done. Now, we will quickly discuss scenario analysis, because based on that only I will be in a position to go for advanced statistical techniques. Decision tree also, I guess I'll have to explain. Okay, fine, no issues. Or else just whatever is needed, I'll take. Okay, fine. Scenario analysis. Now, in sensitivity analysis, what I was doing is only one factor at a time I was changing. But tell me, in a reality, is it going to be possible that only one factor will change? No, multiple factors will change together. So, in scenario analysis, we are telling, boss, multiple factors will change together. Na? So, based on that, multiple scenarios can happen. So, in those different scenarios, you calculate and tell what is going to be your NPV. Very simple. Question will give you 3 scenarios. Yes, Mr. Ranga and Amban, they started their business. Okay, 3 different scenarios could be there. Assume they invested 100 rupees. Yes, scenario number 1, business was addipoli, where level, money only money. They earned 120 rupees in the first year. Best scenario. Or most likely scenario, most likely they are telling 110 and all will earn. Worst case, they earned 90 only. For us, 3 scenarios only they will be giving, question will be giving. What is the probability of this to happen? What is the probability of this to happen? What is the probability of this to happen? Based on that, I will calculate NPV. That much only is there in this. Question will tell you, yes, best option, what all can happen. Worst option, what all can happen. Most likely case, what all can happen. Everyone's probability question will tell you. I will calculate NPV, story is over. As simple as that. GGB. Look at this. Yes, in sensitivity, I was considering only one factor change. However, in reality, multiple factors are dependent, so they can change simultaneously. So it is considered in scenario analysis. Here we will change multiple factors simultaneously, and based on that we will calculate NPV at different scenarios. So normally if a question comes, yes, normally 3 different scenarios will be given in the question. Best case what will happen, worst case what will happen, most likely case what will happen. We need to calculate the NPV and the risk for these scenarios. Look at this. Yes, Mr. A is considering investing in a project. How much a return I want? 10% I want, was. Different scenarios possible from the project. What all can happen? Worst case means initial investment will be 1250. Year 1 how much I will get? 600. Year 2 how much I will get? 650. Year 3 how much I will get? 700. Most likely what will happen is 1100 I will be putting. Yes, 700, 700, 750 I will get. Best means what may happen? Just 1000 I put, but every year 700, 800, 900 I got. This is the data. Let us see what question is telling. Calculate NPV of the best case. If best case happens, what is my NPV? NPV of the worst case happens, what is my NPV? Most likely case happens, what is my NPV? Here only let me do. Tell me best case happen. Yeah, Maja is coming. Tell me, yes, what is the best case? Last one is the best case. Tell me first year, what is my discount rate? 10%. First year I got 700 rupees. I will discount at 10%. Second year I got 800 rupees. I will discount at 10% for 2 years. Third year I got 900. I will discount at 10% for 3 years. Calculate present value of cash inflows. How much you are getting? 973 minus 973. NPV is 973. Okay, great. NPV is 973. Is this clear, everyone? Okay. Yes, numbers I would have put here. Yes. Most likely case, most probably what will happen? First year 700 I will get into present value factor. Second year 700 I will get into present value factor. Third year also 750 I will get into present value factor. Minus initial investment 1100. How much I will be getting? 678 I will be getting. Worst case if it happens. First year I am getting 600 into present value factor. Second year I am getting 650 into present value factor. Third year total present value of cash inflows minus initial investment. Yes, 3 different situations. NPV I calculated. Over. Difficult. What difficult? Over. Yes. Now next, expected NPV. These are all in different situations. What may happen? Expected NPV. If a probability of worst, most likely and best case is 0.25, 0.5, 0.5. Probability is given. Can I calculate expectation? Tell me worst case 25% chance. Yes, most likely 50% chance, best 25% chance. So 358 into 0.25, 678 into 0.5, 973 into 0.25. What is going to be the expected NPV? 671.75 is going to be the expected NPV. Now based on this, if they ask you to calculate risk in NPV also, I can calculate, because every situation NPV I know, probability I know, P into X I know, X minus X bar, P into X minus X bar the whole square. I got variance, take a square root, you got the standard deviation. I don't know if they are asking that. Okay, let us see what question is. If Mr. A is certain about most likely result for first 2 years, he is telling first 2 years most likely will only happen. That means tell me first year, he is telling first year this only I will get, I know. Second year what I will get? Most likely only I will get. Third year what will happen? He is telling, but it is uncertain about third year. Third year I don't know what may happen. Analyze what will be the NPV expecting worst scenario in third year. He is telling third year worst will happen. That means third year worst how much I will be getting? 700. Yes, what will be the NPV assuming investment is 1100 rupees? Tell me first year how much I am getting? 700 into 0.909. Second year 700 into 0.826. Third year it's going to be worst 700 into 0.751. Yes, minus how much investment I told in this case? 1100. Tell me what is going to be my NPV? 640 over Juju B. Look at this statistical techniques. This sensitivity questions I am not touching. You guys can see same only, nothing is there in that. Scenario analysis, one question is there. Yes, project A is there, initial outlay is 14 lakh. Possible 3 inflow attached to the project. Worst case means I may get 450, 400, 700. Most likely this I may get. Best case this I may get. Assuming cost of capital is 9%. Determine NPV in each scenario. Can I do? Worst case what will happen? Most likely what will happen? Best case what will happen? If XYZ Limited is certain that most likely result will come in first 2 years. First year most likely, second year also most likely, but is uncertain about third year cash flow. Analyze what will be NPV expecting worst scenario, worst. Can I calculate? Over. Scenario analysis over. Finish, that's all. Is this clear, everyone? Okay, fine. Next we are having decision tree analysis. I will not touch decision tree now. Then if we have time, we'll see. One Jujube example is there. But here one small point I want, that is the concept of joint probability, which is probability into probability. You guys might be knowing, but still 2 minutes I'll take. Look at this, everyone. Yes. I am having a coin with me. I am tossing. What all can come? Head also can come, tail also may come. I am tossing again. What may come? Head also may come, tail also may come. Yes or no? So look at this. I am tossing a coin 2 times. First time there is a 50% chance head may come. There is a 50% chance tail may come. Yes, assume first time head came. Next time I am tossing. What can happen? Again head may come, tail may come. Head may also come, tail may also come. 50% chance head may come, 50% chance tail may come. Okay, first time tail I got. Next time I am tossing. What will happen? Anything will happen. Head also may come, tail also may come. Is this clear? That means overall tell me what all possibilities can be there. I am tossing either head or head tail or tail head or tail tail. overall 4 situations can come. Anything can be equally likely. Tell me, overall 4 situations are there. Tell me what is the probability of each of these outcome. 25% each. Head 25%, head tail 25%, tail head 25%, tail 25%. Is this clear? Now how did I get that? Look at this, using this, because next technique I will be using this chart for me to get the probability. Look at this. First time probability of getting a head 50%. Second time probability of getting a head again is 50%. So yes, head as well as head. 2 days back I told you, and means into I am going to do 0.5 into 0.5, 0.25. Is this clear? So overall what all can happen? Look at this. Either I can get head head, head tail, tail head, tail tail. Probability of this is 0.5. Look at this. I will show the different path. Yes, path number 1, which is head head. Path number 2 is head tail. Path number 3 is tail head. Path number 4 is tail tail. What is the probability? What is the probability of first head? 0.5. Next head 0.5. So joint probability, it is 0.5 into 0.5. Sir, why you are wasting time, sir? This only is there in next concept, nothing else is there. Okay. Next, head tail. First probability is 0.5, next one is 0.5. So head into tail, it is going to be 0.5 into 0.5, 0.25. Tail head, yes, 0.5 into 0.5. Again, it is going to be 0.25. Tail 0.5 into 0.5, again it is going to be 0.25. Is this clear, everyone? Okay, great. Now look at this very simple example. I started a business. At t is equal to 0, I put 1 lakh rupees. What all I can get? First year, it could be possible I might get 60,000, or I can get 50,000 also. Who knows? Certainty is not there. Okay, boss. I am asking, what is the probability that I will get 60,000? 40%. What is the probability I will get 50,000? 60%. Okay. Second year, what can happen? First year, if first year is good, na, I am telling second year also will be good only. That is, first year if I get 60,000, second year either I can get 50,000 or 60,000 or 70,000. If first year is bad, na, 50,000, second year also will be a bit bad only. Either I can get 40, 60, 65. Tell me, overall what all can happen? I put 1 lakh in business. What all can happen? Option number 1, I am getting 60,000, 50,000. Option number 2, I am getting 60, 60. Option number 3, I am getting 60, 70. Option number 4, I am getting 50, 40. Option number 5, I am getting 50, 60. Option number 6, I am getting 50, 65. Okay, 6 different options are there, 6 different cash flows I can be having. What is the probability? Tell me. Yes, first path, this. Yes, it is a 0.4 into 0.3, which is going to be how much? 0.12. Second path, 60, 60, 0.4 into 0.5, which is going to be 0.2. Third path, 60, 70, 0.4 into 0.2, which is going to be 0.08. Yes, next, 50, 40, 0.6 into 0.25, how much it is? 0.15. Next, 50, 60, 0.6 into 0.4, how much it is going to be? 0.24. Next is 50, 65, 0.6 into 0.35, how much it is going to be? 0.21. Should I show a magic for you guys? Take out your calculator. 0.12 plus 0.2 plus 0.08 plus 0.15 plus 0.24 plus 0.21 equal to my God, what is this? Da magic ada allada bandu say logic ada. Third standard. So much and all we did without touching formula. What was this? Okay, probability into probability. But this I will be using. Okay, I am not explaining decision tree right now. One example is there. Okay, that only I have put here. That only is there in study material. So study material has copied your example, sir. That was there, I put here. Okay, simple. If we get time, we'll explain. Don't worry. Now, based on this, where it went? Okay, this is over. Ahaha. La 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 la. Maja is coming. First page, second page, 2 page summary. Okay. Now understand statistical techniques I am doing. Okay. Basics I have done. I know how to calculate the expected NPV. I know how to calculate the risk if NPV is given for me. If cash flow is given for me, the risk is going to be of cash flow. Based on net coefficient of variation, basic things I have done. Okay, that is if NPV is directly given. Question is directly telling me NPV, I know how to do. But now question is not giving me NPV. Question is giving me different year what all cash flows can be there. Based on that, I have to do. Okay, yes, get ready for the maja. Half an hour. We will make it jujube. Okay, that much time you should give to understand, or else look at study material. Okay, yes, simple. Now first I have to understand my cash flows. Cash flows can be three different types. Either it is perfectly independent cash flows, or it is a perfectly dependent cash flows, or it is a moderately dependent cash flows. Which all cash flows can be there? Perfectly independent, perfectly dependent, moderately dependent. Yes, I'll give you simple examples to understand. Three friends are there. Okay, A, B, C. They decide to go on a trip. Or else a simple example I'll take. Okay, Sebi is there. Okay, Sebi's X is there. Okay, Santosh is there. Okay, they decided we are going for a trip. Yes, Sebi is telling, if my X comes, only then I will come. He going on a trip is completely dependent on whom? On his X. What is this? Perfectly dependent. If this happens, only then I'll come. Okay, yes. Sebi is telling, I want to go on a trip. X, whether she comes, she doesn't come. She comes with her boyfriend, whoever it is. I will go on the trip. What is that? Perfectly independent. Happens, does not happen. However it happens, I am going on a trip. Perfectly independent. Yes. Next comes moderately dependent. Yes, it is a dependent, but moderately. Yes, dependency is there, but not full dependency. Okay? Yes, okay. If X comes, without boyfriend she comes, then we will think. Chance is there. Window is still open. Okay, simple. Okay, dependent, independent, perfectly independent is clear. Perfectly dependent. If this happens, only then we will do. Independent, whatever happens, we will do. Is this clear? Okay, simple. Yes, Sebi is telling, I am deciding to marry. Whom? If I get my X, only then I will marry. If she is there, I am going to marry. Otherwise, I will not marry. I will remain, what is that? Brahmachari. What is that? Perfectly dependent. Yes or no? These thoughts are good till 18 years. Then perfectly independent. Okay, people will come, people will go. If you have to marry, means whoever you will get, you will marry. Perfectly independent. Whoever it is there, you have to marry, you will marry. Is this clear, everyone? Okay, just giving you guys a context. Okay, now understand. You guys will have to tell me, is it perfectly dependent or perfectly independent? Moderately dependent, then will come. Okay. Rangana is there. He decided he is going to start a business. What? Ranga and Amban, juice shop. Assume they invested 10 rupees. Okay, by putting 10 rupees, what will happen? They are telling either first year, either they will be getting 10 rupees or they will be getting 12 rupees. Here don't take a decision. Now next, Ranga is telling first year, yes, this is comparatively good performance. Second year, this is comparatively bad performance. Yes, Ranga is telling first year if I get 10 rupees, first year performance is bad, means next year also it will be bad only. Next year I will get 6 rupees only. First year if it is good, means next year will also be good only. Next year I will get 10 rupees. Tell me, based on first year's cash flow, second year's cash flow is fully dependent. What happens in year 1? Based on that I will be getting year 2. What is this? This is perfectly dependent cash flow. Based on 1 year's cash flow, next year's cash flow is fully dependent. For this year's cash flow, I will be having only one cash flow in the next year. Is this clear, everyone? Okay. Perfectly dependent. Then comes perfectly independent. Rangana has put 10 rupees in the business. Year 1 can be good also, bad also. Bad means he will get 10 rupees. Good means he will be getting 12 rupees. Okay. Good. Sorry, this is bad. This is good. We told year 1 can be either I can get 10 rupees or 12 rupees. We are asking year 2 what will happen. Rangana is telling year 2, either I can get 15 rupees or I can get 20 rupees. We are telling when. Whatever happens in year 1, year 2 is fresh. We will put in efforts. Yes, year 2 is bad, doesn't matter. Year 1 is bad, doesn't matter. Year 2 fresh effort will put. Either I can get 15, 20. Year 1 is good, doesn't necessarily mean year 2 is also good. Again, we have to put efforts. Either I can get 15, 20. Tell me, irrespective of whatever happens in year 1, year 2, fresh, either it can be 15 or it can be 20. What is this? It is perfectly independent. Last year, what happened does not matter. Fresh, I am sitting, I am studying. Is this clear, everyone? Yes or no? Yes or no? Yes or no? Perfect. Yes, one more example I am telling. Yes, I gave first attempt. I failed. Assume. I am telling second attempt also pakka I will fail only. What? Perfectly dependent. If that happened, this only will happen. Yes, I gave first attempt. I failed. Next attempt. If I study, I will pass or else I will fail. Perfectly independent. I gave, I passed. Next, if I don't study, I will fail or else I will pass. Perfectly independent. Is this clear, everyone? Okay. Now look at this, look at this, look at this. Yes, perfectly dependent cash flow. For every year 1 cash flow, I will only be having 1 year 2 cash flow. Okay, 10 rupees I invested. There is a 70% chance I will get 6 rupees, 30% chance I will get 8 rupees. Okay, boss. First year if I get 6 rupees, next year I will get 5 rupees only. What is the probability? 100%. This only will happen. Okay, first year if I get 8 rupees, first year is good means. Second year also will be good only. How much I will get? 9 rupees only. This is pakka. Probability is 1. Is this clear, everyone? Perfectly dependent means for every year 1 cash flow, I will be having only 1 year 2 cash flow. Okay. Perfectly independent. Whatever happens in year 1, year 2 is fresh. Freshly I will put. Now look at this. 10 rupees I put in business. First year I can get 6 also, 8 also. Yes, first year assume I got 6 rupees. What will be second year? Second year again can be good or bad. It can be 5 also, 7 also. Assume first year is good, 8 rupees I got. What happens? Again it can be 5 also, 7 also. Is this clear? That is, yes, year 2 cash flow is not dependent on year 1. For every 1 year 1 cash flow, I will be having 2 or more year 2 cash flow. And it is not dependent. Whatever it will be same only. Is this clear? Okay. Now comes the final thing, which is a moderately dependent cash flow. Is it dependent? Dependent. But fully dependent? Not. Understand. Yes, Rangana started business. He put 10 rupees. We are asking what will happen. Rangana is telling, see, first year either performance can be bad 6 rupees or it can be good 8 rupees. Okay. Based on first year, you cannot take a decision. Next what? He is telling, see, first year if it is bad means, second year also will be bad only. But it can be anything. In bad only it can be anything. If first year is 6 rupees, second year can be 5 also, can be 7 also. Bad only, but can be 5 also, 7 also. First year is good means, 8 means. Next year can be 8 also, 9 also. Now understand, for every 1 year's cash flow, next year, am I having only 1 cash flow? I am having 2. But these 2 cash flows are dependent on year 1. Year 1 is bad means these 2 will be in the bad range only. Year 1 is good means these 2 will be in the good range only. This is going to be my moderately dependent cash flow. Is this clear? Yes, got a reasonable idea? Okay, for us, for understanding purpose. Yes, exam purpose, okay, question will tell you, by looking at that you will understand, aram se. Okay, yes, perfectly independent means what? Whatever happens in year 1, year 2, anything can happen. Perfectly dependent means what? What happened in year 1, like that only I will be having. Year 1 is bad means year 2, 1 cash flow only will be getting. Yes, moderately dependent means dependency is there. Year 1 was bad means next year will be bad only, but in that different options could be there. Is this clear? Cash flow I understood. Till here, okay. 1 minute to let the thing settle in. We will go ahead to the Maja. Okay. It is 4 o'clock, huh? Over. Okay. Yes, now understand, the only place I have to give time and understand is perfectly independent. Everywhere else logically only it will come. This is also logical only, but yes, there is a shortcut to do that. That shortcut I will have to try and explain you guys, and we will bring it together. Don't worry, simple only it is. Perfectly independent cash flow. Look at this situation. Year, yes, T is equal to 0, Rangana has put 10 rupees. Year 1, what can happen? It can be 6 also, it can be 8 also. Yes, irrespective of what happens in year 1. Year 2 can be 5 also, it can be 7 also, 60, 40, 60, 40. Perfectly independent. That means, tell me, what all can happen? Option number 1, I put 10 rupees in the business. What all cash flows I will be getting? What all cash flows I will be getting? Yes, path number 1, I will be getting 6 rupees in first year, 5 rupees in second year. What is the probability? Probability of getting 6 rupees is 0.7, 5 rupees is 0.6. So 0.7 into 0.6 is going to be how much? 4.2. Yes. Or option number 2, I might get 6 rupees and 7 rupees. Okay, 6 can be there, 7 can be there. What is the chance? 70% into 40%, 0.28. Or else it can also be 8 rupees and 5 rupees. Yes, what is the chance? Path 3, it can be 8 rupees and 5 rupees. 0.3 into 0.6, 0.18. Or it can be 8 rupees and 7 rupees. 8 rupee and 7 rupees. 0.3 into 0.4 is, you add, you will be getting 1 rupee. Okay, okay. That means altogether how much possibilities can be there? 4 possibilities can be there. In each of these 4 possibilities, can I calculate the NPV? Yes or no? These are all cash flows. Can I calculate NPV? Look at this. I am telling option number 1. Yes, assume 10% discount rate. Yes, option number 1, first year I will get 6 rupees, second year I will get 5 rupees. Tell me, yes, NPV is nothing but present value of cash inflow minus present value of cash outflow. Tell me, either it can happen that first year I will get 6 rupees into 0.909. Second year I will get 5 rupees, 0.826. I will get present value of cash inflow. Yes, how much money I should be putting? 10 rupees minus 10. Can you guys tell me what is going to be my NPV? 6 into 0.909, 5 into 0.826 minus 10. Minus 0.41. Is this clear? So similarly for each option, I will calculate NPV. Okay, 4 options are there. For 4 options, I will calculate NPV. Once that is done, bingo, story over. I know, yes, my NPV, what all it can be. Either it can be minus 0.42. Second path means it will be 1.24. Third path means 1.40. Fourth path means 3.05. What is the probability? I calculated and kept. Yes, this is my NPV. P into X. I will be getting my expected NPV. Expected NPV. Okay. Risk irka? Risk is there. I will do x minus x bar, p into x minus x bar the whole square. This is going to be the variance in NPV. I will take a square root. I will get the standard deviation of NPV. Jujube, yes or no everyone? Anything new we did? No boss. Perfectly independent. What all options can be there? In every option calculate probability. For every option calculate NPV. Then you do your thing that you are doing. P into x, x minus x bar, p into x minus x bar the whole square. Simple. Jujube. Okay. Yes. Now. Assume I am telling what all can happen. Rangana has put 10 rupees in the business. Year 1, what all can happen? Either he can get 5 rupees, or he can get 6 rupees, or he can get 7 rupees, or he can get 8 rupees. Perfectly independent. Year 1, he got 5 rupees. Year 2, again he can get 5, 6, 7, 8, 5, 6, 7, 8, 5, 6, 7, 8, 5, 6, 7, 8. Year 2, again he got. Year 3, again he can get 5, 6, 7, 8, 5, 6, 7, 8, 5, 6, 7, 8, 5, 6, 7, 8. Year 4, again he can got. How big is going to be your decision tree? First year, 4 options can happen. For every 4 options, next year, 4 more can happen. For every next year, 4 more can happen. For every next year, 4 more can happen. Altogether, 256 options can happen. What will happen? Psych. Yes or no? Is this clear? This point of view, this man is highly addictive. Please watch at your own risk. Oh, kidney touching. I hope in a good way. Till here is okay, That means if you do like this, Govinda re, Govinda will happen. That means we will now come up with an alternative. Okay, what alternative we are going to do? That is what is my shortcut. That is my Hillier's model. Simple only, jujube only. So chumma name is there. Logical only. If you know portfolio basic, how I am calculating standard deviation, that only is there here. Okay, now understand. Yes. First, what Hillier is telling is, boss, I will do one thing. Yes, for the same data I am going to put. Okay, I am not going to put this big data. If you want, you can do for big data also. No issues. Okay, for the same data that I am having here. Which one? This data I am doing. Yes, he is telling, boss, you want to calculate expected NPV as well as risk. Okay, two things separately we will do. Expected NPV. Now tell me. Expected NPV is present value of cash inflow minus present value of cash output. He is telling, don't go for path. Too much kirikiri will happen. Okay. First year, tell me how much money you are putting. Boss, first year 10 rupees I am putting. Doubted ka? Illa 10 only I am putting. Tell me first year what all I can get. 6 also I can get. 8 also I can get. Yes or no? Now what is the chance that I will get 6? 70%. What is the chance I will get 8? 30%. That means what is the expected cash I am going to get? Expected cash I am going to get. 6 into 0.7, 8 into 0.3. 6.6. Okay. Second year I can get 5 also, 7 also, perfectly independent. Yes or no? You forget all this. 60% chance I will get 60% chance I will get 5, 40% chance I will get 7, irrespective of whatever happened in year 1. So tell me second year what can happen? Yes, 0.6 into 5, 0.7, 7 into 0.4. How much it is? 5.8. Perfectly independent. Whatever happened in last year, forget it. Okay, second year. T is equal to 0, I am paying 10 rupees. T is equal to 1, I am getting 6.6. T is equal to 2, I am getting 5.8. Can I calculate NPV? Yes or no? Okay, just bring it to present value terms. 6.6 divided by 1.1. 5.8 divided by 1.1 whole square minus 10. 0.79. 0.788, 0.79. Yes or no? There is nothing new in this. Every path I took. Here I took expectation. Based on that I brought. That's all. Okay. This is nothing new. New is coming now. Okay. Yes. What Hillier told. Hillier told, macha. If you go behind path, you will keep going only. We will do one thing. I will calculate the standard deviation of cash flow. But sir, I want a standard deviation of NPV now. First we will calculate this, then we will think. Okay. Now tell me, first year, what all cash flow I can get? 6 also I can get, 8 also I can get. What is the probability? 70%, 30%. Second year, what all cash flow I can get? 5 also I can get, 7 also I can get, fully independent. Whatever happened last year, second year, 5 also I can get, 7 also I can get. 60%, 40%. Just telling, year 1, what all cash flow it will be? I will calculate expected cash flow. I will calculate the risk of cash flow. Year 2, again I will calculate the risk of cash flow. But sir, I want a standard deviation of NPV. Then we will think that, do one. Okay, we will do. What work is there? Okay. Okay, so what I am going to do, for every year's cash flow, I will calculate the expected cash flow, X bar. It is expected cash flow, P into X, where X is going to be cash flow. Okay, based on that, calculate the variance and standard deviation of cash flow. X is a cash flow, so I will be getting the risk of cash flow. Okay, boss, let us try doing it. Is this clear, everyone? Based on that, next things we will be doing. Don't worry. Okay, look at this. Application of steps. Are you guys having the chart with you? Yeah, if you want, you can quickly write down this chart. This one you guys write down and keep quickly. Year 1 can be 6 or 8, probability is 70%, 30%. Year 2 can be 5 or 7, probability is 60%, 40%. Over. Over. Okay, great. I will get into the calculation. Okay, first, for year 1 cash flow. Year 1, I didn't understand portfolio till yesterday. After watching your video, suddenly realize अरे portfolio तो easy है. The way you are simplifying chapter, mind blowing. Thank you, da. Okay, we'll speak afterwards. Now let me finish this off, or else this will be pending. Okay, don't worry. Afterwards, how much ever you flirt with me, I will be there. After 6:30. Okay, till 6:30, focus. Sebi? Okay, fine. Year 1, what all can happen? 6 rupee also can be my cash flow. Cash flow, cash flow, cash flow, cash flow. I am doing for cash flow. Okay. 8 rupee also can be my cash flow. What is the percentage? 70%, 30%. So can I calculate expected cash flow? Yes, 6 into 0.7 is 4.2. 8 into 0.3 is 2.4. That means my expected cash flow is 6.6. Riskier ka? Riskier ka, boss. Yes, my expected cash flow is 6.6. But if I get 6, 0.6 less. If I get 8, 1.4 more. So I got x minus x bar. I will do p into x minus x bar the whole square. I got the variance. Now. 6.6. What is this? Who is your x? Cash flow is my x here. That means this is expected cash flow. This is the variance of cash flow. If I take a square root, it is the standard deviation of cash flow. Okay. Okay, boss. Great. Year 1 I did. Year 2 is also there. Who will do? We only should do. Year 2 I went. Year 2 what all can be there? Whatever happened in year 1. Year 2 what all can happen? Either it can be 5 or it can be 7. Probability of it being 5, 60%. Probability of it being 7 is going to be 40%. So I can do p into x. Yes, 5 into 0.6, 7 into 0.4. I am getting 5.8. Now, who is your x? Who is your x? Do not forget who your x is. Cash flow is my x. Yes, second year I am expecting 5.8 cash flow. But is it certain? Oh, boss, risk. So if it is 5 means 5 minus 5.8 is minus 0.8. Yes, if it is 7 means 7 minus 5.8 is whatever it is. Yes, x minus x bar the whole square into p. You do. Yes, variance you will get. Who is your x? Cash flow is my x. That means I will get the expected cash flow. I will get the variance of cash flow. I am writing sigma square of cash flow. I will get the standard deviation of cash flow. Till here I have done. Till here is okay, va? Anything new I did? Nothing. Forget path based approach. That I will not be doing. 4 years into 4. Para will go. I am telling simple, boss. Every year I will see. Every year cash flow will be given. For that year cash flow, I will see expected cash flow. For that year, I will see variance of cash flow. For that year, I will see standard deviation of cash flow. Next year, I will do. Next year, I will do. Next year, I will do. 4 years are there. 4 times I will do calculation. Okay. Okay, boss. Now, for project as a whole, now comes for the full project. I want to calculate expected NPV. I told you how to calculate expected NPV. Tell me, stat of the project, I am going to put 10 rupees. First year, how much cash flow I am expecting I will get? I calculated x bar for first year. Second year, how much x bar I calculated? I got the value. Based on this, can I calculate NPV of the project? Yes, boss. Anything new in this? Till now, nothing new I did. Understand? Till now, nothing new I did. If cash flow was given to you, probability was given to you, you calculate expected cash flow, you calculate variance as well as standard deviation of cash flow. Here 4 years are given. For 4 years you do. Now for NPV for project as a whole, yes, you know the initial investment, every year's expected cash flow, you know, you bring to present value. Till now, nothing new I did. New is coming now. Giving you guys a minute to let the things settle in, then we'll go to the Maja. Actually, I didn't catch your language accent fastly. Still I manage. Love you from Maharashtra. I have so many different accents depending on where I am teaching. If I come to Maharashtra, yes, Marathi accent में भी बात कर सकते हैं. Yes, now the only language that I don't know, okay, Tamil konja I know, okay, Telugu I don't know, Kannada I know because I am from Karnataka, Malayalam I've learnt, Hindi I know, English I know, okay, mainstream languages, the only language I don't know is Tamil as well as Telugu. Sebi, it is very important to learn the language. 2 reasons. Firstly, you don't know who your future X is going to be. Okay. Secondly, you don't know who your future hater is going to be. What? Is it? Ah. Okay. Oh, for that purpose. Ah. Okay. So, yes, a suggestion for people who are in the chat, if you are putting scoldings in the chat, put in Telugu or Tamil. But there is a speciality. Scoldings we understand quickly. There is a feel in scolding. This NPV, feel is there. Even though you don't understand, you understand, is scolding. Pakka. This is for mother. This is for father. This is for wife. This is for me only. Understand? Just looking at that, understand. That's a beauty. Okay. Ek number, badhiya. Okay, done. Flirting afterwards, Swapnil. Focus. Hot water is there outside. That switch is on. You don't know. What the outside that water tank is there, na? Switch is there to. Yeah, check and come quickly. Quickly. Or else this will go away quickly. Okay. Afterwards we will do. For now, till the time I finish up this concept, okay, water is there, energy is there. Ready? Great. Now understand, I want to calculate variance for project as a whole. Understand the very simple point, students. T is equal to 0, T is equal to 1, T is equal to 2. What did I calculate? I have calculated the risk of cash flow. Tell me first year risk of cash flow. First year risk of cash flow in terms of standard deviation is how much? 0.9165. Okay. Second year risk of cash flow is how much? 0.9798. 0.9798. This is the risk of cash flow. I want the risk in NPV. What is the risk in NPV? My cash flow is changing, that is only changing my NPV. But this cash flow is here in year 1. This risk of cash flow is in year 2. But NPV is where? Where is NPV standing? NPV is standing here. I am NPV. This risk only. But where I have to bring? To 0 I have to bring. 1 period back I am bringing into present value factor. 2 period back I am bringing into present value factor. Yes or no? Yes or no? Yes or no? No. Why no? Because this is standard deviation. Tell me. Risk. Risk is what? Risk is variance. That means here also what I should take? Variance I should take. So that means it is going to be sigma cash flow 1 square into, I am going to bring it to present value. Now tell me, yes, when this is in terms of square, present value factor also should be how? In terms of square only. Is this clear? Square terms. I can also write sigma cash flow 1 into present value factor 1 whole square. Yes, here second year it is there. Risk is what? Standard deviation. Risk is variance, boss. I want to bring where? To present value terms. So I will tell it is sigma cash flow 2 square into present value factor 2 square. Or I can also write whole square. Over. This much only was there. Calculate. We'll see. Don't worry, explanation is not over. Tell me it is 0.9165 into, is it 0.909 whole square plus 0.9798 into 0.826 whole square. Tell me what is going to be the variance in NPV square terms. I am going to get variance 1.35. I want standard deviation square root. How much? 1.16. First time I did logically 1.35, 1.16. What is this da? Magic da? Allada mandu say. Logic da. Over. This much only. Okay. Simple. Cash flow means cash flow. NPV means NPV. So many options are there. What I will do? I will first not go into calculating NPV. So much will come. I will first go to cash flow. First year, what all cash flow can happen? Okay, boss, this all can happen. X. Based on that, into P. Expected cash flow I will get. X minus X bar, P into X minus X bar, the whole square. I will get variance in cash flow. I will get standard deviation of cash flow. For year 1 I got, year 2, how much ever year is there, I will do. Okay, boss. Year 1 cash flow I know, it's risk I know. Year 2 cash flow I know, it's risk I know. Now, based on that, I have to calculate first NPV of project. I know initial investment, every year's expected cash flow I know. I will bring to present value. Over. Now, every year's cash flows risk I know. I want risk in NPV. That means I have to bring to present value. That only I have to do. But boss, risk is always what? Variance. That means it should be in which terms? Square terms. Over. That is why it is going to be square. So it is sigma cash flow 1 into PVF1 whole square plus sigma cash flow 2 plus into PVF2 whole square, so on and so forth. Is this clear? Okay, va? Yes. So look at this steps. Okay. One more maja element is to be inserted. Don't worry. We'll tell you. Okay. For every year, step 1, for every year cash flow. Yes. X is going to be cash flow. Step 1, I will calculate expected cash flow. Okay. Step 2, I will calculate variance and standard deviation of cash flow. Okay, boss. Based on that, okay, for project as a whole, first I will calculate expected NPV. Every year's expected cash flow is there. I will bring to present value factor minus initial investment. Now, every year's risk of cash flow is there. I will bring to present value because I want risk in NPV. But boss, risk is always in square terms. So it is sigma cash flow square into present value factor square. Sigma cash flow 2 square into present value factor 2 square. Over, story over. Is this clear, everyone? This much only is model. Okay, but I would like to take 1 minute. Okay, to get some maja. Okay. Sir, PVF square we should do, we got to feel, but still something is missing, sir. Don't worry, we'll do that. Now tell me. Portfolio management. 2 securities I'm having. Okay, these values let it be there. 2 securities I'm having. I want to calculate a risk of a portfolio. A plus B whole square is equal to A square plus B square plus 2AB. Here I should be giving the impact of correlation. Okay, great. Now tell me. Yes, I am having in place of A. Yes, I am having sigma cash flow 1 into present value factor 1. Yes, in place of B, I am having sigma cash flow 2 into present value factor 2. To write that is a bit difficult. Yes or no? Normally, I am telling, see, yes, if my returns is there, yes, you take a weighted average, you will be getting. Risk is there, okay, you do that, you should be getting the risk. Yes or no? But risk is always going to be in square terms. So it is going to be sigma cash flow 1 into PVF 1 plus, I am going to write B only square. It is going to be A square. When I am telling A square, what is A? It is sigma cash flow 1 into PVF 1 square. That only I wrote. Plus B square, what? Sigma cash flow 2 into PVF 2 square. Plus 2AB, 2 into sigma cash flow 1 into PVF 1 into sigma cash flow 2 into PVF 2 into correlation between cash flow of year 1 and year 2. What kind of cash flow this is? Independent. Whatever happens in year 1, year 2 relationship irka? Illa. This is what? 0. This segment is what? 0. What I am getting? A square plus B square. That is why I am putting that. La 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 la. Maja has come now. Is this clear, everyone? Okay. This much only is perfectly independent. This was a difficult. Next to nothing is there. Path based only I am going to do. Is this clear? This only is Hillier's approach. Okay. Yes. Let us make it simple. Look at this. Perfectly independent cash flow. Bringing all the things together. Perfectly independent cash flow. Whatever happened in year 1, year 2, relationship irka? Relationship illa. Now, how do I calculate the expected NPV risk of my NPV? Either path based you can do, you will get, but it will take years together. So what I am doing? I am doing based on cash flow. Every year cash flow I will take. Every year cash flow X, every year's expected cash flow X, P into X. Risk in cash flow X minus X bar, P into X minus X bar the whole square. That is a variance in cash flow. I will get standard deviation of cash flow. For year 1 I got, for year 2, how much years is there? That I will do. Over. Now, for project as a whole, firstly I have to calculate expected NPV. Initial investment question has given. Every year how much cash flow I am expecting, X bar I know, I will bring to present value. Over. Now, I have to calculate the risk of NPV, the risk in NPV. What I am telling, boss, every year cash flows risk I know. I want a risk of NPV. Where is NPV standing? At 0. That means I have to bring where? To present value terms. So, it is going to be sigma cash flow 1 into present value factor 1 plus sigma cash flow 2 into present value factor 2. But boss, risk is what? Variance. That means it should be in square terms. Story over. Is this clear, everyone? Yes or no? Okay, great. Maja has come. So, this much only. I told you, portfolio is going to be the base. Okay. Yes, to be very frank, yes, one of the most technical chapters is portfolio. Forex is jujube actually. Forex, full Forex will get over just in cross multiplication. That only is there, nothing is there. Portfolio means you have to understand what is their objective, why they are doing. Yes, in their line of thought only we should think. I cannot keep changing. So, we should get adapted to their line of thought. Okay. Yes. Great. Okay, fine. Let things settle in. You guys want to do a calculation with a simple number to get confidence in this one? Okay, we will do it. Taka will do. Numbers will keep it simple. Okay. Yes, 3 years we will take. Okay, boss, what all can happen? Look at this. T is equal to 0, I am putting 100 rupees. Yes, T is equal to 1. What all can happen? T is equal to 1. Yes, either I can be getting, say for example, 50 rupees or I can be getting, say for example, 70 rupees. Probability 70%, 30%. Okay. Now, irrespective of whatever happened in year 1, year 2 is fully independent. Yes, or else I will take 3. Yes, keep at least some Maja, or else will it be taking more time? 3 years I have to do. We'll do it. What is the time? 4:30. Okay, fine. Yes, either I can get 70, 80, 90, 0.4, 0.3, 0.3. Yes, whatever I get in year 1, year 2 again I can get 50, 60, 70, 0.4, 0.3, 0.3. This only will repeat. I am not putting it again. Okay, this is going to be my year 2 cash flow, fully independent this is. Okay, this is going to be based on this. Whatever happened in year 2, year 3, I will be getting, say for example, 100, 120, 150. Say for example, 0.4, 0.3, 0.3. Now, in reality, if you go based on path based approach, first year 3 into second year 3 into third year 3, 3 into 3 into 3, 27 times I have to calculate NPV. I will be calculating one time only. Okay, how am I doing? What I should go based on cash flow, slowly 1 year at a time. numbers you are having? Okay, boss. Firstly, I am going for year 1. Yes, my cash flow is X. If you want, you write and keep for yourself. Yes, first year what all cash flow can be there? Boss, it can be 70 also, 80 also, 90 also. 70 also, 80 also, 90 also. What is the probability da? 40%, 30%, 30%. Can I do P into X? Will I be getting the expected cash flow? Expected cash flow. How much is it? How much? 79. Okay. Now I can calculate risk in cash flow. X minus X bar. P into X minus X bar the whole square. X minus X bar. 70 minus 79 is minus 9. This is 1. This is, I guess, 11. Do P into X minus X bar the whole square properly you do and give me the variance. Last specs. What is your name in the last? Tell me. Do dab, use calculator. Santosh, 69. You are shy to tell this number, He is done and he is. This is risk, da. Tell me what is going to be standard deviation. Take a square root and tell me. 8.31. Over. Year 1 is over. Same thing I should repeat. Where all? Year 2 also, year 3 also. Okay, let me repeat for year 2. Yes, year 2. Tell me. Year 2, what all can happen? Irrespective of whatever happened in year 1, year 2 can be 50, 60, 70. 50, 60, 70. Probability is 0.4, 0.3, 0.3. Yes, tell me the expected cash flow. Tell me the expected cash flow for year 2. 59. Okay. Yes, calculate risk and tell me. 50 minus 59 is minus 9. This is 1. This is 11. Same only, na? Year 1, year 2. Santosh, how much da? 70 minus. It is going to be 59. It is going to be 69. This is going to be 8.31. Okay, year 2 also is over. No, 69.4. What is this, the Hashim? From where you got this 0.4? Santosh, correct la? Pakka. You should not miss out on 69. Should be correct. Variance. What a coincidence. Quickly. Online students, Maja is coming. Okay, year 2 is over. Year 3 again I am going. Okay, boss, Maja is coming. Year 3, what all I can get? 100, 120, 150. 100 also it can be 120, 150, na? 100, 120, 150. Okay, boss. Tell me probability is 0.4, 0.3, 0.3. Tell me what is going to be my expected cash flow. How much is it? 121. Okay. Calculate risk. 100, 121 is minus 21. It is a minus 1. Is it 29? Yes. Calculate variance. 420. 429. Okay. 9 is repeating everywhere. Pakka na 429. Santosh. You're doing na? 420 plus 9. 429. Tell me what is going to be standard deviation. Take a square root of that. How much? 0.5. 7 1. Okay, this much is over. Over. आराम से year 1, year 2, year 3. Okay, fine. Now I have to calculate for company, sorry, project as a whole. Yes. Tell me, firstly I will calculate the expected NPV of the project. Tell me, NPV is nothing but present value of cash inflow minus present value of cash outflow. Yes, discounting rate I have told. No, assume 10%. Tell me initially how much I put in the project. 100 I put in the project. Okay, boss. Tell me year 1 expectation is 79, year 2 is 59, year 3 is 121. So it is 79 into 0.909. Second year is 59 into 0.826. Third year 121 into 0.751. Yes. What is my NPV? Minus 9. 70 this much. No da. Should cover. Check once. This. My cash flow is this. Don't take this. Cash flow. That only. Minus 9 you are getting. Huh? What da? Huh? NPV. 111.49. Check one more. See, year 1 is 79. 79 into 0.909. Year 2 is 59. 59 into 0.826. Year 3 is 121. 121 into 0.751. Minus 100 I am putting. 111.49. Okay, boss. Now I have to calculate the risk variance in NPV. Always risk I am going to do in variance terms. Okay. Simple. Yes, do this drawing for you for your reference to understand. Yes, tell me what is going to be standard deviation of cash flow for year 1 is 8.31. Standard deviation of cash flow for year 2 is again 8.31. Standard deviation of cash flow for year 3 is going to be how much? 20.71. Okay, boss. This is for every year. I want risk for what? NPV. Where am I standing? 0. That means what I have to do? Bring it to present value. That means it is 8.31 into 0.909 plus 8.31 into 0.826 plus 20.71 into 0.751. But wait. Markowitz is standing. We made a promise to Markowitz. Risk is what? Always. It is always a square. Tell me. $8.31 into 0.909 into equals 8.31 into 0.826 into equals 20.71 into 0.751 into equals 0.07. Okay, that means what is going to be standard deviation of NPV, sigma NPV, it is going to be 18 point over. As simple as that. Is this clear? Just remember one simple point. Okay, whenever we do variance standard deviation, we have a habit of putting percent square. Remember, advanced capital budgeting, all calculation I am doing in terms of rupees. So don't do that. Okay, that's the only point. Is this clear, everyone? Over. This is over. Let the things settle in. After 1 minute, we'll go ahead to the next one. Next 2 things, nothing is there. Okay, 5 minutes, it will get over. This only was difficult. Sebi. Check if it is very hot. Okay. It is hot means mix. Online students. Okay, now give me a confirmation. Testing. It's fine. Perfect. Should be fine. Perfect. Over. This is only Hilliard's model. Fine. Okay. Yes. Next two situations. Nothing is there actually. Look at this. 2 minutes, it will get over. Perfectly dependent cash flow. Year 1, I put, yes, Rangana put 10 rupees in the business. Year 1 can be 6 rupee also, 8 rupees also. Year 1 is bad. Year 2 is also going to be bad only. Yes, if it is 6 rupee means it will be 5 rupee only. For every year 1 cash flow, I have only one year 2 cash flow. Yes, year 1 is good means year 2 is also good only. That means tell me, here there is no need for me to think of shortcut. Here if I want, I can create and give. There is one more Hertz model. Why chumma waste time? Total how much path I can create? 2 path I can create. 10 rupee I put, 6 and 5 I get. 10 rupee I put, 8 and 9 I get. Over. Every path you do, every path's NPV you calculate, finish off the story. Over. Is this clear everyone? Okay. Look at this. The same thing I am going to do. Perfectly dependent. Yes. Normally for us, in case of perfectly dependent, question is going to give us 3 scenarios. Best scenario, worst scenario, most likely scenario. Yes. So what we are going to do, we have to calculate the NPV for each path, each scenario. Maximum 3 path only I will be having. For each path I will calculate NPV. Step 1. Yes, X bar is nothing but my NPV. Is this clear? So X I will be taking NPV. For every path I will calculate NPV. Based on that, yes, expected NPV I will do. Okay, step 1. Step 2, my X is NPV. Yes or no? So yes, step 1 is I calculate my NPV for each path. For each path. Yes, once I get my NPV for each path in a single statement, yes, you put your X, you put the probability, you get P into X. This is the expected NPV. X minus X bar, P into X minus X bar, the whole square. You get variance. X is what? NPV. That means this is variance in what? Variance in NPV. You want standard deviation, take square root. Story over. That's all. Look at this example. Yes, first step, for every path I will calculate NPV. Maximum 3 path only for me will be there. Okay. Yes, best scenario, worst, most likely. Calculate expected NPV, sigma P into X. Calculate risk. Story over. Yes, look at this. Yes, for this case we will do takka. Okay, look at this. I am telling first year I am putting 10 rupees, boss. What all can happen? Either I may get 6 rupees, or I may get 8 rupees, or I may get 9 rupees. Yes, bad, best, most likely. Okay, year 1 is bad, 6 rupee only I got. Year 2, how much I will get? 7 I will get. How much percent certainty is there? 1, probability is 1. That only will happen, nothing else will happen. Year 3, how much I will get? 8 only I will get. That only will happen. Okay, year 1 most likely 8 means year 2 is 8, year 3 is 9. Yes, year 1 9 means this will be 10, this will be 10. Is this clear everyone? Okay, fine. So altogether how much path will be there? 3 path will be there. This is path 1, this is path 2, this is path 3. Can I calculate NPV for each of my path? Yes. So first let me calculate X, which is NPV for each of the path. Tell me if things are bad means, yes, first year I am getting 6 into 0.909. Second year I am getting 7 into 0.826. Third year I am getting 8 into 0.751. I will get my present value of cash inflow minus initial investment of 10. What is going to be my NPV? 7.225, whatever it is. Or most likely what may happen? I will get 8, 8, 9. In this case, what will be my NPV? 8 into 0.909, 8 into 0.826, 9 into 0.751 minus 10. How much you are getting? 10.64. Okay. Best case happened. 9, 10, 10 I am getting. Calculate NPV. 9 into 0.909, 10 into 0.826, 10 into 0.751 minus 10. 13.95. Okay. Yes. Individually NPV I got. I want probability. Joint probability, joint probability, joint probability. What is it? Yes, first year, worst thing happening, 30%. If this happens, next year this happening, into 1. Into 1. What is it? 0.3 only. This only I can close my eyes and write. 0.4 into 1 into 1, 0.4. 0.3 into 1 into 1, 0.3. Is this clear? So, this is going to be 0.3, 0.4, 0.3. X is there, P is there. What I will do? P into X, I will get expected NPV. Can you guys tell me the value? 10.62. Okay, I'll keep up to 2 decimals. Then I will do X minus X bar, P into X minus X bar the whole square. Calculate and tell me variance of NPV. Six point 6.73. Yeah. Okay, aram se you do, you guys, if you want you scribble and do, or aram se you do. Yes, X minus X bar here is how much? 10.62. Okay, in a hurry, do not commit a mistake in calculation. Santosh, only that variance you calculated kept, everywhere else you are not doing. What, Santosh? 6 point? Is this clear? That is variance. Standard deviation I want. 2 point? Over. For this also, if I want, I can, yes, create some other things and give. Hertz model is there. Who wants? 3 cash flow I will have. For 3 NPV I will put. I will do this calculation. Chumma, who will buy heart and keep? Okay? Yes. Over. Yes. Then comes the third situation, moderately dependent cash flow. Here what I have to do? Here there is no option. You will see what all path is there. For every path you will calculate NPV. For every path you will see the probability. Based on that you will finish off the story. Is this clear? There is no shortcut that you can do. In Hertz model for calculation of in Hillier's model for calculation of NPV, I was in a position to, yes, put the shortcut, because their R was 0, because it was independent, so it became A square plus B square. Here I cannot do. Moderately dependent. Correlation is going to be there. I have to do the entire thing. So for every path I will calculate NPV, based on that I will proceed. Is this clear, everyone? Okay, boss, great. So there is no option. I have to put a decision tree, based on that calculate. Yes. So draw a decision tree. For every path I will calculate NPV. For every path I will calculate probability. Once I get that, X NPV is ready. P joint probability is ready. P into X gives me my expected NPV. X minus X bar, P into X minus X bar the whole square gives me variance in NPV. Take a square root, standard deviation of NPV. Story over. Look at this, look at this, look at this. Okay, calculations, yes, let us not do, because chumma present value will keep doing. Look at this. Okay, yes, first 10 rupees I put in the project. What all can happen? Either I can get 6 rupees or I can get 8 rupees. Okay, if I get 6 rupees, year 1 is bad means, year 2 can be 5 also, can be 7 also. Year 2 will also be bad only, but 2 different chances could be there. Year 1 is good means, year 2 will also be good only. It can be 8 also, it can be 9 also. Is this clear? Okay, boss. That means tell me what all path can be there. What all path can be there? Path number 1, I will get 6, 5. Yes or no? What is the probability? 0.7 into 0.6. 0.28. 7, 6 are 42, na? Yes. Path number 2, I can get 6 and 7. 7 4s are 0.28. She was 1 step ahead of the time. Okay. Third path, 8 and 8. Yes, 0.21. Fourth path, 8 and 9. 0.09. Is this clear? Okay, for every path I got the values. For every path I will calculate NPV. NPV calculation, simplest thing in the world. Okay, aram se you should do, that's all. Yes, 6 is first year into PVF1. Yes, 5 is second year, bring it back 2 years minus initial investment. You will get NPV for each of these 4 paths. Okay, boss, you got NPV. Okay, once you got NPV, X NPV is there, probability is there, P into X, you will get expected NPV, X minus X bar, P into X minus X bar the whole square, you will get variance. Remember who your X is. Your X is NPV, that means my variance is of NPV, standard deviation is also of NPV. Story over, concept over. That's all. That's all, my lord. Let us revise, see question, then take a break, come back. Okay. Yes, the complete crux of statistical techniques, everything from scratch to end, basics also, advanced also. Now, statistical techniques. First, I want to know the basics. Yes, how do I calculate the expected? Yes, average. It is sigma P into X. Remember who your X is. X is cash flow, means this is expected cash flow. X is NPV, means this is expected NPV. Then I want to calculate variance. Sigma P into X minus X bar the whole square. Again, X is cash flow, means this is the variance of cash flow. X is NPV, means this is the variance of NPV. Take a square root, you will get standard deviation. Coefficient of variation, it is sigma divided by X bar into 100. Okay. Basics are over. Now, I want to calculate the expected NPV as well as the risk in NPV. Yes, point number 1. Different NPV is given in question. NPV question only gave. They only did. We have any tension to do? No, X is given to me. What I will do? X is given to me. P I will put. P into X gives me expected NPV. X minus X bar the whole square into P. Variance I got, square root I got, over. Yes. Now comes other situations. NPV is not given in the question. Cash flow they gave. 3 different situations. Perfectly independent, perfectly dependent, moderately dependent. Now, if question does not tell anything, my default assumption is always perfectly independent. Is this clear? Perfectly independent, I have to be careful. Everything else is just path based only. Okay. Perfectly independent. In perfectly independent, what am I doing? Am I going to touch the path? No. I will look at the cash flow. Every year cash flow I will see. Here my X is going to be initially the cash flow. Okay. Every year what all cash flow can be there? That is X. Probability is given P. P into X, that gives me the expected cash flow. X minus X bar, P into X minus X bar the whole square, that gives me the variance in the cash flow. Take a square root, I will get standard deviation of cash flow. Year 1 I got, year 2 I got, how much ever year is there, I got it. Okay. For every year's cash flow, I will calculate expected cash flow, I will calculate risk in the cash flow. Here my X is going to be cash flow. Once this is done, this Ramayana is done. Now for project as a whole, what all I want? I want NPV as well as standard deviation. Okay, boss. NPV, simplest thing in the world. I know my initial investment, how much I'm paying. Every year's expected cash flow I know. Bring to present value. You got the expected NPV. Okay, boss. Sigma P into X. Sorry, this I have written wrong. NPV, present value of cash inflows minus present value of cash outflow. I was checking you guys are alert or not. Okay. Midnight 5 AM something happened, I guess. Okay. Now, this is expected NPV. Now, I want to calculate the risk in NPV. Simple. You just have to draw this line. I know sigma cash flow 1. I know sigma cash flow 2. I know sigma cash flow 3. I want risk in what? I want risk in NPV. Where am I standing? Here I am standing. That means this has to come here, present value. So, it is sigma cash flow 1 into present value factor 1 plus sigma cash flow 2 into present value factor 2 plus so on. But boss, a promise was made to whom? To Markowitz. Hey, who told the standard deviation? Variance who taught you? He did systematic, unsystematic. Don't forget the root. First, all problems started because Markowitz had no problem. 2 people who created problem. Newton, because apple fell. Markowitz, because he saw risk. Just that people have only ruined Newton by telling, okay, Newton, apple fell, because on his head apple did not fall. Economics fell, statistics fell. Okay. Yes, so it is always going to be in square terms. Story over. perfectly independent cash flow. Okay, boss, great. Standard deviation, take a square root of variance. Sir, other cases, sir, perfectly dependent, moderately dependent, path based only I am going to do. Okay, perfectly dependent means what? Year one of the three things will happen. Perfectly dependent. Year one, if this happens, means year two, this only will happen. Year three, this only will happen. For every year one cash flow, I will be having only one year two cash flow. So maximum three path will be there. For every path, I will calculate NPV, X. For every path, I will calculate probability. Probability is that year one probability only. I will do P into X. I will get the expected NPV. X minus X bar, P into X minus X bar the whole square. I will get variance in NPV. Here X is my NPV. Take a square root. I will get standard deviation of NPV. Okay. Then comes moderately dependent cash flow. Year one, these two things can happen. If year one is bad, means year two will also be bad only, but one of the two to three things can happen. No option available, path based only I should be doing. So first I will see which all path is there. For every path I will calculate NPV, X. For every path I will calculate probability, P. P into X. X minus X bar, P into X minus X bar the whole square. I will get variance in NPV, take a square root, I will be getting the standard deviation. Concept over. Is this clear, everyone? Okay, great. This much efforts we have put. If you don't see the question, I will not be touching the question and no point. So we should see the question and then go for a break. Okay. Okay, now. If you tell no, I will not do. We'll see the question, because for us to read and understand exactly what it is, okay, yes, a bit of help would be needed. Okay, advanced. If you see this heading, I have put perfectly independent and all of that. So you will do that, but in the exam they will not put the capital budgeting, perfectly independent cash flow, take cash flow. Here, yes. Look at this. Don't worry, once this is over, we'll give you guys a break. Yes. Skylark Airways is planning to acquire light commercial aircraft for flying 50 lakh. I'm going to put in the business. Okay, put the expected cash flow after tax for the next 3 years is as follows. Year 1, what all can happen? Year 1, I can get 14 lakh also, 18 also, 25 also, 40 also. All these probabilities there. Year 2, what all can happen? It can be 15 also, 20 also, 32 also, 45 also. Yes, their probability is given. Year 3, what can happen? Anything can happen. 18 also, 25 also, 35 also, 48 also. Okay. Yes, company wishes to take into consideration all possible risk factors relating to airline. Yes, calculate the expected NPV of this venture, assuming independent probability distribution. Independent, what? Perfectly independent. Even if this was not given, I would have still done based on what? Perfectly independent. Why? Because I have put the heading, Mandu sir. Why? Nothing is given, my default assumption is independent. Year 1 doesn't impact year 2. Is this clear? Now, they have asked me to calculate expected NPV. Two ways are there. If I want to understand, yes, I am going to put 50 lakh. First year, what all things can happen? 1, 2, 3, 4. 1, 2, 3, 4. For every one of year 1, again 4 more things can happen. Yes or no? Here, assume I got 14 lakh. Year 2, what can happen? Anything can happen. 4 more things can happen. Yes, year 2, anything happen. Third year, anything can happen. So altogether, if you want to do based on path 4 into 4 into 4, 16, 30, 48, 64. 64 path will be there. Okay, yes, you have to spend some time to understand exactly what you have to do, boss. Simple. Yes, I am putting 50 lakh here. Year 1, how much is the expected cash flow? Can I calculate, boss? Year 1, 14 lakh, there is a 10% chance. 18 lakh, there is a 20% chance. 25 lakh, there is a 40% chance. 40 lakh, there is a 30% chance. Don't do the numbers. I will get expected cash flow. Year 2, I will get expected cash flow. Year 3, I will get expected cash flow. Bring to present value. You will get expected NPV. Is this clear? Over. Next, possible deviation in the expected value. Standard deviation of NPV. Okay, that means chumma if I do this much here, it is not sufficient. Every year separately I should take. Year 1, I will be taking cash flow. Year 1, X, P into X, X minus X bar, P into X minus X bar the whole square. Same for year 2, same for year 3. For every year, I will calculate expected cash flow, risk in cash flow, variance in cash flow, standard deviation of cash flow. Tell to yourself what you are doing. Okay, based on that, calculate expected NPV of the project. Yes, when you are doing, yes, risk means 3 years is there. I know sigma CF1, sigma CF2, sigma CF3. I want a risk here. I will bring to present value, but a promise was made to Markowitz. What? Square terms I am going to do. Over. Story over. Is this clear, everyone? Yes. What would standard deviation of present value distribution? How it will help in capital budgeting decision? It will tell me how much risk is there, how much up or down will happen. That only it will help. Is this clear, everyone? Okay, boss. Go ahead. Okay, great. Yes. One simple suggestion. Don't see ICA solution. Number you tally. Okay, if you see, why, yes, so many of us have that habit that who will keep doing the numbers. I will see ICA solution. Okay. If you see like that, not okay. Next day you will be in mental hospital. Because standard deviation also they write formula. Okay, this minus this into square into P. But that also they will write. So much headache they will do and give to. Because if they make it simple, people will understand looking at study material. Study material was designed so that you don't understand. It is designed as a pillow. When you are doing CA, you will be having so much stress, tension. You will not be getting sleep. It is designed to give you sleep, comfort. Previously, there was something called as auditing pronouncements. You know, now it is there, not there, na? Only study material is there. This is injustice. When I was doing CA final, if I was not getting sleep in the night, I would open that and keep 5 minutes. Where a level sleep. Okay. Okay, next question will go. Project X is there, Y is there, under evaluation of XY company, estimated cash flow and probability is given below. Okay, boss. Project X, how much amount I am going to put? 70 lakh. Oh, charge is over. Charge was over. Okay, fine. Without this only I will try explaining. Okay, we'll see. Okay, project X, how much money I am putting? 70 lakh I am putting. Yes, probability weights. Year 1, year 2, year 3. Yes, year 1, what all can happen? We should know to read. Year 1 lakh, there is a 30% chance that I will get 30 lakh. There is a 40% chance that I will get 50 lakh. There is a 30% chance that I will get 65 lakh. Similarly, for year 2 also they have given. Similarly, for year 3 also they have given. Nothing is given. I will always assume independent. Okay, boss. Project Y. Yes, year 0 I am putting 85 lakh. Yes, what is the estimation that I am getting? Yes, probability is given 0.2, 0.5, 0.3. Annual cash flows throughout the life. They are telling every year what cash flow they are getting, 40, 45, 50. Now, how many years is the life of the project? For Y they have not given specifically, but for X they have given 3 years. So, I will assume it is 3 years. I say logic, nothing can be done. Okay. So, yes, this I will assume every year's cash flow. The only advantage is that for X, for year 1 separately you will do, for year 2 separately you will do, for year 3 separately you will do, then you will bring. For here you did not do separately. Why? Number is same. Don't try writing again. Year 1 40, 45, 50 probability, do again for year 2 again do, for year 3 again do. Same number da. Expected cash flow will be same, risk in cash flow will be same. Just you bring it to present value terms. Okay. Which project is better based on NPV with the 10% discount? Okay, you calculate NPV. Now compute the standard deviation of the present value distribution and analyze the inherent risk. Standard deviation you are going to calculate. Okay, boss, great. Question is over. That much only I had. Is this clear? Unless question tells me, my default assumption is always perfectly independent. Is this clear? Okay, great. Now comes next question. Perfectly dependent. Okay, boss. Following are the estimates of net cash flow and probability of a new project of X Limited. Yes, year 0, initial investment. What all can be my initial investment? There is a 30% chance it can be 4 lakh. There is a 50% chance it can be 4 lakh. There is a 20% chance it can be 4 lakh. 3 different probabilities are given. So, initial investment can be 4 also, 4 also, 4 also. That means it will be 4 only. So, no. Estimated net after cash tax flows, cash flow after tax, 1 to 5. Okay, it can be 1 lakh also, 1,10,000 also, 1,20,000 also. Okay, here differences can be there. Estimate salvage value at the end of year 5, salvage value, it can be 20,000 also, 50 also, 60 also. Now, aram se. Required rate is 10%. Okay, calculate expected NPV of the project. Here, how am I going to do? Look at this, students. Expected NPV of the project. Tell me, NPV I am calculating. You should be having your mind open. You should just not stick to things. You should know the base. See, NPV, what I am doing? Present value I am bringing. Three different cash flows are there. Initial investment I am there. Cash inflow during the life is there. Terminal value is there. Okay. Tell me, initial investment, what all possibility is there? It can be 4 lakh also, 4 lakh also, 4 lakh also. That means it is going to be 4 lakh only. Yes, cash inflow. Yes, it can be 1 lakh also, 30% chance. It can be 1 lakh 10,000 also, 50% chance. It can be 1 lakh 20,000 also, 20% chance. So that means what is my expected cash inflow every year? Can you tell me? 1 lakh into point, how much? 1 lakh 9,000. Terminal value, it can be 20 also, 50 also, 60 also. Tell me the expected value. 20 into 0.3, 50 into 0.5, 60 into 0.2. 40,000. Can I calculate NPV? Yes, boss. Year 1, 4 lakh is going. Year 5 years are there. Every year 109, 109, 109, 109, 109 is coming. Year 5 again 43 terminal value is coming. Bring to 0. You will get expected NPV. Okay. Okay. Great. Now, second, what is the best case and worst case NPV? Okay, let me see what is best, what is worst. Tell me what is best. Best means what? Less money you are putting, maximum inflow you are getting. Less money you are putting, less money. Money everywhere is same only. More money you are getting. 120, terminal value 60. This is the best scenario. Yes, 4 you are putting here. Every year 120, 120, 120, 120, 120 you are getting. At the end 5th year again 60 you are getting. This case NPV, can I calculate? CA inter GGB also can do. Worst case, what is worst? 4 lakh I am putting. Cash coming is very less. 1 lakh only I got. This also 20 only I got. In this case, can I calculate NPV? This also you can calculate. Okay, next. The probability of occurrence of worst case if cash flows are perfectly dependent over time and independent over time. Sir, what does it mean, sir? Sir, that I link the Mandu said 2 situation can be there. If my cash flows are perfectly dependent, then what is probability? If cash flows is perfectly independent, then what is the probability of worst case? Tell me, perfectly dependent means, tell me what is the worst case here? This is my worst case. Look at this. Aram say, this is worst case. That is, I put 4 lakh at t is equal to 0. How much I get in year 1? 1 lakh only I get. What is the chance of this happening? 30% chance is there. But perfectly dependent means, if first year bad means, next all years what? Bad only. That means next year probability is going to be what? 1, 1, 1, 1, 1, 2, 3, 4, 5. That means basically what? 0.3 only it is going to be there. Perfectly independent. Whatever happens in year 1, anything can happen in year 2. Tell me, first year, worst situation, probability is 0.3. First year is bad. Is it necessary second year should be bad? Independent. That means second year again can be good, average, bad. Second year bad, probability is 0.3. Third year bad, 0.3. Fourth year bad, 0.3. Fifth year bad, 0.3. 0.3 to the power of 5. Simple. Perfectly dependent means you are only going to put the probability. Independent means, yes, probability in probability. How much years is there? That much you write. Whatever it is, who will care? 0.3 to the power of 5. Is this clear? Number you write in the examination. Over. Now, standard deviation and coefficient of variation. Assuming there are only 3 streams of cash flow, only 3 streams of cash flow can be there, only 3 can be there, yes, which are represented by each column of the table with the given probability. Yes, only 3 streams can be there, this as well as this. That means you are putting in the money, that is 4 lakh you put. Yes, there is a 30% chance that you will be getting how much? 1 lakh. There is a 50% chance that you will be getting 1 lakh 10,000. There is a 20% chance that you will be getting 1 lakh 20,000. This only is there. That means if this happens means all 5 years this only will happen. And if this happens means salvage value is going to be 20,000 here. This is going to be 50,000 here. This is going to be 60,000 here. Tell me Which kind of cash flow is this? Perfectly dependent cash flow. Only 3 streams of cash flow can be there. Only 3 paths can be there. If this happens, means then this only will keep happening. Is this clear? Perfectly dependent. This is. The only thing you should understand is to know dependent or independent. Okay. Now, coefficient of variation of X Limited on its average project, which is in the range of 0.95 to 1. They are telling CV, company, any project they are taking, its CV normally is going to be in the range of 0.95 to 1. Normally it will be in the range of 0.95 to 1. Okay, why you are telling that? God knows. We will read further. Yes, if a coefficient of variation of the project is found to be less risky than average, 100 basis points is reduced from company's cost of capital. What nonsense they are telling? God knows. Simple. See, coefficient of variation, CV is telling what? It is sigma divided by X bar. That is, to earn 1 unit of return, how much risk I am taking? Tell me, ideally risk should be more or should be less? Should be less. They are telling that, boss, normally, whatever business we are doing, its CV will be in which range? 0.95 to 1 range it will be there. So, for this range, what we told is, we told 10% should be our required rate. But if in this project I calculate, and if my CV comes to be, if the coefficient of variation is found to be less risky than the average, that means it is lower than this, it falls somewhere here, 0 to 0.95, then what I will do? 100 basis points, 1 basis point means 0.01, 100 basis point means 1% will be reduced from company's cost of capital. That means right now company's cost of capital is 10, if I reduce 1%, it will become 9%. Story is okay. What is needed? They did not tell. Why? They are ICI. What they calculated? Coefficient of variation. Then why this drama was given? Chumma, they are ICI. They can tell anything. This they have not calculated. What is going to be my coefficient? Yes, required return in this case they have not calculated. Chumma, I told. Okay, what they did? Boss, yes, in case of perfectly dependent cash flow, here I calculated for perfectly dependent. For perfectly dependent cash flow, yes, I know my expected NPV. 3 cash flows are there. Every cash flow's NPV I know. Yes, X I know, P into X. I know the expected NPV, X bar. Yes, X minus X bar, P into X minus X bar the whole square. I know the variance, I know the standard deviation. Yes, I know the expected NPV, X bar of perfectly dependent. I know the standard deviation in NPV. Sigma divided by X bar. I will calculate and keep. Over. It will be coming to some 0.9 something. That is their coefficient of variation. Ideally, based on that, I should have reduced. But that they have not done. This sentence, chumma, they have written here. This sentence, chumma, they have written. It's calculation. They did not do. If you want, you can do and keep for understanding purpose. Otherwise, anyways, they have not done. Why we should bother? Finish it off. Over question. Is this clear, everyone? Simple only to us. Yes, obviously, you should be spending some time going back. You should do it by yourself. When I am telling, dependent, dependent, independent, independent. Should go back, read by yourself. Okay. Yes. Why I am in a position to tell this here is because I have seen, because I have spent time. That is why I am telling. The only thing you have to do is you have to spend some time. As simple as that. Okay. Company has under its consideration project with an initial investment of 1 lakh. 1 lakh. We are putting, okay, great, boss. 3 probable cash inflow scenarios with their probabilities of occurrence have been estimated as follows. What all can be there? Yes, either I will be getting 20,000 or I will be getting 30,000 or I will be getting 40,000. Okay, great, boss. Project life is 5 years and desired rate is 20%. 20% I want, that means a 20% discount. The estimated terminal value for the project assets under the 3 probability alternatives for each of these 3 probability is going to be 0, 20, 30. That is, here it is going to be 0, 20, 30. This is terminal value. Yes, you are required to find the probable NPV, expected NPV, irrespective of if it is independent or dependent, you can calculate expected NPV, no issue only. Look at this, you know the annual cash flow, based on this you will calculate the expected annual cash flow. Yes, you know the terminal value, you will calculate the expected terminal value, you bring to present value, you got your expected NPV. Okay, for NPV it does not matter, independent, dependent, nothing matters. Okay, now find the worst case NPV, best case NPV. Tell me, worst case, worst. I put money, how much I am getting? This much only I am getting. This is worst. Okay, Yes, in that case, what is my NPV? Okay, what is best? Maximum I am getting. In this case, what is my NPV? Okay, fine. Now, third, state the probability occurrence. What they are asking? Chumma, yes, the moment you see perfectly positively correlated, perfectly positively correlated. If this increases means this pakka will increase only. What is that? Perfectly dependent. That is why correlation so much time is spent there. R is equal to 1. What does it mean? All those things. Perfectly dependent. The moment you see perfectly dependent, you will start doing path. You will start calculating NPV for everything. You will start calculating risk. Don't do. See what is asked. They are asking probability of worst case. Chumma, you will spend some 15 minutes, you will get a big zero because you would not have put probability. They are asking what? Firm has an investment proposal which requires 80,000 initially. Okay, boss. Investment proposal is expected to have 2 years economic life. 2 years I will be getting. Okay, great. In year 1, there is a 40% chance that I will get for 50,000 and 60% chance that I will get 60,000. Look at this, look at this, look at this. How much I am putting? 80,000 I am putting. If I put 80,000, year 1, what all can happen? There is a 40% chance that I will be getting how much? 50,000. And there is a 60% chance that I will be getting how much? 60,000. In year 1, can I decide this is independent or dependent? No, boss, I should go for year 2 to understand. Okay, boss, now. Next, the probability assigned to cash flow after tax for year 2 is as follows. For year 2, how am I getting? Cash flow in year 1, 50,000. That is, if in year 1 I get 50,000, year 2 what will happen? I can get 24 also, 32 also, 44 also. If in year 1 I get 60,000, I can get this also, this also, this also. Tell me, dependency is there? Dependency is there. Year 1 is bad means year 2 is also bad. Year 1 is good means year 2 is also good. But dependency, am I having only one figure? No, boss, I am having more than one figure. It is moderately dependent. That means if I get 50 here, it is 24, 32, 44. 24, 32, 44. This is 40, 50, 60. Yes, probability is how much? 2, 3, 5. Here it is how much? 4, 5, 1. That means tell me altogether how much path can be there? 1, 2, 3, 4, 5, 6. Each of these 6 paths I will calculate NPV. Joint probability I will be putting. Yes, x is there, p is there, p into x, x minus x bar, p into x minus x bar, the whole square, variance, square root, standard deviation, question over, story over, concept is also over. Finish. Simple only it is. Okay, we will revise and we will take a small break. We are not in a position to give you a big break now. Okay, first is basics. I am starting a project. I want to know the expected x bar. It is sigma px. If x is cash flow means it is expected cash flow. If x is NPV means this is expected NPV. Yes, I want to know the risk. Sigma p into x minus x bar, the whole square is variance. Take a square root, you will get standard deviation. If x is cash flow means this is risk of cash flow. If x is NPV means this is risk of NPV. This is basic for you. Now, cash flow can be 3 different types. Perfectly independent, moderately dependent. Perfectly independent, only there I have to think. There I am not going to go for NPV, anything can happen. I will go to cash flow first. For every year, I will see what all cash flow can be there. What is the probability? P into x, I will get the expected cash flow. X minus x bar, p into x minus x bar, the whole square. I will get the risk in the cash flow. I will get the standard deviation of the cash flow. For every year, I will do that. Phase 1. Phase 2. For project as a whole, I have to calculate NPV. Yes, initial investment I know, every year's expected cash flow I know. I will bring to present value, expected NPV I got. I want to know the risk in NPV. Every year's risk in cash flow I know. I wanted NPV, that means I will bring to present value. Sigma cash flow 1 into present value factor 1. But a promise was made to Markowitz. What I should be? Should be in square. Over. This only is difficult. Next to our jujube only. You do the path, you finish it off. As simple as that. Okay, perfectly dependent. That means 1 year, first year, 3 situations are happening. If this happens, next year this only will happen. Third year this only will happen. So altogether 3 paths are there. Yes, for every path I will calculate NPV. For every path I will calculate probability. Probability is first year probability, that's only. Into nothing has to be done, into 1 1 1 1 1. Okay, based on that, yes, my x is NPV, so I will be getting my p into x, expected NPV, x minus x bar, p into x minus x bar the whole square, variance of NPV, take a square root, I will get standard deviation of NPV. Moderately dependent. Year 1 is bad means year 2 is also bad only, but in that 2-3 things can happen. Every path I will see, for every path I will calculate NPV, x is NPV, p into x, x minus x bar, p into x minus x bar the whole square, I got the variance in NPV, take a square root, I got the standard deviation of NPV. This much only is there. Okay, online students. Okay, now it is 5:19. 5:25 will continue. 6 minutes break. 5 minutes plus 1 minute bonus. Hello, online students, give me a confirmation whether the audio video is clear. Shall we continue our discussion? Yeah, okay, great. So with this, concept 1 is over. Morning we started concept 0, NPV, then PI, then IRR. Yes, after that we started concept 1, risk analysis. How do I measure risk? Conventional techniques, risk adjusted discount rate. Yes, then I went for certainty equivalent. Statistical, I told basics. Yes or no? Mean, variance, standard deviation, coefficient of variation. Yes, then we came to advanced. It is perfectly independent, perfectly dependent, moderately dependent. Then we went to other techniques. In that first one was sensitivity analysis. One factor is changing adversely. Yes, based on that scenario, multiple things are changing. Yes, decision tree analysis. Okay, yes, one simple example is that you can see and leave. Yes, Monte Carlo simulation, not even example is also not there. Okay, that much only. Yes, concept 2 is replacement decision. That currently we will keep it on hold. Concept 3 we will finish it off, because that is miscellaneous. Taka will go to. Okay, in that part 1 is going to be impact of inflation on capital budgeting decision. I took a decision, I am going to start a business, but that decision when I am taking now, yes, all calculations when I am doing, inflation adjustment also I should be doing. Yes, a very simple principle you have to remember. Yes, I will always be using nominal cash flow and nominal discount rate. That is after adjusting inflation. I hope you would have at least heard this nominal, real. Okay, yes, in a very simple way I'll tell. Okay, cash flow can be of two types. First is the real cash flow, wherein inflation is not adjusted. Yes, second is nominal cash flow, wherein inflation is adjusted. Okay, boss. Now understand a very simple thing. I decided once and for all, not happening, boss. I am going to stop teaching. Yes, why chumma? Yes, sleepless nights we are spending and what we are getting money minded. Okay, so we are going to stop teach. What will start? Super business I have in mind. Lungi business. Lungi. We will start selling lungi. Yes. There is no need to tell, there is no need to justify everything, why I should do plus, why I should do minus. You want lungi, you buy lungi. Why lungi? You ask yourself. You don't want lungi, don't buy lungi. Simple. Yes or no? Yes. You want one lungi, 300 rupees. Money minded. You want, you pay 300. Don't want, don't pay. Go without lungi. Wear a pant. What does it be? Yes. So I decided lungi business. Set, no tension only. Okay, boss. We will start. Yes. So I made some calculation. Okay, boss, here I am standing. So based on today's factors, I will be knowing what all will happen. I am telling every lungi I will sell at 200 rupees. Okay, good. For every lungi I have to purchase 100 rupees variable cost. Okay, great. For every lungi I am getting 100 rupees contribution. Okay, amazing. I am telling, yes, first year I will sell 1000 lungi. Okay, great. Second year I will sell 1500 lungi. Yes, third year I will sell 2000 lungi. Okay, great, boss. Tell me, yes, every lungi I will get 100 rupees. That means the first year total how much cash flow I will get? 100 into 1000, 1 lakh I will get. Second year I will sell 1500 lungi. That means how much I will get? 100 into 1500, 1.5 lakh I will get. Third year I will get 100, third year I will sell 200 lungi. 200 into 100, 2000 into 100, how much I will be getting? 2 lakh. Based on this, I made my calculations, NPV, everything I calculated. NPV told accept also. Now comes the maja. Understand? Calculation when I did. Here I did. That means this selling price that I have estimated is for which date? Based on today, what selling price is I have estimated. Today I am selling the lungi at 200 rupees. After 10 years also, lungi will I sell at 200 only? No, boss. With inflation, what will happen? Price will keep increasing, na? That means this number that I have taken is on real terms, is on today's terms. But cash flow I will be getting is going to be a future. That means I should show adjustment of that, na? That means whatever cash flow is there, I will be constant extra I will charge. That means next year how much I will be charging? 200. No, boss. 220 I will be charging. Next year how much? Yes, again 10% extra, whatever it is. Yes, 242. Next year how much? Again 10%. Yes, cost. Yes, this year at 100 rupees I am purchasing. Next year also will I be in a position to buy at 100? No, boss. There also inflation will come now. Question tells there 8% inflation is there. Okay. Based on that I will do. Is this clear? So when I am taking a capital budgeting decision, I am standing here. Means initially my data, my estimates will all be based on the price today. But cash I'm getting is not today, it will be in future. That means in this what I should adjust? Inflation I should adjust. Is this clear? Okay, simple, that only it is telling, nothing else is there. Okay, yes. So how do I calculate my nominal cash flow? Simple, yes, I am having my real cash flow. In that 1 plus inflation I will put over story. Is this clear everyone? Yes, real cash flow into 1 plus inflation to the power of n. Simple. Yes, today one lungi I am selling at 200 was, but after 1 year also will I be selling at 200 only. Assume 10% inflation is there. That means at what price I will be selling? 200 into 1.1. I am going front, include interest factor. Yes, I am telling 200 today I am selling. After 2 years at what price I will be selling? 2 years front I have to go, assume at 10%, that means 200 into 1.1 whole square. Is this clear? Yes, real cash flow on today's basis cash flow is there. Yes, I am not getting today boss, I have to take it front to nominal into 1 plus interest or 1 plus inflation to the power of n. As simple as that. Is this clear? Yes, in reality what I am getting at that respective points is my nominal cash flows. So everything I will be doing in terms of nominal only. Is this clear everyone? Okay boss. So I told, okay, yes, first formula, nominal cash flow is real cash flow on today's basis how much it is, but I am not getting today, in future I am getting, include interest into, I am telling interest, but it is inflation adjustment, same impact only, into 1 plus inflation to the power of 10. Is this clear everyone? Okay boss, great. Now tell me one very simple thing, if inflation rate is same means directly into 1 plus inflation to the power n I will do. Different rates is there. Suppose, yes, I am telling today at 200 rupees lungi is there. First year na 10% inflation, second year is 12% inflation, third year is 15% inflation. Tell me first year at what price I will sell lungi? 200 into 1.1. Second year what price I will sell? Simple boss, 200. Yes, 1 year front into 1.1. Again 1 more year into 1.12. Third year into 1.15. That is why we spend some time on basics there, so that I need not play here. Is this clear everyone? Okay boss. This is okay. So I told two things I am having, cash flow I am having, discount rate I am having. Okay, yes, everything is happening in the future. That means I want my nominal cash flow, and when I am having my nominal cash flow, I should be discounting my nominal cash flow using which rate? Nominal discounting rate. Yes, so today I am standing and I am telling I want 10% on my project boss, but in future, yes, my value of money will fall down, so I will be wanting a higher return. Understand, a very simple thing. Yes, what is the formula for calculation of nominal discount rate? Yes, it is 1 plus real rate into 1 plus inflation minus 1. Or I can tell simply, yes, 1 plus factor into 1 plus factor minus 1. What nonsense is this? Simple, Jujibi, understand. Yes, I am telling. Today I go to bank. I invest 1 rupee. Yes, they are giving me first year 10%, second year 12%. Total how much I will get? Okay, tell me today 1 rupee I put, first year how much I am getting? 10%, 0.1 I got. That means how much I am having at the end of first year? 1.1. Yes, second year how much I got? 12% I got on this amount. So how much I got? 0.132 I got. That means 1.232 I got. Is this clear? Okay, how much I invested? 1. How much I got? 1.232. That means how much return, how much extra I got? 0.232 I got. If I want to calculate it as a percentage, I will tell 0.232 I got on how much rupee? 1 rupee. That means total how much percent I got? 20.32% I got. Yes or no? Okay. Yes, this is a return I got. Simple. No doubts in this. Now, can I also do it like this? I want to calculate the return. I am telling boss 1 rupee I put. Tell me. First year how much I am getting? 10%, 1.1. Second year how much I am getting? 12%, 1.12. That gives me the total amount I am getting. I want the return. That means what I have to reduce? Principal I have to reduce. How much principal I put? Minus 1. That means how much I am getting? 1.1 into 1.12 minus 1. How much you are getting? 0.232. That means I am getting effectively 23.2 percentage. Yes or no? Same feel is what is there here. I am investing. On today's basis, I am telling I want my real rate. 10% is my, yes, based on today, I am telling, okay, that much return I want. But boss, in future, inflation is also there. That also I should be covering now. So in future, if I just get 10%, is it sufficient or no, boss? It is not sufficient. So I am telling, okay, boss, yes, suppose the real rate that I want is 10%. Okay, I want a 10%. Yes, that is sufficient or no, boss? In future, inflation will also come. I should cover inflation and get 10%. Suppose inflation is 5% into 1.05. That is the total I want on 1 rupee. That means -1 you do. You will get effectively how much return you want. Is this clear, everyone? Simple, not getting into too much depth. Is this clear, everyone? Yes, 1 plus factor into 1 plus factor -1. Okay, simple. Now, look at this. Using this example, you will understand even better. I am having a very big dream that I should purchase a car. Okay, fine. So, somehow, after putting in so much efforts, after being so much money minded, I collected 10 lakh rupees today. Today I collected 10 lakh and kept. Okay. But, okay, I don't want car today. I want car after 1 year. Okay, car's price is 11 lakh. That I saw today. Yes, that means how much extra I want, 1 lakh extra I want. I am telling simple, boss. I will invest 10 lakh today in the market. 1 year I will get 10% return. Next year 11 lakh car I will go and buy. Okay, happy, very happy. I am telling I will go 10 lakh I am having with me. I will put in the market 1 year. 10% I will get, it will become 11 lakh. I will go purchase car and come. That means how much return I want? 10% return I want. Very happy. I went back, I slept. 1 year over. I got 11 lakh also. I go to the showroom. Tada! Money minded person has come. Where is my car? Here is your car. How much it is? 12 lakh. Last year you told 11 lakh. That was last year. This year what came? Inflation came, not a mandu say. That means when you are investing, when you are expecting, yes, I want the return, the real return that I want. That is sufficient. No, boss, for future inflation is there. To cover that, that also I want. So that is why I am telling 1 plus real discount rate into 1 plus inflation. That gives me total value on 1 rupee. I want the return -1. That is going to be my nominal discount rate. Is this clear, everyone? Got the feel, got the feel, got the feel? Yes, once you've got this, based on that, over, nothing is there in this. Some 4-5 questions are there. Yes, just to remember the simple principle. Okay, I am taking estimate today, that is on real terms, but I am getting in future, that is on nominal terms. Everything I will be converting into nominal terms. Okay, that means my cash flow should also be nominal cash flow. My discount rate should also be nominal discount rate. How do I calculate nominal cash flow? Yes, today's cash flow is there, real cash flow is there. On that, inflation I should add. Okay, boss, real cash flow is there, future, front I am going, inflation I should add. Yes, inflation rate is same, means 1 plus inflation to the power of n. It is different, means every year I will keep on putting over. Yes, so nominal discount rate, how do I get my nominal discount rate? It is 1 plus a real discount rate. Actually, how much I want? If I get that much only in future, sufficient. Because inflation is also there now. Into 1 plus inflation -1. Based on this, you discount. Yes, a simple point. When you are doing calculation, every cash flow you will be converting into nominal rate. Okay, selling price is there. Okay, inflation rate is given. You will keep converting. Variable cost is there. You will keep converting. Fixed cost is there. You will keep converting. Depreciation is there. You will keep converting. Depreciation. What is depreciation? It is an allocation of historic cost. In the past, I paid 10 lakh. 10 years I am using. Every year 1 lakh I am distributing. Next year, if I tell that depreciation for this year is 1 lakh, do I have to pay 1 lakh? Next year depreciation is 1 lakh. Next year's depreciation, inflation, will I show more depreciation books? This is just a distribution of my historic cost. There I will not put inflation. But sometimes ICI, yes, sometimes they will put inflation on depreciation. Sometimes they will not put. Depends on their mood. Why? Their ICI. Your ICI. No. What you have to do? You put a note. Depreciation is not subject to inflation. Based on that, you finish it off. As simple as that. Is this clear? Golden rule. I will always be considering nominal cash flow and nominal discount rate. Cash flow can be real, nominal. What I want? Nominal cash flow I want. Yes, inflation rate is same, means real cash flow into 1 plus inflation to the power of n. Directly I will do. Different means every year 1 by 1 I should keep going. Real cash flow into 1 plus inflation 1, 1 plus inflation 2, so on and so forth. Nominal discount rate I want. Yes, it is 1 plus real discount rate into 1 plus inflation -1. 1 plus factor into 1 plus factor -1. You got the nominal cash flow, you got the nominal discount rate, bring to present value, you got your NPV. This NPV is after adjusting inflation. Story over. Is this clear? Okay, questions are there on that. We will quickly see the questions. Optimum replacement cycle. Okay, impact of inflation. Okay, determine NP of the project with the following information. Initial outlay, how much I am paying? Tell me, initial outlay, when am I paying? Today I am paying. On today's price, will I be putting inflation? Today's price, today only estimated numbers. Okay. Annual revenue without inflation. Okay. Annual cost excluding depreciation without inflation. Useful life is 4 years. Salvage value is nil. Tax it is 50%. Cost of capital is including inflation premium of 10%. How much is my inflation premium? 10%. By including inflation, I want 12%. Now, simple principle, cash flow is there, discount rate is there. Both should be what? Nominal. Cash flow should be nominal cash flow. Discount rate should be nominal discount rate. Tell me, this cost of capital, discount rate is what? Real or nominal? It is including inflation, boss. Here I need not worry. This is 12%. But cash flow that they have given is without inflation. This I have to convert. Okay, every year's inflation is how much? 10%. Now tell me, how many years is there? 4 years is there. Okay. T is equal to 0. How much I am paying today? 40,000. Whether my inflation will impact this? Boss, today I am standing. Next year's revenues, whether inflation will impact? Yes, boss, it will impact. Tell me. Year 1, 2, 3, 4. Tell me, what is my annual revenue without inflation? 30,000. But how much is inflation? 10%. That means year 1 is going to be 30,000 into 1.1. 33,000. Year 2 is 30,000 into 1.1 into 1.1, whatever it is. This is 1.1 to the power of 3. This is 1.1 to the power of 4. Yes, annual cost is 10,000. First year is into 1.1, 11,000. Yes, 1.1 square to the power 3 to the power 4. Yes, anything else is given. Salvage value, cost of the project, depreciation I will be calculating. Okay, 40,000 is my cost. Yes, how many years is the life? 4 years. Salvage value is 0. That means every year how much is the depreciation? 10,000 is going to be my depreciation. So it is a sale minus annual cost excluding depreciation minus a depreciation of 10,000. Next year it is going to be 10,000 into 1.1. Next year, what is that? Depreciation. If you do inflation on depreciation, I will come to your home and kick you out from there. Okay, recorded students. Doesn't matter you tell me money minded, I will come to your home. You call money minded, okay. Depreciation you do right. Okay, simple. Yes, I will be getting my earnings before interest and tax. Yes, on that tax rate is given for me. How much tax rate is given for me? 50% tax minus tax. I will arrive at my earnings after tax. On that I will add back depreciation. Yes or no? I will arrive at my cash flow after tax. This is a nominal. Now on this cash flow, okay, you have the nominal discount rate. On that basis you do NPV. Full chapter you are doing NPV only. But how you are adjusting and doing NPV, that's the only thing. Is this clear everyone? Okay, great. Now comes next question. Company requires, XYZ Limited requires 8 lakh for a unit. That is to build a business, I guess. Okay, fine. Useful life of project is 4 years. Salvage value is nil. Okay, great. Depreciation charge is 2 lakh per annum. Yes. 8 lakh divided by 4. Okay, great. Expected revenue and cost excluding depreciation, ignoring inflation. This inflation is not there. Okay, every year's revenue is given, cost is given. Tax is 60%. Cost of capital is 10%, including inflation. Okay. Okay. Calculate NPV of the project if inflation rate for revenue and cost are as follows. Okay. 1 to 3 year revenue 10%, 10,987, cost is going to be Maja is coming because every year inflation rate is different. Every year it will keep on going, friend. That's all, simple. Okay. Now look at this. 1, 2, 3, 4. I will show revenue. Tell me. Yes, revenue of year 1 without including inflation. I will show the revenues things. Yes, here T is equal to 0, 1. I will write, where will I write? This I will erase. Yes, as much as possible, try to write down your question pictorically for yourself so that you do not commit a mistake. 2, 3, 4. For revenue, I am telling. What is my inflation percentage? First year inflation is 10%, second year is 9%, third year is 8%, fourth year is 7%. Okay, boss. Today I did my calculation that first year I will be getting 6 lakh, boss. That was based on today, na. Next year inflation also I'll be getting. So 6 lakh into 1.1 it is going to be. Is this clear? That is going to be my year 1 revenue. Year 2's revenue, today I calculated will be 7 lakh. Here I told 7 lakh I'll be getting. But I am getting actually after year 2 na, into 1.1 into 1.09. Third year, so whatever is the cash flow, yes, into 1.1 into 1.09 into 1.08. Fourth year, into 1.1, 1.09, 1.08, 1.07. That is for revenue. Cost is there. Cost inflation is there. Based on that I will do. Aram se, you should do it aram se. You chumma keep by hurting this, that, and all gone. Is this clear? Yes. Revenue after inflation you got. Cost after inflation you got. Depreciation is there. Minus depreciation you will do. You will get your earnings before interest and tax. Tax you will reduce. Yes. Depreciation you will add back. Cash flow after tax you will be getting. This is after adjusting your inflation. Nominal this is. Is this clear? Yes. Now, this today I paid. So, this is going to be on today's terms only. This only is real. This only is nominal. Okay, boss. Cost of capital is 10% including inflation. So, based on that you discount. You calculate NPV. Story is over. Is this clear, everyone? Okay. Simple GGP things. Okay. Next, firm has projected following cash flow from the project under evaluation. Yes, 0, 1, 2, 3. Okay. Above cash flows have been made at expected price after recognizing inflation. After recognizing, that means in this, did I adjust inflation? I have adjusted inflation. That means, do I need to do it again? Okay. The firm's cost of capital is 10%. The expected annual rate of inflation is 5%. That means my default assumption is this is how much I want in a reality, but I want 5% for inflation also. That means my nominal discount rate, it is 1 plus factor into 1 plus factor minus 1. 1.1 into 1.05 minus 1. So, I will be getting how much? 15.5%. So, all these cash flows I will discount at 15.5 and check. Is this clear, everyone? Okay. Next thing is Shashi company has projected following cash flow from the project under evaluation 0, 1, 2, 3. Above cash flows have been at expected prices after recognizing good. I need not adjust inflation. The firm's cost of capital is 10%. Its expected annual rate of inflation is 5%. So, it is to be valued at 10% for 1, 2, 3 years. Whether 10% is after including inflation, this one you check ICI solution, okay, because present value factor they have given for 10%. Now, if you want, what you can do is 10%, if I assume it is real discount rate, if I want to this cash flow, I can bring it back to real terms. From real to nominal, you are going front, include interest. Nominal to real, you are coming back, eliminate interest. If you want, you can do it, or else, yes, 10%, 1.1 into 1.05 minus 1, you will get 15.5%. On that basis, you calculate PV present value factors by yourself. Based on that, you do, story is over. But because they have given these discount rates, if on that basis you want to do, means okay, that way you will have to come back. Okay, forget it. Forget this line. But check the solution once. Sometimes ICI will tell that 10% is after adjusting inflation. ICI is ICI, they can do anything. See, just above they wrote like this, below. You cannot believe, because they are ICI, they can do anything. Okay. Yes, that is the thing. You just check the solution, be, yes, double sure, that's all. Yes, I do not remember exactly what they have done. Okay. Yes, next comes question 19. 15 lakh I want today. Okay, boss. Useful life is 3 years. Salvage value is nil. Okay, that means depreciation is 5 lakh. Okay, perfect only. Given below projected revenue and cost excluding depreciation, ignoring inflation. In this inflation we have not put. Okay, every year. Is applicable tax rate is 35%. Assume cost of capital to be 14% after tax. Is inflation rate is given. Inflation rate is given. Inflation rate is given for every year. Okay, boss. Based on that, I'll have to be doing. Same thing only I'll have to be doing. Yes, there is absolutely, yes, no relevance for this sentence after tax. My cost of capital is going to be after showing tax adjustment only. Chumma time pass they have written. Is this clear, everyone? Don't worry. What now? This only you have to do. Yes, today's cash flow is given. Put inflation on revenue. Put inflation on cost. Yes, from that you reduce depreciation. You will arrive at your EBIT. Yes, on that you pay tax. Add back depreciation. You will arrive at your nominal cash flow. Nominal cash flow you discounted nominal discount rate, which is 14%. Their factors is also given. Question over. Okay, finish. Yes, now comes a very difficult, tricky, confusing concept. Oh God, please give me the strength. I don't know if I will be in a position to make justice to this topic. Please Give me the strength. Thanos. What is it? I don't know. Okay. Utility concept. Very difficult. Even if 1 second you miss, gone. Comment and all afterwards you can do. Listen first. Okay. Jubilee Consultancy Group has determined the relative utility of cash flow for the 2 forthcoming project of client. They are telling, yes, if my cash flow next year that I am getting is minus 15,000, my utility is minus 100. Utility is basically the happiness. Next year you get 15,000 negative cash flow. Will you be happy? Yeah? No, you will be sad. How much? Full 100% sad you will be. You will get 10,000 negative. You will be 60% sad. You will be 4,000 negative. You will be 3% sad. You get 0. You will be 0% sad. You get 15,000. You will be 40% happy. Something like that. They have put the numbers. Okay. Now they are telling distribution of cash flow of project A and B are as follows. Yes, tell me project A. Yes, cash flow probability is given. Tell me cash flow project A. Yes, there is a 10% chance that I will be getting minus 15,000 cash flow. Tell me if I am getting minus 15,000 cash flow means am I happy or am I sad? Sad. How much sad I am? Minus 100 sad I am. If I am getting minus 10,000 means happy or sad? Sad. How much sad I am? Minus 60 sad I am. This is my utility. If I am getting 15,000 means happy or sad? Happy. How much happy I am? 40 happy I am. If I am getting 10,000 means happy or sad? Happy. How much happy I am? 30 happy I am. If I am getting 5,000 means happy or sad? Happy. How much happy I am? 20 happy I am. Yes. Which project should be selected and why? Yes. If you want Aram say, yes, cash flow into probability, expected cash flow you could have done and you could have done. But if you do like that, what maja is there? They did based on utility. What? Utility I calculate. Very difficult, very difficult, very difficult. Tell me, yes, minus 100 is the utility. What is the probability? Into 0.1 equals minus 60 into 0.2 equals 40 into 0.4 equals 30 into 0.2 equals 20 into 0.1 equals. What is the grand total? How much? 2 plus 2. So overall I am 2% happy. Yes, for this also I will do for these numbers. Suppose randomly assume here I got 10. In this business I am 2% happy. In this business I am 10% happy. What I want? Happiness. More I want. Very difficult. How to explain? God, why? This very difficult for CA students. This they are asking. They are very difficult. Did not understand, sir. Amount of the cash flow is given, utility is given. Instead of cash flow, you put utility. Do a probability into X. Here X is utility. Whichever is highest, more utility I want. Over. Miscellaneous is over. 1 is over, 3 is over, 2 is pending. Okay, we'll see how much we can push till 6:30. That much we'll do. If I tell replacement decisions part 1, I don't think I'll be in a position to go ahead. Yes. Replacement decision. I am having an asset with me. Should I replace or not? That decision I am going to take. It's 3 different parts we have bifurcated. Part 1, currently I will keep it on hold. First I will go to part 2 and part 3. If that finishes and still you have energy, then we will come back to part 1. We will see. Okay, should I replace or not? All those things currently let me keep it on hold. Look at the students. Okay. Equivalent annual NPV as well as equivalent annual cost. Okay, simple. Okay. Now, Ranga Amban juice shop, they're having a sugarcane machine. That machine is not working well. They decided we have to go purchase a new machine. Okay, great. Which machine we should buy? Assume both are giving same benefit. Wherever cost is less, that I will buy. Now two different machines are there. Now machine 1, yes, initially I will be paying, and every year running cost I will be paying. It's a different period I am paying. I want to bring it to same period, I will bring to present value. Yes, machine is present value of cash outflow is 1 lakh. That is initially to purchase how much I paid, every year how much I paid, I brought to present value, I got 1 lakh. Machine B, na, present value of cash outflow is 1,20,000. Tell me which one is better. If I am buying A means on today's term 1 lakh I should pay. If I am buying means on today's term 1,20,000 I should pay. Which one is better? Cash outflow should be more or should be less? Should be less. So I'll tell, okay boss, we'll go for A. Bingo. But wait, machine A, na, only 2 years life is there. Machine B is giving me 3 years life. That means tell me this 1 lakh if I pay, it is for 2 years. That means effectively for every year how much it is? 50,000. This 1,20,000 is for 3 years. That means effectively for every year how much it is? 40,000. Yes or no? Yes. Now tell, for every year cost is less where? In B. That means which one I should go for? B I should go for. Okay. This much only I am doing. Step 1, I will calculate the present value of all cash outflow. I know, I have been playing from morning. Present 2, yes, step 2, because life is different. Yes, on total cash basis I cannot be taking. Yes, I want for every year how much it is. But small twist is there. What is the twist? Tell me, this cash outflow, it is on what basis? It is on present value basis. But this is 2 years, this is not on present value basis. That means when I am dividing, I should bring it to present value basis. That means, yes, I will divide 1 lakh divided by, suppose, assume my present value factor is 10%. That means tell me, if 2 years is my life means 1 rupee at first year, how much I will be paying? 0.909. Second year, how much it is? 0.826. Yes, 1. This I am bringing means 0.909. This I am bringing means 0.826. That means total it is going to be how much? What is the annuity factor? 1.735. So 1 lakh I will divide, but this is on present value basis. That means life also 2 years. I want on present value basis. It is divided by present value annuity factor. Yes, I have assumed 10% discounting for 2 years. It is 1 lakh divided by 1.735. How much it is going to be? 57,637. Is this clear? Not getting too much into detail as to why am I dividing by present value annuity factor. Chumma, I will spend 15 minutes. Already it is 6 o'clock. Simple. This is present value. That also you keep it present value. Finish it off. Nah. Why chumma time pass you are doing so much? Is this clear, everyone? Sufficient, reasonably. Same thing I am telling here. 1,20,000 is there here, boss. I want per annum. Okay, I can do divide by 3. No, I cannot do because this is at 0. Yes, 1, 1, 1. 3 years is there. I will bring it to 0. Okay, how I will bring it to 0? Yes, 3 years life is there. 1, 1, 1. Bring it to 0. What is going to be the present value annuity factor? No, annuity factor you give me. 2.486 or 487. I am telling 1,20,000 is there, boss. Yes, that is for 3 years. I cannot do because this is present value. So I want present value for 3 years. It is 2.486. How much it is going to be? 4270. Yes, that means understand. If I go for the first machine, na, every year I am paying 57,000. If I am going for second project, na, every year I am paying 48,270. I am paying more or less, less. Where it is less? Second one it is less. So which one I will go? Second one I will go. Simple. Okay. 2 steps. Step 1, calculate present value of all cash outflow. To purchase asset I am paying. Every year, yes, running cost I am paying. Bring present value. It is at 0. Now, life is different. If life was same, here only I can take a decision. Life is different. So I want per annum cost. I cannot directly divide by number of years because this is on present value. Number of years also should be on present value. So I will be dividing by present value annuity factor of the number of years. Okay, based on that I will calculate equivalent annual cost. Based on that I will be taking a decision. Is this clear, everyone? So tell me. Yes, this was anyways for concept purpose. Based on this, no questions, nothing is there. Okay, is equivalent annual cost. Step 1, I will calculate present value of all cash outflows, but I want per annum, so I will divide by number of years. Boss, it is present value, so it is present value annuity factor. Is this clear, everyone? Yes. So step 1, present value of all cash outflows. Step 2, equivalent annual cost, that is present value of all cash outflows divided by present value annuity factor. Decision, it is outflow, minimum means best. Okay, wow. Okay, shall we continue? Okay, this one we will do, then based on energy we'll see. Okay, optimum replacement cycle. I'm worried thinking about today evening, because tomorrow's chapter's notes we will write again. 50% I've written. Yesterday I slept at 5 o'clock. Today again if I write and sleep, what will happen? Day after tomorrow, sir. I replan take CFN plus 1 May 2025. Okay, fine. Optimum. That is what from half an hour is going on my mind. Okay, this anyway still till 6:30 I'll push. After that, what I will do? Okay, fine. Optimum replacement cycle. Simple jujube. Yes. Now understand. Yes. Our Rangana is there. Yes. What Rangana is telling? Okay, our business is going on. Ranga and Amban juice and tea shop is going on. Yes. We decided. Yes. We will not list the product on Zomato. We will only keep our delivery personnel. Yes. With them we will distribute home delivery. For that, what we want? Scooter we want. Okay. They are telling my business will go for next 50 years. Brand value is there. But to deliver the juice, vehicle is there. Same bike I can use for 50 years. Sir. No. Yes. Once my life goes on increasing, what happens? Its efficiency decreases. Because of that, what happens? Its operating cost increases. So I am telling, ideally, after every how many years, I should sell the vehicle. I should replace the vehicle. Optimum replacement cycle. My project is going on, but this asset every once after a while I need to replace. Ideally, after how much period I should keep replacing? Look at this. Yes, on what basis I will be taking a decision? There I calculated equivalent annual cost. Based on that only I am taking a decision. Simple. ORC is a tool which is used to determine the best time to replace the asset. Okay, in order to minimize the equivalent annual cost of usage. It is used when project is long term in nature and requires frequent replacement. Frequently I should keep replacing. So ideally at what time I should replace? Yes, it is based on equivalent annual cost of asset at different time periods. Equivalent annual cost, that is I will be calculating present value of cash outflow divided by present value annuity factor. Sir, got a feel, sir, did not get understanding full. Don't worry, example is there. Look at this. Company gives bike to its salesperson. Sales people are there. Rangana has given bike. Okay. The maximum period a bike can be used is 3 years. So tell me. Today I purchased a bike. Maximum how much years we can use this bike? 3 years we can use this bike. Yes or no? I want to take a decision. I as a company, how much year I should use? 3 options are there. Either I will use 1 year, then I will sell. Or I will use 2 years, then I will sell. Or I will use 3 years, then I will sell. Which one is best? Wherever my equivalent annual cost is less, that is best. Okay, aram se. 3 options are there. Either I will sell at end of first year, or I'll sell at end of second year, or I'll sell at end of third year. Okay, boss, great. We will see what all is there. Now look at this. Purchase price of bike. If I'm buying bike, how much it is? 55,000 it is. Resale value. If I sell at the end of first year, good value will be there, 35,000 will be there. I use 2 years and sell, 21 only I'll get. I use 3 years and sell, 9 only I'll get. Okay, great. Running cost to use the vehicle. Fresh means running cost is going to be less. More years means running cost is going to be more. Yes, if I'm using the vehicle for first year only, yes, 3,000 for road tax, 30,000 for repairs, petrol. Total how much I'm incurring in a year? 33,000. If I use the vehicle for second year also, 3 plus 35, 38 I will be incurring. If I use for third year also, 3 plus 43, 46,000 I will be incurring. Is this clear, everyone? Okay, perfect. If you guys want, you guys can just write down these numbers. Look at this. Purchase price is 55,000. Okay. Yes, resale value, total cost, both the cost I added. First year is 35, 21, 9. Here it is 33, 38, 46. Okay, purchase price, it is 55. Is this clear? These numbers are there with you? Okay, great. Tell me what all, yes, 10% is my, yes, discounting rate, determine the optimal replacement period. Tell me what all options Ranganna is having. 3 options. Either he will sell by using it after 1 year, or he'll sell after using it for 2 years, or he has to sell after using it for 3 years. Beyond that he cannot use. Okay, which one is best? In every option, I will calculate the equivalent annual cost. Okay, boss. I am telling, I am using my vehicle for 1 year only. That means understand what is happening, replace bike every year, 1 year only I am using. That means today at t is equal to 0, I will purchase. How much year I will use? 1 year I will use. At the end of first year, what I will do? I will sell. Over, story over. Is this clear? Yes, I want to calculate present value of cash outflow. Tell me, if I am using for 1 year only, tell me, yes, to purchase how much I am paying? 55,000 I am paying. Okay, great. First year, I have to pay for the, yes, repairs, maintenance. How much I am paying first year? 30 plus 3, 33,000 I am paying, 33,000 I am paying. But sir, first year end, year is over. What I am doing? I am selling a bike. When I sell a bike, what I am getting? Cash is coming. How much scrap value I am getting? 35,000 I am getting. Yes or no? Yes. Now tell me. All these are at different points where I want to bring them to 0. So I will bring it to present value. Yes, calculation of present value of cash outflow. Initial investment, it is already in present value. Need not worry. Running cost, yes, it is 33,000. When am I incurring it? First year. Where I want it to be? 0th year. Yes, bring it back 1 year into 0.909. It is 29,997. Sir, at the end of first year, I am selling, sir. How much I am getting? 35,000. When I am getting? First year. Where I want? 0th year. Bring it back 1 year. 35,000 into 0.909. It is 31,815. Be careful. This I am paying. This I am paying. This I am getting. It is having ulta sign. Here if you put plus, it is minus. Here if you put minus, you are going to put plus. I want to calculate cash outflow. So all outflow I am going to put plus. Inflow I am going to put minus. So much and all, there is no need. You should be doing this much basics. Is this clear? That means net, what is going to be present value of cash outflow? It is going to be 53,182. Is this clear? Okay. Numbers are okay. What I am doing? Today I purchase, at the end of first year I sell. So today to purchase I am paying. First year running cost I am paying. But when I sold, I got some money. Everything I bought to present value. So 1 year's present value of cost is 53,182. 1 year I am using. Present value of cost is 53,182. This is the present value at t is equal to 0. Yes, I want for 1 year only. That means I will divide by 1. But boss, this at present value base I should be dividing. I should divide by present value annuity factor. Is this clear? This is here. I want to know the cost for every year. Here what is the cost? So divided by annuity factor of 10% for 1 year. How much it is? 0.909. How much is it? 53,182 divided by 0.909. How much it is? How much? 58,506. Yes or no? On today's basis, it is 53,182. But boss, I want to know first year and how much it is. 10% interest is there. You add that, you will reach that. Is it clear? As simple as that. Okay, boss. That was one option. If I purchase today and use for 1 year means, okay, every year my cost is going to be 58,506. Okay, aram se, we'll go to the next option. Option number 2 is, I'm telling, every year who will sell da? Once in 2 years I'll sell. Okay, great. Tell me what all is happening, Yes, when I am purchasing, how much I am paying to purchase the bike? 55,000 I am paying here. Okay, 2 years I am using. That means 2 years running cost I will incur. Tell me first year how much is my running cost? 33,000. Second year how much is my running cost? 38,000. Second year I sold. Cash is coming. Salvage value. When I am selling second year, which salvage value I'll get? Second year salvage value. How much is it? 21,000. All these are a different period. What I will do? Bring to present value. Yes, my present value of all cash outflow for 2 years. It is 99,039. This is for 2 years, sir. I want to know for per annum divided by 2. Yes or no? This is present value. That means when I am dividing life also, it should be on present value terms. So divided by, yes, present value annuity factor of 10% for 2 years. It is going to be how much? 1.735. That means how much it is going to be? 99,039 divided by 1.735. It is going to be how much? The 57082. Yes or no? Yes. What does it mean? What does it mean? What does it mean? Simple. Yes, it means that, see, boss, on today's basis, if I am paying, means it is 99,039. I am telling boss, today's basis I don't want. I am paying every year. I am paying. Now tell me every year how much I am paying. Yes, every year it is as good as 57082. 57082 I am paying. Yes, if you want to get a more feel of what is happening, 57082, bring it back 1 year. 57082, bring it back 2 years. You will get this value. This value is at 0. I want to know every year's value is what. That is what I am doing. Is that logic in too much detail I have not told, but I hope it is sufficient for you guys. Present value of cash outflow divided by present value annuity factor. Is this clear? Okay, boss. Now tell me 1 year is better, 2 year is better. If I am selling in 1 year means every year's cost is 58,000. If I am selling in 2 year means every year's cost is 57,000. Which is better? 2 year is better. But sir, one more option is there now. Which one? 3 year. Let me see that also. Tell me if I am selling after 3 year means. Today I purchase. To purchase how much I am paying? 55,000. 3 years I am using. That means 3 years running cost I will incur. First year's running cost is how much? 33. Second year is how much? 38. Third year is how much? 46. Sir, third year and I sold na. Scrap value I will get. Which is scrap value? Third year scrap value. How much it is? 9,000. I will bring all to present value. Look at this initial investment. 3 years running cost minus resale value at the end of third year. I will get present value of all cash outflows. But sir, this is for how many years? 3 years. I want for what? 1 year. Divided by 3. Present value annuity factor of 3 years, which is 2.486. So how much I am getting? 57,993. That means understand. Yes, if I am using the asset for 1 year, my yearly cost is 58,500. If I am using it for 2 years, my yearly cost is 57,000 only. If I am using it for 3 years, it is 57,900. Where my yearly cost is lowest? 2 years. That means ideally when I should replace, every 2 years I should replace. So we will set a policy that, okay boss, every 2 years we will keep replacing the asset. Is this clear, everyone? Okay. This is what we have to do. Simple jujube. Now 3 times I did a calculation. Okay. I have created a simple structure, simple format in which in a single table you will get everything. And so many of your calculation will be eliminated. This much is fine for you to save time. That's all. If you are comfortable with that, okay, fine. Now look at this, students. What I am doing. Altogether 3 cash flows are there. First is going to be my initial investment. Next is going to be the running cost. Next, at the end of the life, I will be getting scrap value. Okay. Period I am writing initial investment. When am I doing? At t is equal to 0. At t is equal to 0, the present value factor is going to be 1. Yes, running cost. When all I am incurring, first year is there, second year is there, third year is there, depending on how I am using. Okay, first, second, third. Yes, it's present value factor. Resale value. If I sell at the end of first year, this value. If I sell at the end of second year, this value. If I sell at the end of third year, this value. Okay, now 3 options are there. Option number 1. Yes, I will replace every year. Just feel and tell me, I will replace every year. What all I am incurring? Today at t is equal to 0, I purchased. How much I am paying to purchase? 55,000. Okay, 55,000 I paid. Yes, first year, what I incurred? I incurred first year's running cost. How much is the first year's running cost? 33,000. That is at first year. I will bring it to present value terms. 33, I will bring it to present value terms. And first year end, I will sell it to scrap. That means what is the scrap value at the end of first year? 35,000. Yes or no? Minus 35,000. When am I selling? First year end. That means first year's present value factor. So I will be getting present value of cash outflow. This is for how many year? 1 year. That means I will divide by present value annuity factor of 1 year. I will get equivalent annual cost. Okay, or 2 years. In case of 2 years, what will happen? Look at this. Yes, today I purchased, T is equal to 0. How much I am paying? 55,000 I paid. Okay, boss. Now, how many years I am using? 2 years I am using. That means how many years running cost I will incur? 2 years running cost. First year running cost is how much? 33. Second year running cost is how much? 38. First year's running cost is 33. Second year's running cost is 38. There in the left present value factor is there. You will multiply, you will get the value. No need to multiply. This number only is this. Okay, that is why I am doing it this way, because next time when I am doing chumma, this if I calculate is sufficient, this is there for me. Is this clear? But you have to be careful. Now, 2 years end I am selling. So, scrap value when I am getting. Second year end I am getting. That means, yes, second year end I am getting. Which present value factor? Second year present value factor I am putting. Is this clear? Or else 3 years I am using. Today I purchase, how much? 55 I paid. First year 33 I paid. Second year 38 I paid. Third year how much I paid? 46 I paid. Okay, boss, 55. First year 33, 38, 46. These two into also I need not do. Left side it is there. You are saving a lot of time. For third year present value factor you have written. You will write it down. Now, when are you selling? Third year end. Which scrap value? Third year end. Which discount figure? Third year end. Third year you are putting it back. You will get the present value of cash outflow divided by present value annuity factor. You will be getting your equivalent annual cost. Like this, if you are doing, means in a single statement it will get over. How many other options is there? If you will no sir, too much kirkiri is there. Aram se one by one you do. You will be getting 8 to 10 marks for this question. What is there? Chumma. Initial investment plus running cost, bring it to present value, minus scrap value, bring it to present value, divided by present value annuity factor. Is this clear, everyone? Okay, great. Steps. For each of the scenario, calculate equivalent annual cost. Look at the structure. Yes, it is initial investment plus running cost at present value minus resale value at present value. It is going to be at present value divided by present value annuity factor. You will get the equivalent annual cost. Based on that, wherever my cost is lowest, that I am going to choose. Is this clear, everyone? Yes, this concept is over. This format I have written. Now look at the questions. Question. Okay, chumma, just for the sake of showing, I'll have to show. Nothing is there. Look at this. Yes, taxi operator, I purchased at 4 lakh. 3 years life is there. That means either I can sell at the end of 1 year, 2 year, 3 year. If I'm selling, yes, if I'm using for first year means 180 cost I have to pay. At the end of it, 280 resale value is there. If I'm using for 2 years means second year's cost is given, second year's resale value is given, third year is given. Calculate optimal replacement cycle. Same thing only. Here, the only difference is 4 years is there. Today I am purchasing at this price. Yes, understand. Yes, every year for maintenance and repair. Maintenance 16, repair 0. That means total 16. Second year 18 4 22, 28 20 16 36. Resale value is given. Yes, 15% is given. You will calculate this. If you put in that table, in a single table will get over. Is this clear? Okay. 34 is also same thing only. Model 55,000 you purchased bike. Yes, 1 year old, second year old, third year old. Resale value is there. Yes, road tax, petrol is given. If you add this, you will get total cost. Yes, 3 plus 30, 33. 35 plus 3, 38. 43 plus 3, 46. Oh my God! I say copied our question. Copyright will put a. How they copied the? Bad, na? Very bad. This also is same, huh? That also they copied. Oh my God. Okay. Over. Yes, based on this, one question had come in your hot exam. When? May 24. Advanced capital budgeting past paper is not there because it came for May 24. Long back and all it was there. And all chumma who will keep doing. Yes, 2010, 2012, all those things. Recent you see. Okay, yes. A machine used on a production line must be replaced at least every 4 years. We did for 3 years. This is for 4 years. Purchase price is 1 year. Maintenance repair is given. I will get every year's cost. Scrap value is given. Yes. All these things are given. Present value factor also they have only given. Based on this, I have to calculate. Simplest thing in the world. How much marks it came for? 8 marks it came for. Is this clear, everyone? Okay, perfect. Now, in this chapter, what all I have not done? Okay, we will revise and stop. Firstly, decision tree. There is one simple Jujube question on decision tree. Some 2,40,000 antivirus I have purchased. I have not done. You can see it yourself. Okay. Then replacement decision. In that two part I have done equivalent annual cost calculation as well as yes optimal replacement cycle calculation I have done. Yes, this incremental analysis, should I replace the asset or not? That incremental analysis I have not done. You can see our question bank on that. Some 2 questions are there. You guys try to do it by yourselves. Just incremental approach. Now NPV when I was calculating, I was doing on total basis. Initial investment how much it is, cash inflow how much it is, terminal value how much it is. There I have to do on incremental basis. Incremental initial investment how much it is, incremental cash inflow how much it is, incremental terminal value how much it is. Simple. I am telling, see, I am running a sugarcane business. Right now I am already having asset. From that I am already using. Suppose every year 50,000 I am getting. But I am thinking I will sell this and buy a new machine. Why, sir? Because if I buy a new machine, every year 80,000 I will get. Okay. But to get this 80,000, I should sell this and purchase a new asset. For that payment also I should be doing. So understand, yes, when I am taking this decision, should I do or not? Full 80,000 is not relevant for me. Why? 50,000 today also I am getting. If I replace with the new asset, how much extra I am getting? 30 extra I am getting. On that basis only we will see. Yes, to replace how much extra I am paying today, incremental initial investment. If I replace every year extra, how much inflow I am getting? Incremental cash inflow. At the end of it, extra how much terminal value I am getting? Incremental terminal value. Bring to present value. Based on that, it will be over. Is this clear, everyone? These 2 things I have not done. Then there is one simulation on that. Nothing is there in the study material also. Is this clear? This much only. Everything else we have done. Questions also maximum as much as possible we have done. Yes, sensitivity I have not touched the questions, but simple only, GGB only, you see, you will be in a position to do it. Is this clear, everyone? This was the chapter of advanced capital budgeting. We will revise quickly in 3 to 4 minutes, then we will end the session. Okay, va. Then what plans for Sunday weekend? Sebi, going with X, beach, holding hands. Huh? After 1 or 2 years. Hey, where is Santosh da? Went to meet Exa. Today's notes, summary notes I will upload on the group. Okay. Questions I have uploaded already. We'll do it. Advanced capital budgeting. 3 concepts. Concept 0, basics. Concept 1, risk analysis. Concept 2, replacement decision. Concept 3, miscellaneous. Concept 0, basics. First is the concept of discounting. From present, I want to go to future, means I will include interest into 1 plus interest. Same rate means into 1 plus interest to the power of n. Different rate means every year you will keep on doing. From future, I want to come back, means eliminate interest divided by 1 plus interest. Same rate means directly you can do to the power of n, or else slowly 1 by 1 every year you will keep coming back. Okay, boss, great. NPV, 3 different cash flow. First is initial investment, then during the life, cash inflow during the life, at the end of the life, terminal value. Initial investment, yes, it is for purchasing how much, installation how much, minus subsidy if any I received. Yes, during the life, cash inflow, it is sales minus operating cost, variable fixed cost. I will get my EBITDA minus depreciation. I will arrive at my EBIT minus tax. Directly I will reduce my tax. I will not be reducing interest. When I am discounting, that is getting adjusted. Yes, minus tax. I will arrive at my earnings after tax or no PAT. On that I will add back depreciation. I will arrive at my cash flow after tax. Okay, terminal value. At the end of the life, I will sell the asset. I will get cash. On that, if I am having capital gain, means I will pay tax Capital loss means I will be getting a reduction of that. So it is going to be sale value plus or minus capital gain tax. If it is gain means I will pay minus. If it is loss means I will get the benefit plus. Is this clear, everyone? Yes, all these cash flows are there in different period. Discount, bring it to 0. Based on that, take a calculation. Is this clear, everyone? Okay, great. Profitability index. Yes, it is present value of cash inflow divided by present value of cash outflow. For 1 rupee I am putting today. On today's basis, how much I am getting? Okay, boss. Next is going to be internal rate of return. It is telling actually how much return I am earning. IRR is that rate at which NPV is going to be equal to 0. First, at a random rate, I will discount and calculate NPV. Suppose at 10% I discounted. NPV is positive. That means, am I earning 10%? Yes, I am earning a bit more than 10%. So, I will increase the discount rate and calculate. I will do this and I will arrive at 2 rate. At 1 rate, NPV is positive. At 1 rate, NPV is negative. I will interpolate and calculate my IRR. Is this clear, everyone? Okay, boss. Simple. Then comes risk analysis in capital budgeting. Okay, boss. I calculated NPV. I am okay to start. But risk boss. It is all future now. How do I incorporate risk? First is conventional techniques. RADR, risk adjusted discount rate. It is telling cash flow is riskier, risky. That means discount rate also is going to be risk adjusted. How do I calculate? I am telling boss, even if I don't take risk, I am getting risk free. Okay, in the business, for taking 1 unit of risk, how much premium I am charging into this business, this project is how much times riskier, risk index. Using RADR, I will discount. Okay, one more is certainty equivalent. It is telling boss, cash flow le risk irka, cash flow le risk irka. Yes, I will do one thing. I will see how much is my certain cash flow. It is expected cash flow into CE, certainty equivalent factor. That gives me my certain cash flow. This is a certain cash flow. At which rate I will discount? Risk-free rate I will discount. Story over. Is this clear, everyone? Okay, boss. Yes. Then statistical techniques. Subsequently, I have told. Okay. Scenario analysis, 3 different scenarios are there. In every scenario, I will be calculating NPV. Okay, fine. Decision 3, okay, I have not told, but the concept of joint probability, probability into probability, okay, is going to be needed for us. Sensitivity analysis. Simple point, 2 things I should remember. I want adverse movement and one time, one girlfriend, one factor at a time. Is this clear? 2 different ways I can do it. First, a fixed percent change in every factor. Every factor adversely changes by a fixed percent, say 10%. In that case, what I have to do? First step, I will calculate existing NPV. Second calculate, I am telling factor will change by 10%. I will calculate what is the revised value of factor. For this value, what is the revised NPV? Then I will see the percentage change in NPV. How much percent NPV falls? Wherever NPV falls maximum percent, that is most sensitive. Any case you can do. Yes, the only exception for us was when I told you that, yes, my project life is 3 years, I have to bring it adversely by 10%, it became 2.7, I could not do. I brought it to 2, then I did a cross multiplication and played that, okay. Second is margin of safety approach. Again, step 1 is same, I will calculate, yes, NPV, existing NPV. Existing NPV is, say for example, 50,000. I am telling at what value of this factor, NPV becomes a 0. I want to calculate at what value of this factor, NPV becomes 0. Then I will tell, okay boss, my original value of factor is this, revised value of factor is this. Yes, I will calculate the percentage change in the factor. Wherever for a small percent change in factor, NPV becomes 0, that is the most riskiest, that is the most sensitive. Is this clear, everyone? Okay boss, great. Now how do I calculate the revised value of factor? Simple. Project life, discounted payback period. Year, cash flow, present value of cash flow, cumulative present value. Wherever my cumulative present value is getting close to the investment I am putting, yes, there I want between the 2 years, how will I play? Interpolation I will do. Yes, discount rate. At which discount rate my NPV is going to be equal to 0? It is at my IRR. I will calculate IRR. Okay, sales volume to make my NPV is equal to 0. Yes, different years, different ratio I will be selling. So in that ratio I should give weight. 200, 300, 400 means 2x, 3x, 4x. Everywhere else, whatever value of factor I want to calculate, I will take it as x. But I should remember who is my x. If I want to calculate selling price or variable cost means I will take contribution as x. Quickly we will get over. Everywhere else, that factor I will take it as x. I will finish off the story. This much only is sensitivity. Is this clear, everyone? Okay. Then comes the statistical techniques. Great. Okay. Statistical techniques. Basics. Expected, average, sigma p into x. Yes. If x is cash flow means it is expected cash flow. If x is NPV means this is expected NPV. Yes. Variance. sigma x minus x bar the whole square into P. If x is cash flow means this is cash flows variance. If it is NPV means it is NPV's variance. Square root of variance will give you your standard deviation. Okay. Okay, boss. Fine. NPV is given in the question means directly you will finish it off. Sir, NPV is not given. Three different types of cash flow: perfectly independent, perfectly dependent, moderately dependent. Nothing is given. Default assumption is always going to be perfectly independent. Perfectly independent, we have to be careful. Perfectly independent, so much can happen. I'm telling, who wants this kiri kiri? On what basis I will first do the calculation? Based on cash flow. Every year cash flow I will take. X is cash flow. Probability is given. P into X. I get the expected cash flow. I take x minus x bar, P into x minus x bar the whole square. I get the variance of cash flow. I take a square root. I will get the standard deviation in cash flow. This I will do for year 1, year 2. How many years is there? I will do and keep. Aram se will do. Over. Now, careful. Aram. For project as a whole, I want to calculate NPV. How will I calculate NPV, boss? Very simple. I know initial investment. Every year, how much cash flow I am expecting to get, that I calculated and kept. X bar, expected cash flow. Bring it to present value. I will get expected NPV. Okay, okay, boss. Sir, I have to calculate risk. Okay, great, boss. Now tell me. Yes, I have calculated standard deviation of cash flow 1, standard deviation of cash flow 2, standard deviation of cash flow 3, so on and so forth. Yes, now I want, yes, risk in what? Risk in cash flow. Risk in NPV I want. Where is NPV standing? At t is equal to 0. That means I have to bring it to present value terms. So it is going to be sigma cash flow 1 into present value factor 1 plus sigma cash flow 2 into present value factor 2. But wait, boss. Promise we made to Markowitz. Risk is always what? Square terms. So I will be doing a square. Is this clear, everyone? Over. GGB. After that, take a square root, you will be getting standard deviation. Okay, boss. This only was a bit different. Everywhere else it is aram only, simple only. Yes, suppose perfectly dependent. Yes, first year whatever may happen. First year if this happens means second year this only will happen. Third year this only will happen. Yes, like that. Three different scenarios will be given. Three different paths are there. For every path I will calculate NPV. That is my X, step 1. For every path I will calculate the probability. Probability is that first year's probability only. Okay, X. P into X. Yes, X minus X bar. P into X minus X bar the whole square. P into X is the expected NPV. That is the variance in NPV. Take a square root, you will get the standard deviation of NPV. Okay. Next comes again moderately dependent. Year 1 this may happen, this may happen. If year 1 is bad, year 2 is also bad, but in that these three can happen. Year 1 is good, year 2 is also good, but in that these three can happen. Yes, there is no way out. Path based approach only I should be doing. Is this clear? So I will see every path. For every path I will calculate NPV. That is my X. For every path I will see the probability. Yes, joint probability. Probability into probability. Yes, my X is NPV. So P into X I will get expected NPV. X minus X bar. P into X minus X bar the whole square is a variance in NPV. Take a square root, you will get the standard deviation in NPV. Is this clear, everyone? Okay, boss. Great. This is also over. Then comes concept 1 is over for us. Concept 2, replacement decision. In that I told how do I take a decision based on equivalent annual cost. A different period cost I am incurring, I brought it to present value. I got present value of cash outflow. On this basis I could have taken decision, but life is different, boss. So I want to know every year's cash outflow is how much. So divided by number of years. But wait, boss, this is on present value. That means number of years should also be on present value. That is divided by present value annuity factor. Okay, okay, boss. Third one is going to be my optimal replacement cycle. Yes, what is my optimal replacement cycle trying to tell me? Yes, it is telling, boss, simple. 2 steps. Yes, different options are there. 3 years is the life of the asset, means either I can sell at the end of first year, or I can sell at the end of second year, or I can sell at the end of third year. For every option, step 1, calculate present value of cash outflow. Initial investment plus running cost minus salvage value. Bring everything to present value. Boss, it is at present value. I want for every year divided by present value annuity factor. You will be getting equivalent annual cost. Wherever it is the lowest, that is the best that you choose. This is going to be the format that we are going to keep in mind. Is this clear, everyone? Okay, boss. Then comes miscellaneous areas. In that, the first one is impact of inflation in capital budgeting decision. Okay, boss. Decision I am taking based on today's data, but things are happening in the future. Yes, simple point, I should convert everything into nominal. Yes, my discount rate is there. Yes, cash flow is there. Yes, everything should be nominal. Now, firstly, cash flow, how will I convert into nominal? Today's cash flow is there. I want to futures cash flow. Include interest. That is basically include inflation. Same inflation into 1 plus inflation to the power of n. Different year. Every year you keep on doing. Over, boss. So, firstly, I told, okay, nominal cash flow. Next comes to nominal discount rate. 1 plus factor into 1 plus factor minus 1. It is 1 plus real rate into 1 plus inflation minus 1. Based on that, you calculate your NPV. Is this clear? Yes. Then had the most challenging thing, utility approach, sigma of utility into probability. Yes, chapter is O. Is this clear, everyone? Perfect. So that is it for today. Yes, go back home, practice questions. Okay. Try. Statistical techniques is a bit challenging. You will have to tell to yourself what exactly is it. Okay, do not let the external noise fool you. Very simple it is, but you have to be careful. That's all. Sensitivity is also simple only. Replacement is also simple only. This chapter is simple actually, but you have to see the questions and be ready. In this model only will come because it's a new chapter. Okay, tomorrow we will do the chapter mutual funds. It's actually a very simple chapter, but there are different variants of questions that can be asked. Once we understand each variant properly, basically NAV calculation only is there, but each variant how I should do, once I understand it, chapter is going to be over. Every question also will be doing. Last day we'll go into forex, how much ever we can do it. Is this clear? So thank you so much, students. See you guys tomorrow. Have a great day. Bye. Yes, online students, we will end the session. Okay, wow. Thank you so much, sir. Thank you so much, dear. Yeah, students, I hope there is no doubts. So I will end the session. Okay, na?